outlook, or at least warning on their profit outlook. I should also say yesterday, Credit Suisse in the European session ended higher. That was after that Swiss blog reported that potentially State Street is interested in a takeover. In the U.S. session, though, the ADR trading, that ended lower by about 1%. A lot of cold water was thrown on this idea. We had a lot of analysts saying, look, this doesn't make sense. Jefferies called it unlikely as well. So you might see Credit Suisse give back some of those gains that happened late yesterday.
Danny, I struggle to remember a 24 hours period when Credit Suisse wasn't prominently in the headlines.
Yeah, true.
You're also looking at Kering. Tell us what the news is there.
So Kering held a capital markets day yesterday, and in it they talked about St. Laurent YSL, saying that they plan to more than double their annual revenue of St. Laurent. They're really focusing on this, trying to widen the breadth of mega brands. They have analysts very excited about this, saying that it's a good way to increase their staples of brands.
Danny, thanks very much. I know chip stock's also in focus for Danny Berger. Thanks to Danny for that update there. Just a few minutes then until the start of the European equity trading session, and European futures are pointing lower. We have the ECB today. That's going to be the big event of the day. What will we hear from President Christine Lagarde as they prepare the way towards July? This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome to the European Market Open, everyone. A minute to go until the start of cash equity trading. I'm Francine Lacqua here in London with Tom McKenzie.
And here are your top stories. Countdown to lift off. The ECB will pave the way today for its first rate hike in over a decade as it seeks to tame record inflation. We are live in Amsterdam for that decision. Silence fuels the speculation. State Street slides after refusing to comment on a report it may buy Credit Suisse. Shares of the Zurich-based bank jump. Plus, trade rebound. Chinese exports surge as COVID disruptions ease, but inflation concerns still weigh on Asia stocks.
Tom, let's take a look at the futures. Now, the futures are, of course, once again worried about monetary policy and inflation, monetary policy being too aggressive with inflation, not taking care enough about growth. So European stocks, of course, the futures are down about 0.5%, and then we see what the ECB and Christine Lagarde comes up with later.
Absolutely, the end to the asset purchase programme, and then whether we get some clarity in terms of that rate hike cycle that is being lined up by the European Central Bank. That is the expectation. At least on the China story, yes, we had stronger exports. Certainly, the longer-term picture is one of concern about demand from its international markets and trading partners. And then, of course, you have additional restrictions being put in place in Shanghai. Just a reminder that COVID-0 is proving and remains disruptive. The FTSE 100 is now down 0.6%. The German DAX in similar territory, losing 82 points just in the first few seconds. Over in France, the CAC 40 lower by 0.6%. Spanish IBEX faring less badly than the other major indexes, just in the first few seconds, down 26 points or 0.3%. Let's switch it on then and look at how things are playing out across assets. We had, of course, red on the screen on Wall Street yesterday. The futures looking to build on that loss then, just by about 0.1%. It is that CPI and the inflation data out on Friday that will be a key focus, of course, for US investors. Euro dollar, as we look ahead to Madame Lagarde's decision, 107. Not a lot of movement in the single currency. Italian 2-year, just wanted to bring this attention, but of course there is concern that as you get higher rates, the end to the APP and that additional support from the ECB, that maybe you get a blowout in those peripheral spreads. Currently at 118, just a move a little over 1 basis points for the Italian 2-year. Not much movement there then in terms of that sensitivity. Natural gas, bringing that to your attention as well. Look at that gain, 33%. This is on the back of some disruption around one of the key terminals in Texas, one of 7 export terminals stateside. There's been a fire there. It means that potentially there is less US gas then on the international markets, and you're seeing a reaction to that, up 33%. Francine?
Yeah, it's interesting actually on the Italian 2-year yield. I was speaking to a couple of Italian officials, and they were saying, look, it's always Italy at the forefront of some of these concerns, but this time they believe that it's not their fault. It's not about reforms not being done, but it's really about that proximity to Russian gas. So a lot of them really worried that the ECB will not do enough to help them, step in and make sure that that spread doesn't narrow too much between BTPs and Bunds. Overall, I don't have much for you, Tom. If you look at all the sectors, they're down, so there's not one in the green. Just about actually energy, 0.2% higher. A moment ago, it was down. Utilities, telecoms down, and then the biggest losers, basic resources and technology, down over 1.5%.
Okay, let's dig into some of these key themes then, percolating through these markets with MLive's Mark Cudmore. Mark, what are you looking at?
Good morning, Tom. Well, as you and Francine said, it is always about Italy. And I may have a slightly different stance than Francine about whether Italy are entirely innocent for why it's always about them. But today, I think the ECB reaction will be really interesting. So I want to draw your attention to 2 charts. The first is the spread between BTP 10-year yields and Bund 10-year yields. And you can see it's just above 200 basis points. We're getting a little bit nervous now. I've highlighted 300 basis points as the danger zone. This is a little bit arbitrary. People might decide it's a slightly different level. The reason I've picked that is because that's where we got up to above there in 2018, when we really were worried about the sustainability of Italy's debt and how that would kind of play out. I would note that the spreads there were nowhere near the Eurozone crisis, and before we got whatever it takes and before we kind of really changed the stance of the Eurozone. I think that we will get spreads above this level because we're in a different environment, even though I don't think the panic will be as great as 4 years ago, because I think the pandemic brought us ever closer towards debt mutualization. However, I want to bring one more chart into play. And the reason I'm drawing attention to this is I was at a macro roundtable last night, and half the group, a minority of the group, were extremely worried about Italy and kind of think this is going to be one of the big themes the next 6 months, that people are underpricing. I'd say the other majority were less vocal, but a little bit more relaxed about it. But the reason some people are so concerned is that, hey, it's not just about spreads here. There's a reason to look at nominal yields. They're up at 3.4% at the moment of the 10-year yields. We're getting close to the levels that we got to in 2018. Given that we're in a world of rising yields, given that the ECB is just about to start hiking rates, and we're just about to start the path of kind of tightening policy, we can expect those yields to go much, much higher. And the level of nominal yields here matters, because Italy has debt to GDP of 150% or north of 150%. They no longer have a primary surplus. They're at serious risk of just not having a sustainable debt bubble. It's a self-fulfilling negative spiral that basically grows to infinity unless you have some external event come in and forces the ECB to explicitly mutualize debt. I think ultimately that is the path we're going down. ultimately this will be a very bullish moment for Europe when it happens. But I think the path there will be a moment of kind of stress and panic. And I think this will play out over the next 6 months, 12 months.
Yeah, you're probably right, Mark. I mean, there is, of course, the hope still that the ECB comes out with some kind of stronger language. And this is what I hear in the circles in Rome, and saying, well, Mario Draghi used to be able to keep a lid on interest rates without actually doing much on yields. If they'd say we won't allow fragmentation, I don't know whether that's enough or not.
Look, I think how they discuss fragmentation today will be really, really important. We're not expecting anything in the statement, but Lagarde's going to be asked about that. Like, will there be an explicit plan to fight fragmentation, or kind of, what's their plan around that in the Eurozone? And I think how they handle that will be quite important. People are watching for that. I don't think it'll be a big disappointment if they don't have a clear plan. I'd be surprised if they have a clear plan already, in fact. But I do think that's something that's going to be increasingly focused over the coming months. And the reason it's in focus is because, as you said, Francine, it's always Italy.
It's always Italy for a number of reasons. They also have great food, but we'll talk about that, Mark, another time. Our Bloomberg MLive managing editor, Mark Cudmore. Now, we're also looking at Credit Suisse. We were yesterday at some point expecting State Street to come out with some kind of release saying that they're interested in Credit Suisse or not, but actually they decided not to do so. Now, yesterday was a wild whipsawing day for Credit Suisse. The share price started yesterday, the day down 7.5% on a profit warning, rumors about cost cuts, Bloomberg scoop saying they will fire people, and then this report by Paradeplatz on a blog saying that they'll be bought out at 9. We're currently at 6.74. This is 9 Swiss franc per share price by State Street. They've never confirmed it. They haven't denied it. And you can see Credit Suisse down 3.2% today.
Yeah, the other line that crossed just in the last few minutes or so from our Asia team is the news, according to our reporting, that they are looking to put a brake on their Asia expansion, particularly in China. So as investors also adjusting or indeed digesting that. There is a lot of news flow on Credit Suisse, but it's the news around China that is also a factor here. I remember speaking to the former CEO, I know that you spoke to a number of times as well, Tidjane Chen, when he came over to Beijing as part of that push, the importance he was saying about the wealth management business in Asia. Now they are putting a bit of a brake on that. OK, it is decision day. Let's go from the individual corporate stories to the macro. The decision day, of course, for the ECB President, Madame Lagarde, and her colleagues in what could mark a major shift in euro area monetary policy. Joining us live from Rome, from the Goldman Sachs Annual European Financials Conference, is Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs. Good morning, Peter. Fantastic to have you on today, as ever. Thank you for your time. Let's start then with the look ahead to the ECB and the decision from Madame Lagarde. What and how will an increase in interest rates of whether it's 25 basis points or 50 basis points change your thesis on European equities at this point?
Well, I don't think that in itself will change the outlook. It's widely expected that they're going to raise rates and guide towards the runoff from QE. But the question really, I think, is what's going to happen to interest rates over a period of time, and what guidance do we get about that? I mean, our own view is that we'll get back-to-back rate rises through to June of next year, terminal rate at around 1.5%. The risks are probably on the upside, but bear in mind that's still a very negative level of real rates at a time when nominal GDP is reasonably strong and valuations of equities have come down a long way and, in our view, remain reasonably attractive for people who are taking a sort of 12-month view. So we expect more choppiness in the near term, but I think there is some value in the European market given that rate context still.
So, Peter, I was going to ask, and good morning, it's also Francine, where you see that value, but also are we going to see some kind of earnings recession even if the economy in Europe doesn't go through it?
I think it's possible. I mean, we're looking at low single-digit earnings growth. Our numbers are below consensus. I think the consensus numbers will come down. It wouldn't take much to get negative earnings, but I don't think it's likely that we'll get a deep recession or a deep recession in earnings over the course of the next year or so. Some important points to bear in mind. Despite all of the obvious negative factors hitting the economy, we do have relatively strong balance sheets in the household sector, the corporate sector, and of course in the banks. And we're getting quite a big easing of fiscal policy as well. And labour markets are strong. None of that will prevent a downturn, but I think it will limit the extent of it. And we're still pretty bullish about commodity prices and that part of the market. where you're still getting quite strong rises in cash flow and earnings, and that will offset some of the other areas of potential weakness. So I don't think a deep profit recession is very likely.
And Peter, you flagged the capex cycle that could be confronting us as a catalyst for some of these corporates and some of these equities going forward. How do you position, how do you invest along that potential uplift from capex?
Yeah, well, let me just say, look, this is again one of the changes structurally I think we're beginning to see. In the last decade or so, there was very little capex spending. In fact, capex as a share of free cash flow came down, particularly in Europe, in an environment of weak growth and a lot of excess capacity. The world has changed. We have supply shortages. We've got renewed commitments for increased defense spending, renewables, and the transition in energy. All of this is going to cost a lot. We think that companies that are facilitating that change are the ones that are likely to benefit most. So this is across a range of different industries, but certainly across capital goods and industrials. Some of these companies will see better revenue growth than they've been used to for a decade or so in a period of quite low nominal GDP.
Peter, what do the Treasury yield in the U.S. 10-year at 3% or above mean for equities?
Well, financial conditions, of course, have tightened, partly as a result of that, and equity weakness as well. But arguably, they're still relatively loose compared to periods not so long ago. And again, Treasury yields at 3% are certainly high relative to where they were at the beginning of this year, but they're very low relative to where they were not so long ago. Remember, before the financial crisis, 10-year Treasury yields were about 4.5%. And because inflation is higher today, real rates are much lower. So when you can compare that against the equity market, where multiples have come down, where dividend yields are still reasonably high, there's still a gap there, which provides a bit of a cushion, a bit of a buffer for risk assets like equities in the context of those higher bond yields.
Peter, thanks so much. Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs, stays with us. And this is such a Goldman Sachs move, Peter. You're where the action's at, because we talk about ECB fragmentation. So I need to ask you about the Roman espresso. And then I know at the European Financial Conference where you're attending, we'll also hear from Mr. Gutstein of Credit Suisse a little bit later on. So we'll ask you about banks and, of course, the ECB. Coming up, demand for homes in the UK falls, signaling that rising interest rates and the cost of living crisis are taking a toll on the property market. We have more on that story later on in the program, and this is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think the real challenge for us there is on the cost side. The part that's less controllable is really around inflation.
You know, there's much more uncertainty as you look forward 6 to 12 months.
It's obviously going to make some companies be more conservative about letting the rope out and getting more aggressive.
As I've said many times, we think the greater risk by far is deflation. We think inflation will unravel.
Tech Voices there talking inflation. The last voice, of course, Kathy Wood on the question of high inventories. Fran.
Now, still with us, Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs. He's in Rome. We're all jealous. We all wish we could follow the fragmentation story from Rome at the annual European Financial Conferences 2022. So, Peter, I bet you're delighted to be in Rome. You also have some great speakers, actually, at the conference, Thomas Gottstein, a little bit later on. I'm sure he'll address M&A in some form. Looking at equities, are we going to see a consolidation phase in the banking space?
Well, this is a story that keeps coming back, and it goes in waves, and there are hopes that we can see this. But I think a lot of it really ties down to the issue of progress on banking union, and there does seem to be a bit more momentum in that direction again. And indeed, if that happens, I think it could unleash a lot of potential M&A and consolidation and boost returns at a time when rates are rising, pushing up net interest margins, and that becomes a much more attractive prospect for investors, which have long neglected the banking system and bank stocks in Europe, for good reason, for a decade or so. So I think the dynamics are changing a little bit, and M&A is one part of that story that's looking a little bit more promising, Francine.
And Peter, we were hearing there from some tech executives, of course, in a time of high yields now on the 10-year above 3%. What do you do with mega cap tech in this environment, given that valuations have come down? Is there an opportunity, if you're looking 12 months out, as you've described, is there an opportunity to add exposure to mega cap tech?
Yeah, I think there is. I mean, we've generally been tilted towards value really since late 2020 because we felt that in an environment of a bit more inflation and rising interest rates and actually rising returns in the energy and the bank sector, you would get this shift. But of course, since then, rates have risen much more quickly than we and others anticipated, and that's derated tech quite significantly. But large cap tech, which has also pulled back, generally is very profitable, very cash generative, and you're starting to see valuations there, which I think are quite attractive. So as we move forwards in time, we think that the market is going to become much more eclectic in terms of leadership, less driven really by these opposing factors between growth and value, and much more really about the ability to sustain margins and generate cash flow. And I think you'll see that possibility in parts of technology and also in parts of the more traditional value areas of the market as well.
But Peter, what are the kind of places in that space that you would invest in right now? And I imagine there's a trend. We all thought that we'd watch more Netflix, maybe. We all thought that we'd order more food on Deliveroo and whatnot. And it seems like things are changing in a way that a lot of investors weren't expecting.
Yeah, I think the technology is always evolving almost by definition. And I think what we're seeing is a series of challenges in the world which we haven't seen previously, including higher energy costs, including higher labor costs. This, I think, will generate a lot of investment in ways to improve productivity, become more efficient, substitute technology for labor. Technology will be part of the solution. And I think finding companies that can facilitate that improved productivity and efficiency will be part of what we see winning as we move forward. So things like robotics, artificial intelligence, and so on. So different types of technology. And also, I think technology is sort of broadening out outside of the technology sector. It's becoming increasingly difficult to, define what is and what isn't a technology company.
Peter, you touched on, so from technology to energy, you've touched on energy, you're an equities man, of course, but let me take the liberty of asking you about commodities. It's part of our MLive Pulse survey for the week. Do you have a view on which commodity will outperform this year and which will underperform?
Well, we're structurally bullish of commodities. We think they play an important increasing role in asset allocation as a real asset, as an inflation hedge. But structurally, we think commodity prices are going to be rising anyway because of a profound lack of supply and underinvestment over a very long period of time. We're particularly bullish on oil prices. We see still reasonably strong upside from where we are now. And think that will feed through to better performance in the equity space around the commodity sectors as well.
Okay, Peter Oppenheimer, as ever, we appreciate your insights, the constructive case there for equities from the chief global equity strategist at Goldman Sachs. Joining us out of Rome, of course.
We should be in Rome. Road trip to Rome.
We need to make that pitch, don't we? The espressos and that split when it comes to BTPs.
All about ECB. We're not
the espressos to BTPs, I know. I prefer the espressos. Coming up, Credit Suisse, we've been talking about this. Their shares drop as State Street declines to comment on reports of a potential takeover. Also the news on their moves to maybe a cap expansion in China. We've got more on that story next. This is Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Welcome back to the Open, everyone. 23 minutes into the European trading day. You can see European stocks down between 0.5% and 0.7%. But really, it's all about the ECB starting, of course, that process of reducing the balance sheet. And the one thing that people want to know about is what they'll do with fragmentation. So watch out for the press conference of Madame Lagarde a little bit later on. Now, the banking world was abuzz with talk of a high-profile takeover yesterday. A Swiss blog said State Street can make a bid for Credit Suisse. Now, the U.S. bank declined to comment on the report, falling the most in almost 2 months. Now, Credit Suisse shares lower this morning, giving up some of yesterday's gain. For more, we're joined by Tom Metcalf. Tom, I have to say, yesterday was not the day I was expecting for Credit Suisse. The profit warning, down 7%. We have a great scoop saying that they'll have to, cut costs and fire people. It's still down by less. And then takeover targets boom, it finishes 6% higher. Like, what is going on?
Yeah, it was an absolute roller coaster, and it's still unresolved. So it's still fascinating. We spent most of the yesterday afternoon waiting for State Street to give a statement, hoping it might clarify its position. And what it came out with was very, very intriguing. Basically saying, look, we're not going to comment on media reports, and we're just focused on kind of executing on existing things. But that is not like a full denial. So who knows what's going on? It's fascinating.
They're in the process already of going through, as you say, this fairly significant acquisition anyway. So they've got to work through that. But what would they be looking for, State Street, in Credit Suisse? The whole business, the asset management side. What would be looking tempting to them?
Well, according to this well-read and closely followed blog, it basically sounds like they would bid for the whole firm, and that is kind of would surprise a lot of analysts because there's so many problems associated with buying a whole bank, from regulation just as absorbing it. So I think when people look at this as a practical thing, perhaps they think maybe it's a prelude to just the asset management arm or something like that. That certainly would be one of the most attractive parts of Credit Suisse right now. So it's hard to know.
Expensive. I mean, look at the share price. It's at 669, and apparently they'd want to buy it at 9. Like, I just don't understand why they would do that.
Well, it's definitely a premium, but I mean, compared to what Credit Suisse was once worth, maybe going back a few years.
War, Tom. Am I like really downbeat on this, and I shouldn't be?
You're very anti-Credit Suisse right now.
I'm not. But is it like, what's it worth?
Oh, well, I mean, right now its market cap is what, 16 billion Swiss francs, and you look at something like UBS, which is many times higher than that. So Credit Suisse is going through a very tough moment, which puts it in play, of course. But then the question is it really up for sale or anything like that?
Okay, Tom Metcalf, I believe, and I get the sense we're going to be getting you back on, next couple of hours, next couple of days on this story.
Well, Gottstein is speaking actually at the Goldman Sachs conference.
Worth listening into then.
At 10:15 a.m. UK time, 45 minutes. 11:15
ECT, 10:15 UK. Coming up, we have a new era of monetary policy for the euro area, maybe ahead, as the ECB pivots to confront that inflation threat, more than 8% across the eurozone. Today's rate decision is 12:45 UK time. After Gottstein, then we will look ahead to that next. This is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines will work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Countdown to liftoff. The ECB will pave the way today for its first rate hike in over a decade as it seeks to tame record inflation. Live in Amsterdam. Credit Suisse seesaws. The Swiss lender's shares down in early trade after State Street refuses to comment on a report of a potential takeover bid. We also have news on what they want to do in Asia, plus trade rebound. Chinese exports surge as COVID disruption eases. Inflation concerns still weigh on Asian stocks. Now, Tom, if you look at the markets, I mean, they're looking at monetary policy, and once again, they worry about inflation.
Yeah, what about inflation? We're seeing Brent above $120 a barrel. You've got the restrictions around that export of gas out of the United States, potentially on the back of that fire that we're seeing at a terminal in Texas. Looking ahead, of course, to that decision, as we say in the headlines from the ECB and Madame Lagarde. And then on the China side, yes, better export numbers, but further restrictions in Shanghai. A lockdown of part of the city there on some additional COVID cases, and some restrictions as well in a key district, the diplomatic district of Chaoyang in Beijing. So that continues to be a headwind, of course, for the economy of China. In terms of how things are playing out across these markets, 30 minutes into the trading day this Thursday, you're seeing losses of 0.8%. The DAX is down 132 points, lower by 0.9% on the German benchmark. The FTSE 100 down 0.6%. Let's switch it on, see how things are playing out across sectors. Then the last time I looked, it was just energy that was the only sector eking out gains. That remains the case, up 0.4%. Again, oil and gas a factor there. At the bottom of the list, you've got basic resources down 1.5%. That will be tied to what we're seeing in China, no doubt. Consumer and finance also lower. The story around Credit Suisse remains in focus. One of the key corporate stories for us today, of course, Francine.
Yeah, now this is what we're looking at in general. Now, this is without a doubt, I think, what we need to look at in terms of fragmentation. I think we have a wonderful, wonderful chart that our Valerie put together looking at, for example, the difference and the spread between Italian, of course, BTPs and German Bunds. One thing that a lot of, I guess, actors in a lot of governments are hoping for is some kind of support coming from the ECB saying that they won't tolerate any fragmentation. Now, armed with new forecasts and with prices rising at a record pace, the ECB President Christine Lagarde and her colleagues look set 10 trillions of euros of asset purchases and cement a path to exiting 8 years of negative interest rates at today's monetary policy meeting. So for more, we're joined by our Europe correspondent Maria Tadeo from Amsterdam, where ECB Governing Council are. Maria, Amsterdam, I mean, A, lucky you, but two, it's quite strange to see the ECB meeting there. A very highly anticipated meeting. What can we expect?
Yes, Francine, very highly anticipated meeting. And of course, we're in Amsterdam. I think the shot kind of gives it away. We went out and scouted the most Dutch scenery that we could get for you. The location changes, but the focus of the meeting, Francine, is still very much a story about inflation, inflation, inflation. Now, today we are going to get updated projections all the way to 2024. That's important in terms of the future calibration. No policy decision expected, but nonetheless, Francine, two big things happening in the meeting. One, we're very much likely going to get confirmation by the ECB that the asset purchase program is coming to an end within the next few weeks. And of course, that opens and paves a way to that first rate hike. Of course, the market very well calibrated that this is going to happen in July. The question is the magnitude around the hiking path going forward. But overall, Francine, if you put everything together, it really does feel like today it's the end of an era for the European Central Bank, the start of a new one, certainly around the path of more rate hikes and the story around inflation, big concerns about the way that all of this is feeding into the European economy and in particular the cost of living. Just to give you an example, today we had the Dutch inflation coming out again at 10%. That more than almost quadruples the target of the ECB, just below 2%.
And all of that, Maria, of course, making it incredibly challenging, the press conference for Madame Lagarde, and having to walk this tightrope. What are you going to be zeroing in on in terms of the words and the language that she's likely to use?
Yeah, And Tom, we always say the press conference at this point is more challenging than almost a decision. And of course, traders keeping a very close eye on the language here. I think there's two things that will really be the focus. Is she going to stay around the 25 basis points narrative that seemed to be consensus up until a few weeks ago? Or do we get a hawkish pivot that now potentially opens the door to 50 basis points? There's a number of calls out there by a number of banks already saying when you look at the inflation print, the ECB is going to have to go harder than 25. Now, the other big thing, of course, will be fragmentation. The more you normalize and, of course, you hike rates, the more volatility you could see in the bond market. That fragmentation, whether or not the ECB is ready to provide some buffer for the euro system, can provide a policy that works for 19 different economies. I think that's something that will be at top of the agenda. And not just fragmentation as an abstract concept, but are we going to get any hints that the European Central Bank is clearly working now on a tool to deal potentially with the spillover of the hiking policy?
Okay, Bloomberg's Maria today on the ground in Amsterdam, previewing that meeting for us, that decision at 12:45 UK time. Let's get more on this now with Sarah Hewen, Head of Research Europe and Americas at Standard Chartered Bank. Sarah, thank you for joining us in the studio on this important day for the ECB. You are expecting rate hikes in July and September. Can the ECB push through rate hikes without causing that dispersion, that breakdown, or that blowout in yields across the periphery?
They've flagged it very clearly. So we've had a very clear heads up from Lagarde, from Philip Lane, that rate hikes will start in July. And Lane has gone further. He's indicated 25 basis points, most likely. Now, that should be enough of a heads up for markets to avoid a big blow up. The question is, do they go for 50 basis points? As your correspondent Maria was saying, there is some suggestion that they might want to go more hawkish, and there are good reasons for doing that. High inflation, the fact that other central banks are taking more hawkish, front-loading rate hikes. But we think that they're going to take a more gradual approach and that this is going to be the message from Lagarde this afternoon.
But Sarah, so we had an exclusive interview with Christine Lagarde 10 days ago in Davos, and she said, first of all, they're not in a panic zone. It was the day after the European blog, which was a clear message to the Governing Council and probably to the hawks as well. Wait, why do 50 basis points now? And is there a danger that actually her messaging is getting lost because the hawks keep on talking?
I think it accurately reflects the dilemma because there is a real concern about inflation becoming embedded. And we know that Lagarde and Lane and me, and probably the doves on the Governing Council are worried that wages are going to accelerate. We've got minimum wages being increased quite rapidly across a number of major economies, and inflation expectations are building. So that would be the reason for front loading. But at the same time, of course, the economy is looking weak. Confidence is very weak. They are particularly concerned as well about tightening credit conditions. So the European Banks Survey suggests that banks are going to be tightening credit conditions quite dramatically in the coming months, and that's even without a clear signal about a 50 basis points hike. So this is a very good reason for staying gradual.
We were speaking to Simon French of Panmure earlier, an economist there, looking at all things Eurozone. He was saying there's relative resilience in European corporates and in the financial system after years of easy policy. Does that resilience give some strength then going forward? Do you agree with that assessment in terms of the ability for corporates to weather higher rates across the Eurozone?
I do agree. I think that there is a certain amount of ammunition that's being built up, and corporate balance sheets are in a much stronger position. What we can't account for are the geopolitical risks and the global risks. So the impact that high commodity prices is going to have on global growth, there are real concerns that we start to see a slowdown, not just in Europe, but in the US, and of course uncertainty over where China is for the second half of the year. In Europe specifically, there is another concern, which is what happens to gas imports later this year. Is Russian gas weaponized? And that would certainly tip the economy into recession if we were to see Russian gas imports cut off.
So what happens if there was a gas embargo, probably from the Russia side? What happens to ECB policy? Is there anything that they can do actually to try and temper that?
I think this goes back to the gradualism message. It's don't do too much too fast. Flexibility, optionality are the other key words that Lagarde has mentioned. And it's let's deal with the situation as we see it. We can predict that wages are going to start to pick up. We can't predict what is going to happen to commodity prices, but we need to be conscious of the impact and the fact that governments can offset to a certain extent. We have seen government support for corporates and for households, but that ultimately is limited. And we see that reflected in the very weak confidence numbers, particularly for households.
That fiscal impulse, do we expect more from European governments as they weigh up those higher energy prices to cope in some way with that impact on households, and to what extent that fiscal impulse could offset some of the tightening from the ECB?
Yes, governments are very alert to the risks that they're all facing at the moment, and I think that we probably will see further support. And of course, we have the Recovery Fund money which is coming through, which will be activated and is being activated and will provide something of an offset. Governments are in a tricky position, of course, and we have to mention the fragmentation word. The risk is that if you see too aggressive fiscal spending, particularly amongst the peripheral governments, then bond yields will rise very rapidly. It'll be interesting to see what ECB says this afternoon about how they intend to offset that. No, there's no silver bullet here.
Sarah, thank you so much. Sarah Hewen, there, Head of Research, Europe and Americas at Standard Chartered Bank. Now, coming up, we'll be back out at Goldman Sachs' European Financial Conference in Rome. We'll dive into capital flows with Richard Ramsden, the lender's Head of Financial Institutional Research. That's coming up next, and this is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Welcome back to the Open. 43 minutes into your European trading day. Losses of around 0.9% across European equities. Every single sector this Thursday morning 43 minutes into the trading session in the red, apart from energy standing out just with a gain of just a little over 0.1%. Of course, Brent remains elevated above $120 a barrel. Interesting, some fluctuations across the yield space, particularly when it comes to those Italian BTPs as we head up to that ECB decision. You're currently seeing money moving in to those bonds. Yields are down. They started the session with the yields up. Currently, the front end yields off by about 2 basis points on the 10-year, yields down by about 4 basis points on BTPs. Francine.
Now, joining us live from Rome, beautiful Rome, La Grande Bellezza. Can you see I'm a bit gutted not to be there? From the Goldman Sachs Annual European Financials Conference is Richard Ramsden. He's Managing Director and Head of U.S. Financial Institutions Research at Goldman Sachs. Richard, thank you for joining us, especially since you're in beautiful Rome. A lot of the talk, of course, today is about M&A. You can't specifically talk about Credit Suisse, but I was surprised to see that share price shoot up on speculation that it would be bought out by a U.S. bank. In general, do you think we'll see more of these kind of transatlantic acquisitions?
You know, so a couple of thoughts around that. I mean, we've obviously seen quite a lot of consolidation in the U.S. System over the last decade. It's clear that one of the success factors within banking is scale. You've seen the barriers to entry increase significantly, you know, and firms have realized that if they want to generate superior returns, you know, really having economies of scale are absolutely critical in terms of achieving that. You know, having said that, I think the bar for cross-border consolidation is pretty high, both from a regulatory perspective, especially when you're dealing with very large institutions, but also from a shareholder perspective in terms of your ability to extract synergies out of a transaction like that.
Richard, I'm looking more broadly at the banking index, the KBW bank index down on around 14% year to date. Have you been surprised by the inability of these banking stocks to get a lift from higher rates? Why is that not playing through in that view on higher net interest margins for these banks?
So I think that is the number one question that people are asking. I mean, if you look at the fundamentals within the US banking system today, they're actually remarkably good. You know, so loan growth is running at high single digit. It's the highest level it's been in 20 years. And that's because of elevated corporate loan demand as well as consumer loan demand. So on the corporate side, you know, corporates are obviously rebuilding inventories. There's a step up in terms of CapEx spending. And more of that is getting funded by the banking industry, just given that obviously conditions in high yield markets have become more challenging. You've got credit costs or credit losses, which are the lowest level that they've been in 30 years. And that just reflects the remarkable position the US consumer is in, but also just the fact that, you know, corporates continue to have very high levels of liquidity. You've had relatively good levels of activity in capital markets, especially on the trading side. You know, so if you look at equity and fixed income trading, you know, we're expecting that those are going to continue to grow year on year. And the capital and liquidity position of the banking system in the US is still pretty good. So why have the stocks underperformed? I think the reason is really because of this concern around tightening financial conditions and what that's going to mean in terms of probability of recession. You know, so we're expecting that this year, the banking system in the US is going to see an improvement in profitability of between 300 to 400 basis points in terms of return on equity. I think the market really is discounting that because they think it's going to be temporary. You know, I think the average bank stock in the US today is discounting somewhere between a 50 to 60% probability of recession. And obviously in a recession, credit losses are going to pick up and interest rates presumably will start to fall again.
So, Richard, given what you've just said, do you have any, favorite banks? Like, what's the safest bet right now? You have very diverse different banks, ones that are much focused on retail, the other ones more investment banks.
Yeah, so if you think about the characteristics of a bank that you want to own today, I think there's three things that you really want to look for. The first is you want leverage to higher interest rates. I mean, clearly, you know, the pickup in terms of interest rates is going to be very important in terms of net interest margin expansion and in terms of profitability. The second thing is that you want a bank that is going to be able to deliver operating leverage. You know, so the banks are not immune to inflation. You know, they are seeing much higher labor costs. So you want a bank that's going to be able to deliver operating leverage. And the third thing is you want a bank that hasn't grown that rapidly into the downturn, you know, because the loan portfolios that I think that will perform the worst in an economic downturn are probably the ones that you've accumulated over the last couple of years. So the bank stocks that we like Bank America. We think that they are very rate sensitive. We think they can keep expenses broadly flat this year, and they've been a very conservative underwriter. We like JP Morgan, again, because of the rate sensitivity and because we do think they have a fortress balance sheet. And we do like some of the regional banks as well, which are exposed to higher interest rates.
The fortress balance sheet of JP Morgan, currently at $128 a share. You've got the price target at 161. Do you get there by the end of the year to that price target, Richard? And are there catalysts there even amid these concerns of a recession?
So it's a 12-month price target. Look, it is somewhat of a binary outcome. I mean, if we don't have an economic downturn of any noticeable amount in the US, I do think you can get to that type of price level. And you get there almost entirely just by the interest rate hikes that we're expecting in the US and the loan growth. We think with JP Morgan, though, there's a very attractive long-term story there. They are investing very heavily in terms of expanding their franchise in the US. They're also investing quite heavily in parts of Europe as well. They obviously have their consumer offering in the UK. They're building out their middle market offering in parts of continental Europe. So we do think that over the next 3 to 5 years, there's considerable upside as some of those investments actually start to bear fruit.
Mm-hmm. Wonderful. Richard, what a great pleasure to have you on TV today. Richard Ramsden, their Managing Director and Head of U.S. Financial Institutions Research at Goldman Sachs from their European Financials Conference in Rome. Now let's get straight to the Bloomberg First Word News. Here's Alice Atkins. Hi, Alice.
Morning, Francine. Shanghai is to lock down part of the city on Saturday morning to conduct mass COVID testing, its first major movement restriction since it exited a 2-month shutdown at the start of this month. The plan is to seal the Minhang district of some 2.7 million people only for the morning, but residents face the risk of being confined to their homes for another 2 weeks if any COVID infections are discovered. European gas prices have gained this morning after a fire broke out at a Texas export terminal. The incident threatens to leave gas supply stranded in the domestic American market despite strong overseas demand. Owner Freeport LNG says the blaze has been brought under control and there were no injuries. The facility is one of 7 terminals that exports US natural gas by sea. Ukraine's President Volodymyr Zelensky says the ongoing battle in the city of Severodonetsk is among the most critical in the entire war. Russian troops have been trying to seize the city, which has lost 85% of its population for weeks. Zelensky says the fight could determine the fate of the whole Donbass region. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francine.
Thank you so much, Alice. Now, coming up, demand for homes in the UK falls, signaling that rising interest rates and the cost of living crisis are taking a toll on the property market. We have more on that story next, and this is Bloomberg.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the Open. We are 55 minutes now into the European trading day. Losses across European equities of 0.7% on this ECB day, but it's focused on the UK for now. Demand for UK homes falling for the first time since August last month, in an early sign that rising interest rates and the cost of living crisis are now taking a toll on the property market. According to RICS, the Royal Institution of Chartered Surveyors, the housing market is now at a turning point here in the UK, with estate agents claiming that buyers are, quote, tightening their belts. Joining us now is our EMEA economics and government correspondent, Lizzie Burden. Lizzie, how realistic are these warnings then? Are we getting this downturn in property prices across the UK?
Well, we keep having warnings, don't we, from Bank of England policymakers past and present about this slowdown. When's it going to come? You saw Deputy Governor John Cunliffe last week saying that he was already seeing straws in the wind showing the slowdowns coming, so the RICS survey might be one of them. It's because you've got rising inflation, rising interest rates. The Bank of England's expected to hike again on Thursday. But Boris Johnson's speaking this afternoon. He's expected to announce more ways to help people save for deposits, access mortgage finance. Clearly, he's trying to show that he's sticking to the agenda despite nearly being deposed on Monday. But these are demand-side interventions, so you have to ask whether they're just going to stoke house price growth even further. But really, surely that would help, given that more than half of British households are homeowners. And I mean, help the government politically.
Yeah, politically. I mean, certainly he has to do something. I guess it's his first big policy since that narrow win on Monday. Lizzie, thanks so much. Lizzie Burden. Also, thank you to Tom McKenzie, who taught me how to say Lancashire. Lancashire. Do I sound British?
Although I said Arkansas once, which our American colleagues will not let me live down.
Me neither. Now that I know that.
Terrible. Never say that live on air. The markets across Europe, you're looking at losses 0.7%. Future stateside S&P E-minis are flat, range-bound. Futures on the Nasdaq, similar territory. Stay with us. Surveillance Early Edition up next. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement? to help reduce the emissions from these well-stocked maritime behemoths.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
What's true in the United States is true in every country. Trickle-down economics does not work.
We do need to continue with investment, and that will take a bit of time. It'll take more time.
Innovation solves problems. We had a lot of problems through the coronavirus. Innovation solves problems. We were rewarded accordingly.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Thursday, the 9th of June. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Countdown to liftoff, the ECB will pave the way for its first rate hike in over a decade as it seeks to tame record inflation, and we're live in Amsterdam. Silence fuels the speculation. State Street slides after refusing to comment on a report that it made by Credit Suisse. The chief executive, Gottstein, will speak at 10 a.m. UK time. Plus, stay tuned for this hour. We'll be joined by Nanette Heschler-Feiderb and Frédéric Ducrozet to talk ECB. Plus, the former UK Chancellor, Philip Hammond, and Tate & Lyle's chief executive, Nick Hampton, will all discuss British politics and inflation. If you have any questions for any of our guests, write into IB Plus TV Go. Now, first thing is first, to always check on the markets. And actually, we're seeing a little bit of anxiousness out there when it comes to markets. I think we have a cross-board asset check. But first, let's start with some of the maps. The FTSE, the CAC 40, the FTSE MIB over in Italy, and the DAX down between 0.6 and 0.8%. Of course, the pressure is still markets trying to figure out monetary policy normalization, what that means for inflation, therefore what it means for risky assets. And then the other thing we're looking out for is, of course, China. We did have some encouraging data to say that exports are rising as they get out of lockdown, but then certain parts of certain cities will also be closed on Saturday for testing, and so a little bit of a wait-and-see situation over in China. Now, armed with new forecasts and with prices rising at a record pace, ECB President Christine Lagarde and her colleagues look set to end trillions of euros of asset purchases. They're expected to lay a path to exiting 8 years of negative interest rates at today's monetary policy meeting. Well, we spoke to the ECB president 2 weeks ago in Davos. She said the bank is not acting reactively.
We are not in a panic mode. And we've started that journey, thinking about it very carefully, back in December, with steps along the way. And we are now at a stage where there is every certainty that we will stop net asset purchases very early in July.
Let's get more now on this with our Europe correspondent, Maria Tadeo, who's in Amsterdam for that meeting. Maria, there's a sequencing. The ECB clearly put out exactly what they want to do, but then the market, and certainly it's priced into the money markets, they're expecting a 50 basis point hike, possibly in July and then September. Will Christine Lagarde push back against that?
Yes, she did. And Francine, I remember that interview, of course, that you did in Davos, that big exclusive in which she told you repeatedly, we're not in a panic mode, we're not behind the curve, and she really defended the actions of the ECB. But if you look at the market, and a number of calls now increasing, I should say, a number of calls from a number of major banks now do say that the European Central Bank does look behind the curve and is going to have to be more aggressive in July. So to me, the focus today, knowing, of course, that she will finally make it official, asset purchases will come to an end in the next few weeks, weeks. And of course, that now opens the way for the first rate hike. The debate is she going to stick with that 25% basis points narrative? We have a hold on this, or actually now hint at a more hawkish stance from the European Central Bank. Of course, very much tied to this, Francine, is the language around the fragmentation and potentially the spillover from this normalization. The more you rate or increase rates, you could see that volatility feed into the bond market. We've been seeing it lately with BTPs. Is she going to give a clear signal now that the European Central Bank is ready to provide some buffer to that for that central bank and potentially tailor policy for 19 different economies? So I think a lot of this will depend on the language around the rate path that we go from here. Is it more hawkish or not? And then two, the fragmentation that really is a buzzword in markets today.
Yeah, and that, of course, is something that she'll have to navigate during the press conference, Maria.
Yeah, and you know, Francine, it's always difficult, and we always say this. I get the impression we always focus more on the press conference than, in fact, the statement itself. But the language today will be key, whether she can match the expectations of the market, whether she can be in tune with what's already priced in, but also give clear signals on those two very important topics. Are we heading for 25, now maybe open to 50, but also two, what happens if we start seeing persistent jitters in the bond market, particularly, of course, in the periphery?
Maria, thanks so much. Our Europe correspondent, Maria Tadeo, there in Amsterdam, where the ECB meeting is today. Now let's bring in Nanette Hechler-Feiderb, Chief Investment Officer, International Wealth Management and Global Head of Economic Research at Credit Suisse. Nanette, thank you for joining us. So much is being priced in on what the ECB can do in terms of aggressiveness. Do you think the hawks have taken hold at the Governing Council?
Well, it's a close call. Our base case is that the ECB is going to stick to those 25 basis points paths that they have laid out. But today we are going to very carefully look at the verbal guidance, in particular whether they're going to drop their sentence that interest rate hikes will be gradual. So that will be a cue for us onto what to expect for July. We will also pay a lot of attention to the long-term inflation expectations. If they are around 2.3 to 2.4% as opposed to closer to 2%, then this is a hawkish cue as well. And as you also pointed out, the fragmentation tool and more on that may be actually also an indication that they're preparing to front load some of those future interest rate hikes into July. So today, very important to look at the verbal guidance.
So, and the verbal guidance, I think, is probably what makes a lot of institutional investors, a lot of governments in Europe very nervous about what she could say on fragmentation. If we don't have some kind of support for your periphery bond yields, what does it mean for markets?
For sure, when to expect a faster interest rate hike path, then also this is likely to feed into credit spreads. And so markets are going to react to that, whether there is a mitigation tool that is going to be implemented in order to contain some of those spillovers into the credit market.
Yeah, and I mean, really, for me, the chart of the day, and then I'll ask you about treasuries at 3%, is really the spread between Italy and Spain and what, of course, that means going forward. Where do you find value? Where do you find bargains in Europe right now?
I mean, beyond Europe, I have to say just simply the higher yield environment that we are seeing in global bonds now across the board, starting in the US with, back to 3% in 10-year nominals. For government bonds, but also in Europe now, much faster increase in bond yields. All of that is giving us actually, just a better even base to look at many segments of fixed income. So I have to say, have been of the view that in emerging market, hard currency bonds, if you're asking me concretely, where do I see opportunities that are arising thanks to benchmark yields that are higher? It is in these areas. There we already see some very attractive yields in our view, but also I think there is now the case to be more neutral rather than underweight in government bonds as well, just simply because of the higher yield level that we are seeing.
Nanette, I mean, there has been a pretty dramatic shift in markets overall as how they're pricing risk around the world. Do you think worldwide there still needs to be more correction to price in possible recessions, to price in this, possible stagflation environment for longer?
Really, I mean, the way I've been thinking about markets is in a sequence of things. The market so far has really repriced interest rate levels, and especially what equities have done. And those equities that are particularly sensitive to interest rates, in my view, has been really reconfirming that interpretation of what has happened on the market. The next phase is going to be on how the market is anticipating now the effects of tighter monetary conditions, higher interest rates on the economy. The UK, whether it's in the housing market, whether it's on private consumption, whether it's altogether on GDP expectations, a very good example in case. And that's going to be the second phase that markets will be looking at. So cyclical sectors will probably have to be reassessed against the expectation that economies are going to get cooled over time. It brings us back to watching quality earnings, to watching companies that have good pricing power, to watching where there is value also in the valuations. At the moment, we think, for example, there is a very good case to be made for China equities. But over time, there will be other opportunities arising.
Nanette, what are you expecting actually Treasury yields to do? And again, has the fallout of Treasury yields at 3% and above been already hitting the markets?
Oh, I think those yields in 10-year U.S. Treasuries are probably going to continue rising a little bit, but at a much slower pace and really not in the same magnitude as before. So just concretely over the next 12 months, I could see very well the 3.4, 3.5% type of level there for 10-year nominal U.S. Treasury yields. But what it tells you already is that at those higher levels where we are now and with much slower further increases, just total returns on U.S. Treasuries are going not to look as bad anymore as a few months ago. So I do expect that a number of investors are going to see this push above the 3% level that we are starting now as also a possibility to rebalance their allocations a little bit, a bit more in favor of fixed income as before.
Nanette, thank you so much. As always, Nanette Hechler-Feider, the Chief Investment Officer, International Wealth Management, and Global Head of Economic Research at Credit Suisse, joining us this morning. Now, coming up on the program, we'll continue the conversation on the ECB with Frédéric Ducrozet. He's Head of Macroeconomic Research at Pictet Wealth Management. And then a little bit later on, we'll also be joined by the former UK Chancellor, Philip Hammond, to discuss the UK economy and what next for a divided Conservative Party. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now let's discuss more on the ECB with Frédéric Ducrozet, Head of Macroeconomic Research at Pictet Wealth Management. First off, Frédéric, congratulations on the promotion, but also you're one of the smartest thinkers on the ECB. So don't, always never forget the ECB in all of your research. What are you expecting for Madame Lagarde to actually position what they'll do in July and beyond?
Yeah, it's all about guidance today. It's been 8 years since essentially the start of QE, when Mario Draghi in Amsterdam 8 years ago announced and paved the way for QE. And now we're here back in Amsterdam with the Governing Council announcing the end of net asset purchases. So that's a given. What we will be all watching in the statement and during the press conference is the verbal guidance for the pace of policy normalization. The thing, I think the difficulty today in terms of communication for Christine Lagarde is that just a few weeks ago, on the 23rd of May, she did lay out the path for normalization with a rather gradual pace of 25 basis point hikes. So we all appreciate the case now for a faster pace of normalization, including 50 basis point hikes. It's difficult for her to completely switch from this gradualism to something much more aggressive. That's, I think, the most difficult challenge today.
So, Frédéric, how do you think she'll actually position that? And what are you expecting of the ECB? Because, I guess things could then turn if we're looking at peak inflation now.
I don't think they will pre-commit to the exact size of timing and pace of hikes as of today. I think the statement will be opened to potentially a faster pace of normalization should they see a further deterioration in the inflation outlook. The staff projection will be very important. I think it will be the first time ever that the ECB staff will project long-term inflation above 2%. That in itself is obviously a strong case for, a swift exit, at least from negative rates. And then again, we have a couple of data that will be very important before the next meeting on the 21st of July, which is the next HICP print, inflation and core inflation in particular. If we see a further increase, I think this will potentially tip the balance, and inflation expectations. And the survey of professional forecasters from the ECB in particular, that may also be potentially the ultimate piece of evidence that the ECB will seek to collect before they make a decision. But in my view, it's a very close call. I would say that on the margins, a 50 basis point hike is more likely for September than in July. Let's not forget that July is also a bit tough in terms of liquidity conditions for BTP spreads in particular.
Frédéric, I have to say the history of Amsterdam and ECB with that 2014 speech of Mario Draghi talking about contingencies is not lost on anyone. Will Madame Lagarde think of that and find and forge her way forward?
As she said during your interview in Davos, actually, the ECB has been preparing for that, moving from gradualism, flexibility to something also slightly different, which is optionality. Optionality, and she could argue this today, means both ways, looking at risk in either directions, including in terms of hawkish surprises that we've had for several months now. And there is, again, I think, a fundamental case for the ECB to move faster in the first step. But then the difficulty is that they need to come with this slightly change for the first step of the normalization, going back above zero, essentially, and mitigate that, I would say, by a more gradual, cautious tone beyond September, let's say, and moving towards neutral levels. That, to me, is a much more difficult challenge to meet for this.
Frédéric, do you think the ECB should come out with some kind of anti-fragmentation tool today? And is the time sooner the better, or can they wait a couple of weeks and months?
I think they will wait. Really, I wouldn't hold my breath, and I don't think they will get much details about that. The first line of defense is the PEPP reinvestment. We know already. Actually, it's not news from this week's story that reinvestment can be brought forward in time, that can be spread across regions. They can use that as a first tool. But when you look at BTP spreads, they're back below 200 basis points. They have, more importantly, in my view, moved in sync with Euro area IG credit spread. So it means that Italy is still perceived by investors as interest rate risk. Everything has been repriced higher, but not an idiosyncratic credit risk, which is a big difference for the ECB. And I think both the hawks and the doves will be willing to wait constructive ambiguity will prevail or not.
Apart from anti-fragmentation, is there anything else that the ECB can do in place to keep those bonds under control?
I know it's something no one talks about, but there are still TLTROs. There are still liquidity operation. And when you look, the ECB will stop buying bonds in net terms at least. Next year, in the coming years, we have a big question mark in terms of fiscal policy, fiscal rules. Who else can meet this demand for sovereign bonds? Well, the private sector, banks in particular, and liquidity tools have been part of this toolkit from the ECB. We're not talking about this at the moment, but if and when banks start to repay those TLTROs, this will, I think, add to the risk also in terms of demand, lower demand in that case, for sovereign bonds. And that could be also part of the solution. But overall, again, I think they will wait for spreads to move meaningfully higher and wider before they make any decision.
Frédéric, thank you so much. Smart conversations and, of course, research notes. As always, Frédéric Ducrosier, their head of macroeconomic research at Pictet Wealth Management. Now, coming up, who is behind Elon Musk's Twitter offer? Up next, a secretive $5 billion fund that is pledging the third largest amount to Musk's bid. That's coming up next, and this is Bloomberg.
I'm here at the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now, who are the people behind Elon Musk's bid for Twitter? Well, as the bevy of big-name bankers and Silicon Valley mainstays, there's a notable exception. Yes, it is the third largest investor, and he's secretive, the secretive Alexander Tamas, and not that secretive, but as a personality, we don't know much about him. He runs Vi Capital. Its website consists of a little more than one page with no address or contact details, but its assets under management have recently recently ballooned to more than $5 billion. And if he's watching, we would love to interview. But here, with the very latest on this, is our Bloomberg Daybreak Europe anchor, Danny Berger. She tracks all these secretive billionaires. What do we know about him?
Yeah, so to your point, not a lot, which of course is interesting within itself because this is just such not only a huge deal, but a very public deal. So we know that part of his career started out working for tech deals at Goldman. He then went on to work with the Russian-Israeli billionaire Yuri Milner. From there, he eventually founds his own fund. We know it's grown a lot recently, doubling the size from a 2020 statement that said it was around $2 billion. And we know that he's also been cultivating ties with Elon Musk. He has put money into the Boring Co., SpaceX, Neuralink. We also know that one of his interns is actually the son of a key aide to Elon Musk. So he has connections there.
So there's definitely connections. What do we know about the bid? So apparently, Twitter's complying. They're going to give him the data. Like, does Twitter want to be sold now?
Well, it seems like Twitter's doing everything they can to be sold, to get Elon Musk to live up to this contract. There was a report from Washington Post and New York Times saying they've unleashed the fire hose. They're going to give Elon Musk 500 million tweets each day that come out to sort through the data. That is quite the headache to sort through, but, it might make him have to comply with this deal.
Have to comply. What a fun story. Danny Berger, our anchor for Bloomberg Daybreak Europe. Coming up in the week that Boris Johnson narrowly survived the confidence vote, we speak to the former UK Chancellor, Philip Hammond. That interview is next. And this is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
countdown to liftoff, where the ECB will pave the way today for its first rate hike in over a decade as it seeks to tame record inflation. We're live in Amsterdam. Silence fuels the speculation. State Street slides after refusing to comment on a report made by Credit Suisse. The chief executive, Gottstein, will speak at 10 a.m. UK time. Plus, stay tuned. This hour, the former UK Chancellor Philip Hammond and Tate & Lyle chief executive Nick Hampton will discuss British politics and inflation. Any questions for our guests? Write in on IB Plus TV Go. So, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. For our audience on TV and radio, I'm Francine Lacqua here in London. Now, Boris Johnson will promise to reform the UK housing market today as he attempts to heal his fractured Conservative Party in his first big policy speech since narrowly winning a vote on his leadership. Well, we're delighted now to be joined by Philip Hammond, Lord Hammond, former UK Chancellor of the Exchequer. What a week to speak to you, Lord Hammond. I mean, I feel like everything's happened all at once. Can Boris Johnson survive this for the next year? Will he still be Prime Minister in 2023?
Well, I can't say whether he'll be Prime Minister going into 2023, but I don't think that he will lead the party into the next general election. I think a rebellion on this scale is very difficult to survive, and I think he'll find that his authority in the party ebbs away over the next few months.
Does he realise, and will it change the policies that he'll put in place?
I don't know whether he realises, but I know that Boris Johnson's instinct now will be to reach for popular policies, do the populist thing, and try to offer people what in the short term they think they want. Unfortunately, we're at a point in our economic cycle where what we need is a dose of realism. We have some challenges in this country to face. The sooner we get to grips with them and face them honestly and openly, the quicker we'll get out of them and the better chance we've got of resuming a strong growth path and rebuilding living standards.
So 40% of his own MPs in the Conservative Party voted against him. Why are they against him? I mean, this is not necessarily about Partygate.
No, I think it's deeper than that. I think it's, to be honest, my colleagues are very focused once you get to the tipping point in a parliament, the second half of a parliament heading towards the next general election, very focused on the question of whether we can win the next election, whether they can hold on to their seats and their jobs. And I think the verdict is that Boris Johnson is no longer, on balance, a vote winner for the Conservative Party. He's potentially a vote loser. And I think the message is seeping through that the party needs to change direction, and for anybody taking over the leadership of the party to be able to rebuild trust with the British people is going to take some time. It's no good doing this 6-9 months before a general election. It's going to have to be done sooner rather than later.
Why do they think he's a vote loser?
The evidence around them, the polling evidence, and we'll see evidence in by-elections over the coming weeks.
Do you think he should resign?
Well, it's a bit academic, really. That isn't in the nature of Prime Ministers, and I'm not at all surprised that the Prime Minister's position is that he's won the vote, and even if he'd won it by a single vote, he will soldier on. That was also Theresa May's position after she won a confidence vote in 2018, but the writing was on the wall from that point onwards. Authority just quietly drains away. It doesn't happen overnight. It's a cumulative effect, and I think we'll see a drip feed of, unfortunately, bad news around the UK economy over the coming months that is going to make it much, much more difficult for the Prime Minister.
But can you draw real parallels between Theresa May and what's happening to Boris Johnson? Or because the personalities are so widely different, Boris Johnson will also deal with it differently?
He will deal with it differently, but I think the other big difference is that, of course, Theresa May had no overall majority in Parliament and was therefore immediately vulnerable to defeats in Parliament. Boris is much less vulnerable to defeats in Parliament because of the size of the Conservative majority, although clearly if even a half of the people who voted against him on Monday were to vote against the Tory whip in the Commons, the government would be badly defeated. But that's probably not the way it's going to happen. I think this is probably going to be about a slow attrition of authority over the course of the summer and into the autumn.
So, Lord Hammond, talk to me a little bit about how it works in your Conservative Party. Are there, behind-the-scenes conversations now about who could replace him? Are they coalescing behind a candidate, or is it still all out in the open?
Well, I don't think they are coalescing behind a candidate, and that, of course, is part of the problem for the rebels and part of the good fortune of the Prime Minister that there is not an obvious successor. Wind the clock back 6 months and Rishi Sunak looked like the obvious inheritor, building a very strong position, but he has been damaged by the, perhaps unfairly, but he has nonetheless been damaged by the issues around his wife's tax status. And I think just by, you know, at a time of cost of living crisis, people being reminded that he comes from a very different set of circumstances from most of them. So I think, you know, most of my former colleagues in Parliament do not regard Rishi Sunak as being the likely front runner in an early competition. If it goes long, he may have a chance to rebuild his position.
So who is the front runner? I mean, we hear about Jeremy Hunt, Liz Truss.
Yeah, well, all of these people will definitely be runners in the race, and you know, Nadeem Zahawi, Tom Tugendhat, people who are spoken about very often among colleagues. I mean, they all have strengths, they all have weaknesses as well, and there will be a lot of jockeying for position over the coming weeks. The exquisite dilemma for cabinet ministers now is how to position themselves. Nobody who's in the cabinet wants to immediately put themselves offside with the Prime Minister, but every single one of them, however strongly they're professing their undying loyalty, is privately thinking about when is the moment to make their move to distance themselves from the Prime Minister if he's ultimately going down, and positioning themselves either to be a runner or at least to have a role in the cabinet of a future leader.
But this is extremely difficult because, you know, as opposed to your boss, Theresa May, it seems like Boris Johnson will not tolerate any dissent.
So that is another big difference. Theresa's response to the vote of confidence was to try and build a broader coalition, to try and reach out to people within the party who she thought were at least amenable to reason, and to try to be conciliatory. Boris, I think, will take the opposite approach. Certainly my experience with Boris was that he takes a very extreme view of anyone who challenges him personally. And if he can find out who the 148 are, I'm certain that their prospects will be very limited over the remaining period of his tenure in office.
How many of the 148 you think also voted against him because of what's happening in tax and the fact that, I mean, I was told in a private conversation by a big, large party donor that this is not a Conservative government just because of the tax increases?
So there is definitely a mood among a lot of traditional Conservatives that this is the government's policies are not truly Conservative policies, that it's far more interventionist, far more big government than they would like to see, far higher taxing government than they would like to see. But of course what the Prime Minister is trying to do is manage the coalition that he built in 2019, which was never going to be a sustainable coalition. On the one hand, traditional Conservatives who want to see smaller government, lower taxes. On the other hand, the new Tories, if you like, in the red wall seats, who've been promised lots of spending on infrastructure and levelling up, who've implicitly been promised higher wages for themselves. They want to see a bigger, more activist government spending more money and taxing more, so long as it's taxing somebody else more. Of course, nobody's in favour of more tax if it falls on themselves. But there's definitely a constituency out there that the Prime Minister does have to think about, who would like to see more taxes on other people in order to fund their priorities.
And then where's Labour in all of this? So should they be doing better?
They certainly should.
So why aren't they?
So the other great advantage Boris Johnson has is frankly a very poor exploitation by the Labour Party of his difficulties over the last months. It really is, or has been, an open goal, and they failed to kick the ball into it.
All right, Lord Hammond, thanks so much. Former UK Chancellor of the Exchequer. He actually stays with us, and we'll talk about crypto next. Cryptocurrencies with former UK Chancellor Philip Hammond. That's next, and this is Bloomberg.
会开春的时候，为各国运动员和随队官员提供热情周到的服务。
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. European gas prices have gained this morning after a fire broke out at a Texas export terminal. The incident threatens to leave gas supplies stranded in the domestic American market despite strong overseas demand. Owner Freeport LNG says the blaze has been brought under control and there were no injuries. The facility is one of 7 terminals that exports U.S. natural gas by sea. Apple is to handle its own lending for a new buy now, pay later offering. A wholly owned subsidiary will oversee credit checks and make decisions on loans for the servers, which is called Apple Pay Later. The move sidestep partners and the tech giant pushes deeper into financial services. Uber CEO says the company is recession restrained. In an interview at the Bloomberg Technology Summit, Dara Khosrowshahi said spending on services has remained robust and the ride-hailers' supply of drivers is up almost 80% on a year ago. He also said he doesn't see any need for job cuts.
We don't think they're necessary at all. However, with the uncertain environment out there, we should be more cautious. You know, there's much more uncertainty as you look forward 6 to 12 months. And my message to our employee base is, we're going to be careful. We feel really good about the business and the trends, but let's not get carried away.
And that's your Bloomberg Business Flash. Francine.
Yeah, thank you so much. Now, I want to go back to UK politics with Lord Hammond, former Chancellor of the Exchequer, and then we'll talk about crypto because he did also join an asset trading company, Copper, last year. Lord Hammond, let's just go back to something that you told me in the break, which I find fascinating. So there was a vote with 148 rebels from Conservative MPs on Monday. You were telling me that if this vote happened yesterday, he would have lost it. Why?
If the vote was run again yesterday, I think there would have been significantly more people voting against him. I suspect that on Monday, everybody was surprised by the outturn. Many of my former colleagues would have voted for the Prime Minister with heavy heart, expecting him to win, not wanting to break cover at this stage. Knowing what they now know, that there are 148 rebels solidly against him, I think if the vote were rerun, there would be certainly more than 148, possibly as many as 180 that would vote against him.
I mean, is it possible for him to even survive the summer, given what you think?
Well, I think it's going to be very difficult. As I've said, it's pernicious. Authority drains away once you get into this kind of position.
I also want to talk about cryptocurrencies because, of course, you joined the London-based digital asset trading company Copper last year, and you basically say that the UK has fallen behind other European hubs or in the European Union in setting clear regulation on the burgeoning crypto industry. So you want, Lord Hammond, the UK to become a global leader in digital asset technology. First of all, are we confusing stable coins, Bitcoin, and some digital assets that could be useful? Like what's good and what's not?
So, first of all, Copper, the company that I'm involved with, is only involved in institutional trading. It doesn't deal with retail customers at all. And I'm agnostic on coins and the trading of coins. What interests me is building the underlying infrastructure, the distributed ledger technology-enabled infrastructure that will power the financial services of the future. Now, at the moment, that infrastructure is being used to trade digital assets because they're the only products capable of being traded. But we're moving very rapidly towards an era when traditional financial assets will be tokenized and will be traded over the same platforms. And the jurisdiction which has built that infrastructure most effectively will have a massive first mover advantage.
And that's not the UK.
I want that to be London.
But is it already too late?
Well, I don't think it's too late, but we're really up against it. Look, I wasn't, as you know, a great fan of leaving the European Union, but we made that decision. We've left the European Union. And the big challenge for the UK, one of the big challenges for the UK now, is how we maintain our role, our dominance in financial services in the post-Brexit world, where we will not have, as of right, access to European Union markets. And one of the obvious ways to do that is to do what we've done in the past, is to embrace new technology quickly and effectively, use the agility of our regulators as an unfair advantage, if you like, and be a first mover. And we have not done that with crypto, and it's a great disappointment to me.
So why? Do you think because they're scared to regulate it, because they don't have the right staff to regulate it, because it's still quite complicated and open?
So it is complex. I think there are two big reasons. One is that in the public's mind, the whole debate around crypto is mixed up with perceptions about the use of crypto assets in money laundering and organised crime and so on, and the underlying value of building this digital infrastructure has not really been conveyed. And secondly, I think the regulators have been under incredible pressure. I mean, the UK regulators have had to deal with the consequences of Brexit, the temporary permissions regimes, inward and outward, that they've been managing. They've had an enormous amount to do over the last couple of years, and I think they've struggled, frankly, to recruit and retain the right people and to provide the bandwidth to address the digital opportunity.
Philip Hammond, as always, thank you so much for joining us. He's, of course, Lord Hammond, the former UK Chancellor of the Exchequer, joining us this morning. And you can hear more from Philip on crypto in the next episode of Bloomberg's In the City podcast. Actually, this week's podcast is really quite cool. It's on food in London, and the next week will be on crypto. Now, coming up, a sweet beat for Tate & Lyle. See what we've done there. Its full-year net income comes in better than estimates. We'll dive into the results with the company's Chief Executive Officer, Nick Hampton. That's coming up next, and this is Bloomberg.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
get your
This
news.
is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, China, we understand, is considering reviving Jack Ma's anti-PO as crackdown eases. Yesterday, we had a number, of course, of gaming companies, but also financial companies benefiting from an understanding that actually China is easing some of the restrictions that we saw in the last couple of years when it comes to cracking down. So we'll have, of course, a very close eye on that, and we'll keep an eye on also Alibaba gaining 4%, turning positive in U.S. pre-market trade. Now, on to Tate & Lyle, reporting better than expected earnings. Full year net income came in at £236 million, down nearly 7% year on year. For the coming year, the UK-based food and beverage ingredient maker sees its revenue growing further. Now, we're joined by Tate & Lyle's Chief Executive Officer, Nick Hampton. Nick, thank you so much for joining us. Now, of course, a reminder to everyone, you no longer do the sugars. It's the sweeteners. It's things that people want, especially when we're calorie counting or trying to be more healthy. Talk to me about inflation. How much is the refining process, but also the inflation pressure on you, and are you able to pass it on to consumers?
So, I mean, clearly inflation is a significant factor, as it was last year, by the way. And, you know, the way we're dealing with that is through significant productivity. So last year we hit a $150 million productivity target 2 years ahead of target. Cost control, so being disciplined in the business, and where necessary, passing through pricing to customers. Now, for us, although the functionality of our ingredients is really important to our customers' products, it's actually a relatively small part of the overall cost of the product, and therefore the impact on consumers is pretty small compared to some other raw materials that go into food products. So that helps us with pricing.
But in terms of some of the raw materials, you're, for example, very exposed to corn because of the shortages from either drought or also what's happening in Ukraine. I imagine it's much more difficult not only to source, but also to get it to where you need it to be.
So we're working hard to maintain security of supply. We've got forward cover on our key raw materials, corn, etc., for the next 6 months or so. And we're fortunate that we don't source anything out of Ukraine or Russia. But as you say, it's a dynamic environment. So we're having to work hard to keep the factories running and keep our customers served. Not really significantly different to what we saw through the pandemic, and we did it successfully then. But it's a continual focus for our team on a daily basis to make sure we've got security of supply and we can keep moving products, because transport's in short supply as well.
So where do you see the biggest pain points will be in soft commodities, and when will we get back to a more normal scenario?
Well, it's no doubt that the challenge is greater in Europe than it is in the rest of the world because of the terrible situation in Ukraine. In terms of forward view of inflation, we're planning for continued inflation for the foreseeable future. So, you know, we're managing our business assuming inflation will continue, and it's very difficult to predict precisely how long that's going to go on because things are evolving so rapidly at the moment.
How are prices, you know, of the sweeteners compared to the sugar? And if they're higher, does it mean that because of these price pressures and, you know, global recessionary concerns, that certain companies are reluctant to do the switch?
So we're not seeing any slowdown in demand for what we do. You know, our new products, which is where a lot of that shift comes from, grew by 35% last year. And the other thing we focus on when we see a recessionary environment coming is helping our customers, you know, if you like, value engineer products. So there's a way of reducing the cost of products by simplifying formulations. And through the pandemic, we saw that as well. And we successfully grew. So we have to balance our innovation efforts to focus on both and support our customers in both areas. So creating healthier products, but also making them more value-oriented for consumers.
So where's the biggest demand coming from in terms of products, but also regions?
So encouragingly, last year, we saw double-digit growth across all of our regions. You know, we saw good recovery in North America and Europe as we came out of the pandemic, and the faster-growing markets in growth markets grew very well. In terms of products, we're seeing, you know, very strong demand for sweeteners, you know, especially our stevia business, which over doubled last year. We're seeing very strong demand for dietary fibers as consumers become increasingly conscious about the need for extra fibers in their diet. And, you know, as part of that drive. We just announced today the completion of an acquisition in China of a dietary fibres business, which exposes us not just more to dietary fibres, which is growing, but also to China, which is clearly a big growth market for us for the future.
Nick Hampton, thank you so much for joining us, the Chief Executive there of Tate and Lyle. Well, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kaylee Lyons in New York, Anna Edwards in London. Happy Thursday, ECB Day. We'll see whether they discuss and deal with European fragmentation. This is Bloomberg.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dinings, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali, masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We've settled into a little bit of fatigue.
This market has obviously posed some unique challenges.
There is more and more evidence building that maybe we are starting to see peak inflation.
The global economy is paying a very hefty price for the war that Russia is leading into Ukraine.
It's time to sit and watch and wait. And essentially, that's the position that the ECB and the Bank of Japan have taken.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kaylee Lyons.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Thursday, June 9th. Our top stories today. The ECB's set to pave the way for its first interest rate hike in more than a decade. It's expected to announce an imminent end to large-scale asset purchases later today. President Biden calls inflation the bane of the U.S. ARK investment chief Cathie Wood, though, says the huge inventories held by American companies suggest that inflation will die down. And Credit Suisse is tapping the brakes on its plan to expand in China. Shares of the bank drop again. State Street says it won't respond to news reports that it's looking to buy the Swiss bank and is focused on other pending acquisitions. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons over in New York, and we're waiting for the ECB. Then, Kaylee, a lot of focus here in Europe on the ECB. European stocks, though, losing a little bit of ground as we work our way toward that important meeting.
Well, and we saw stocks losing some ground in Asia overnight as well, Anna. Broadly, a down day for Asian stocks. We had the MSCI Asia Pacific Index lower by a few tenths of 1%, a drag really created by China with the CSI 300 there down a full percentage point. Now, on the one hand, you did have better trade data, export data for May. The question is what demand is going to look like going forward, as some companies are reporting that orders are dropping as consumers shift from goods to services. And of course, you also had news that Shanghai is going to lock down part of the city over the weekend for testing, so COVID-0 remains a headwind. Of course, the other story we've been following in Asia over the last several days is the weakness of the Japanese yen. Dollar yen went out to a 134 handle yesterday, though the yen is gaining a bit of strength back today. We're at 133.70, but still that is right around the weakest level in 20 years as the Bank of Japan keeps that yield target, wants to keep policy easy at a time when pretty much everyone else is tightening, including the RBNZ in New Zealand. It outlaid its plans for QT overnight. That will begin next month. As a result, you have the 10-year in New Zealand at a 7-year high, up about 9 basis points. Now, one other bit of news that crossed right after the Asian session closed about 10-15 minutes ago is out of China. China regulators reportedly are considering reviving Ant's IPO. Ant, of course, the financial giant controlled by Alibaba's Jack Ma. Alibaba ADRs in pre-market here in the U.S., Matt, up more than 6% on that news.
Yeah, and that's got to be a little bit of positive sentiment for futures this morning. We're seeing gains today. We didn't see gains at the close yesterday. You know, we've had a couple of very twisty days with deep red opens and positive closes, or vice versa. Yesterday, we closed down still more than 1% in the cash trade. So snapping a 2-day decline, a little bit of a bounce maybe, but also positive sentiment from the Alibaba possibility, the potential IPO. You do see investors, though, buying the 10-year yield, buying the 10-year treasuries, pushing the yield down, I should say, but still over 3%, 3.0178 right now. And when we've seen treasuries, the yield over 3%, we've really seen a lot of pressure on equities. So keep in mind that inverse correlation. Right now, NYMEX crude is little changed, but at 121.97, Texas Intermediate is very expensive. And obviously, the global benchmark Brent is trading for a little bit more right now. And Bitcoin, as usual lately, nothing doing. I mean, it's up 1% from midnight, but still at 30,000 and change, 30,465. So continues to be stuck in that range. Anna, you see some red over in Europe.
Yeah, we do see some red here in Europe. So those higher interest rate, those higher debt yields, a factor, higher inflation expectations, higher commodity prices, all that very much in the mix as we wait for the ECB and not really taking our lead from US futures, interestingly. So stuck in a rut here, really, in Europe, down 0.3% in London, 0.4% to moving lower on the Xetra DAX. So we've got weakness here. There is some positivity around some of those energy names, with Brent, yes, falling today, but up with $123 as the handle on the Brent price. That is, of course, relative to history, a high price for oil. So that's the picture on the map. One of the sectors that is not doing quite so well is financial services, and that was weighed down by Credit Suisse. Although we do see that stock just jumping into positive territory, literally just in the last 10 minutes or so. As we said in our headlines, it had been under pressure in the first couple of hours of trade here, as we'd heard those comments from State Street. Well, they didn't want to comment, but they did point towards the fact they were focused on acquisitions elsewhere. EDF, the Electricité de France energy business over in France, is more than 80% owned by the French government. A newspaper in France talking about whether full nationalisation is coming for this business, and the stock is up by 6.5% as a result. This is the one-day move in natural gas prices here in the UK, 23% higher. We've been up by more than 30% earlier on in the session. The European benchmark also up, not by as much, but also moving higher. And this has to do with that explosion at an export facility, an LNG export facility in Texas. As a result, gas being trapped in the United States weighs on US prices, can't get to Europe. That pushes up the European prices at a time when Europe is, of course, increasingly reliant on the US and others as it tries to replace gas flows from Russia. This is euro-yen. We're working our way towards the ECB meeting, Kaylee, of course, and a lot of people will focus on euro-dollar. How hawkish will the ECB be? And, of course, the yen has been really weak of late, even if the yen is actually bouncing a little bit this morning. So I just put in euro-yen as this could be a pair to watch whilst we focus on the ECB and, I was going to say Frankfurt, but they're not in Frankfurt, they're in Amsterdam.
Yep. Changing locations for today, Anna. That is definitely something we will be watching in the day ahead. There's also some other things that we should be paying attention to, including President Biden attending and delivering remarks at the opening plenary of the 9th Summit of the Americas. That's out on the West Coast. Then Boris Johnson will promise to reform the UK housing market in his first big policy speech since narrowly winning a vote on his leadership. And finally, as Anna mentioned, we will be getting that ECB rate decision. That is at 7:45 a.m. New York time. Matt, I cannot wait.
Yeah, paying very close attention, although we don't expect any change to the rate. We should hear about the end of the asset purchase program, or at least winding that down, and then get a clue as to the coming rate hikes in July and September. Of course, they take an August holiday like most civilized people. The ECB then set to announce an imminent end to the APP. We spoke to Christine Lagarde exclusively at Davos last month, where she made it clear she isn't in a rush.
We are not in a panic mode. And we've started that journey, thinking about it very carefully, back in December, with steps along the way. And we are now at a stage where there is every certainty that we will stop net asset purchases very early in July.
Let's get more with our European correspondent, Maria Tadeo, who's been covering the ECB for years in Frankfurt. And thankfully, this time, you're in Amsterdam, Maria.
Yes, Matt, we're in Amsterdam. You have the little boat, you have the canal. Some will say this is the most cliched shot of Amsterdam, but I like to think of it as a tribute to this beautiful city. But, you know, I think location changes, but nonetheless, Matt, the focus is the same. It really is about inflation. As you said there, we're not expecting policy changes today, but this is a press conference that is really worth watching over two things. We're going to get confirmation the asset purchases are coming to an end in the next few weeks, and that, of course, will open now and pave the way for the first rate hike. This is in July. The market is very well priced in on that and well calibrated. The question is, and this to me really is the key point today, is Madame Lagarde going to stay fixed on the 25 basis points, or actually does she signal perhaps a more hawkish tilt now, potentially 50 basis points to come? The other thing to me that's important in this press conference particularly will be the language around fragmentation. The more you normalize policy, the more you take rates higher. You could see that volatility in the bond market. We already see it play out in BTPs. Is she going to talk about fragmentation, the risk of it, particularly, as I say, when you look at the Italian bond market? And is the ECB ready to provide some buffer on that front? And not just as an abstract concept, but perhaps even pointing now to an actual tool that would deal with those spillover effects from the rate path. So I think to me, it's those two things. Do we hover around 25 or 50? And what does she do if we see spreads once again jump in across the euro area?
Maria Tadeo in Amsterdam. Dankjewel. Thank you very much for reporting on the road with the ECB. Now, investor Kathy Wood says the massive inventories now held by US companies suggest that inflation will die down in the US. She spoke exclusively to Bloomberg's Ed Ludlow at the UP Summit.
As I've said many times, we think the greater risk by far is deflation. Deflation cyclically.
But you're talking over a longer time horizon.
I'm talking about now, too, because I think this inventory issue highlights the cyclical reason we've been saying we think inflation will unravel. The secular deflation story is very powerful.
Let's get more on this then with Bloomberg's Danny Berger. Really interesting commentary there. And inventories is something we've been looking at when it comes to US retail, certainly for a while.
Yeah, really fantastic interview by Ed there. Yes, it is something we've been looking at. Of course, it's important to note that Kathy Wood is talking her book to some extent, not perhaps to some extent, to a large extent. She owns a lot of tech. ARK has fallen 50% this year. If we went away from inflation, didn't have these rate hikes or even cuts down the road, that would certainly help her portfolio. But Anna, you're right. This issue of a retailer inventory glut is something that a lot of people have been concerned about. Markets have been concerned about. When we've heard from Walmart, Target, all the likes talking about this this huge buildup of inventory, it's really been enough to spark markets moving lower. Now, BI estimates show that the amount of inventories as a proportion of sales is the highest since data going back to 2007 because these retailers, due to COVID issues, supply chain issues, and demand, put a lot of inventory in their warehouses. So the concern is, if it's building up now, does that mean you have a consumer who's spending less because inflation is biting? Of course, the other possibility is that we're just spending on services. We're not spending on goods as much even anymore. That's why tomorrow's figure of CPI, seeing the breakdown of goods and services and whether services has stayed elevated, is going to be really important, Kaylee.
Absolutely. We're looking forward to that print at 8:30 a.m. New York time tomorrow. Bloomberg's Danny Berger, thank you so much. And while we're talking inflation, we know that it's something that has dogged President Joe Biden for some time. He talked about that last night on a show hosted by Jimmy Kimmel.
Look, inflation is the bane of our existence. Inflation is mostly in food and in gasoline at the pump.
Jack Fitzpatrick, Bloomberg government reporter, joins us now from D.C. The bane of our existence, Jack, pretty strong language, and yet that probably is true for the president and the Democratic Party as we draw closer to the midterms.
Yeah, beyond the economic effects, it's clearly a political bane of the president's existence, and he's made it clear that he understands the amount of blowback coming his way and has talked quite a bit about the limits of his own powers to address inflation in the immediate term. You've heard him talk a lot more about reducing the deficit from the recent highs. I thought it was pretty newsworthy that he specifically said trying to lower prescription drug costs is one thing they can do. That's not an immediate panacea, but that is part of the sort of remnants of the Build Back Better so-called legislative package that may still be alive. Something along the lines of prescription drug costs, changing the tax code, and maybe an environmental and energy portion is what they're still talking about now and then. So that if it's a possibility that the inflation political pressure on the president moves things forward on those issues. Again, that's not an immediate fix to inflation, but it would be quite significant if there's a lot of pressure to take some sort of action to do something on prescription drugs.
Inflation, you know, Reagan said inflation is as violent as a mugger, as frightening as an armed robber, and as deadly as a hitman. But guns are the #1 killer of children in this country these days. President Biden also spoke about gun control on Kimmel. Where do we stand on the negotiations in Congress?
Yeah, you know, it was interesting that Jimmy Kimmel, of all people, a late-night talk show host, did seem pretty determined to press the president and ask some tough questions, and pressed him on why he can't do more through executive orders. Biden pushed back a bit on that and said that his legal abilities are limited, but there are still talks going on in the Senate in particular that look somewhat promising but very limited. They're talking about things like red flag laws, shoring up background checks, especially for people under 21, younger people who may have some things in their background that were expunged. The House actually voted on a more ambitious bill just yesterday and passed it almost exactly along party lines, very little crossover. That got into raising the age on some purchase of most semi-automatic weapons to 21. But again, there were only 5 Republicans who crossed over in the House. It's not the kind of thing that would have a great time in the Senate. So we're still looking to the Senate in the behind-the-scenes talks they're having on something slimmed down, and they are still hopeful that they can come to some very modest proposal that could get 60 votes in the Senate.
All right, Jack, thanks very much. Bloomberg's Jack Fitzpatrick there reporting on the White House facing inflation and gun violence. Now, Credit Suisse is tapping the brakes on its China expansion and postponing its biggest mainland project there. Bloomberg's learned the Swiss lender has delayed the launch of its locally incorporated bank by a year to 2024. This comes amid the real news that we all care about when it comes to Credit Suisse. Is State Street going to buy it or not? State Street didn't want to make a comment. Our global finance correspondent, Shanali Bassick, joins us. So what's the latest with the possibility of Credit Suisse getting taken out?
Well, look no further than State Street's stock price yesterday after this rumor was leaked. The idea that it fell more than 5% in the stock market. A lot of skepticism from sell-side analysts that this is a deal that would make sense sense for State Street, partially given the size, but also because of the business mix and regulatory hurdles that they may face. Now, would a smaller deal make sense? Typically, when we've seen these deals be talked about before, there has been conversations. Think about what happened with Deutsche Bank a couple of years ago. Conversations about not a full-scale takeover, but are there pieces like the asset manager that could be acquired? These rumors have been perennial. I've been here 9 years, and these rumors have existed as long as that. So it's fair to say that there are reasons for skepticism for a deal of this size, but there is a broader question. Is it time? Is now the time with depressed valuations for finally European banking mergers?
Janali, we're just seeing Credit Suisse's CEO, Thomas Gottstein, speaking at a Goldman conference, actually, and he's saying the strategy execution is on track. We'll keep an eye on what else he has to say this morning. Now, on to other news that I know you've been following very closely. SEC Chief Gary Gensler has been laying out his vision for revamping stock market rules. He wants them to be more favorable or more fair, in his view, for retail investors. What's his argument?
Yeah, the landmine here is really the idea of changing payment for order flow, which obviously has been touted as a way to really improve execution for retail traders, leveling the playing field. And he's saying now that the playing field really isn't very level at all. He wants his staff to consider creating an order-by-order auction mechanism. Now, right now, the main way of competing with payment for order flow is internalization. What market participants are really asking the SEC to do is create a lot of disclosure here about the true price improvement for investors. Bloomberg Intelligence's Larry Tabb says the current system allows investors to capture 38, almost 40% of the spread under the current mechanism. So can the SEC's changes really make life better for retail investors? The data still needs to show it.
Okay, Janali, thanks so much. Bloomberg's Janali Basak with the latest on a couple of really interesting news items from the world of finance. Coming up, we'll get back to the European economy. Jens Eisenschmidt joins us. Morgan Stanley chief European economist will put Europe front and centre because of the ECB meeting taking place today. How will they lay the groundwork for a hike in July, and how big will that hike be? Plus, the Lord of Lanai, Oracle billionaire Larry Ellison, is making his Hawaiian island more hospitable to the super rich, apparently, and pushing out families that have been there for generations. Read more on that story by typing NI Big Take into your terminal. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Welcome back to Bloomberg Surveillance Early Edition. Eddie van der Welt of the Bloomberg Markets Live team joins us on set here in London to talk us through his thoughts on markets. And I really want to get your perspective on natural gas this morning then, Eddie. Really interesting dynamics, trapping gas in the US, not able to export it, LNG this is, to Europe. And so UK prices jumped by 25% this morning. Is that the top?
You know what, you talked us very well through the fundamentals earlier and what happened exactly, but I think what you've got to remember is this is a short-term impact in the natural gas market. If you really look at the long-term fundamentals, storage in Europe is filling up extremely fast compared with last year. I think people got a scare last year. They have brought their demand forward. We are seeing winter prices for natural gas in the middle of summer, right? I think what we're seeing some demand destruction later on in the year, and I think we're seeing the rest of the demand being brought forward. Now, I think therefore we see a softer period as we go into the winter. This is probably more bullish coal than anything.
Okay.
Hey, Eddie, yesterday Cathie Wood said we should be more worried about deflation than inflation. Have you heard anyone else saying that?
Not at the moment, right? I mean, the story is all about inflation. It's absolutely going to be on everybody's minds as we go into the ECB meeting today. And I think at the ECB, I think investors are hoping to see that rarest of the rare creatures, an ECB hawk. I think they're going to be a little bit disappointed, though. I think what we're going to see is hawks or doves dressed like hawks, the other way around, actually. But I think what they're going to do is they're going to fake dovish. The market, there's going to be an outrage. They're going to say, we want 50, and the ECB is going to deliver that 50 at the next meeting. But I think in the first instance, the ECB fakes dovish at this meeting.
Okay, lots to watch for then. Eddie, thank you very much. Eddie van der Welt of the Bloomberg Markets Live team. And for more market analysis ahead of the ECB, check out MLIV Go on your terminal. That is the Market Live blog. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Now keeping you up to date with news from around the world, here's the first word. A fire at an LNG plant in Texas will temporarily reduce exports, lowering prices in the U.S. while raising them in Europe. The Freeport LNG export facility will remain closed for at least 3 weeks. Almost a fifth of all overseas shipments of gas from the U.S. went through the terminal last month. A secretive $5 billion fund is one of those helping Elon Musk's bid for Twitter. Vi Capital has committed $700 million to finance the $44 billion deal. Alexander Thomas's firm is the third biggest outside equity investor in the deal. The German national has a history of connecting himself to big-name investors. Coming up, investors are awaiting the ECB decision in just over 2 hours' time. We'll preview that with Jens Eisenschmidt, Morgan Stanley chief European economist. This is Bloomberg.
En nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las mediciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The ECB is set to pave the way for its first interest rate hike in more than a decade. It's expected to announce an imminent end to large-scale asset purchases later today. Officials are trying to tame record inflation while averting further damage to an economy bruised by the war in Ukraine. President Biden calls inflation the bane of the U.S. ARK investment chief Cathie Wood says the huge inventories held by American companies suggest that inflation will die down. And Credit Suisse is tapping the brakes on its plan to expand in China. Shares of the Swiss bank drop again. State Street says it won't respond to news reports that it's looking at buying Credit Suisse and is focused on other pending acquisitions. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. Matt, we've got European equity markets looking a little vulnerable this morning as we wait for the ECB.
Yeah, and U.S. equity indexes finished the day lower yesterday, so maybe what we're seeing today is a little bit of a bounce, although Kaylee brought us the good news, potential good news on Alibaba. When Chinese tech stocks get a little bit of a lift, that makes U.S. futures investors a little bit more optimistic. So maybe that's part of the 0.3% gain that we're seeing here. Not a huge thing, but still green on the screen. Investors are also buying bonds, though, pushing the yield lower right now. It's still over 3%, 3.0197% on the 10-year, and not really a lot of move in the yield, but the level, I think, is notable. The level on crude kind of takes your breath away, right? Texas Intermediate trading for 122.02. Feels like 2008 again. We're actually down right now to that level, so it's pretty amazing, and that has its consequences. That's part of the bane of the U.S. that President Biden was talking about. Bitcoin right now, it's up 1 1/3%, but still holding at 30,582. At some point, I'm just going to take this off the board because, Kaylee, it doesn't really change.
It's been stuck around that level for weeks now, Matt, so it hasn't been all too exciting. Now, as you mentioned, I am following a couple pieces of news out of China that are reflected in the pre-market action in the U.S. this morning. One is actually related to Tesla's factory in China, in Shanghai. It saw production triple in May, producing more than 33,000 cars. So that really shows how production roared back after it struggled with those COVID-related lockdowns. That is lifting Tesla shares in early hours by about 3 percentage points. Now, the other piece of news, and Matt, you hinted at this, relates to China's maybe easing regulatory crackdown. The news that came out earlier, about an hour ago or so, was that China regulators are now reconsidering Ant Group's IPO. Ant, of course, the financial company controlled by Jack Ma of Alibaba. You are seeing that reflected in Alibaba ADRs before the bell. They're up about 3.5%. And in other Chinese technology stocks, U.S. listings as well. Didi is up a little more than 6%, and Baidu getting a little bit of a lift, up about 1.4% before the bell, Anna.
Kaylee, European equity markets then on the back foot this morning, a little bit weaker, down by 0.5%, not really being lifted in terms of sentiment by what we're seeing in U.S. futures this morning. Part of that is weakness in financial services, and Credit Suisse is down again, down 2%. Yesterday, we were talking at this time of day about a weaker share price for Credit Suisse after they produced a profit warning. Then later in the day, of course, there was that speculation in one particular website that was talking about whether we might see a bid coming through from State Street. They didn't want to comment, but pointed to other M&A that they're doing, and so the Credit Suisse share price falls as a result. What is not falling is natural gas prices here in Europe. This is the UK benchmark, up by 22% this morning. It's been up more than 30% earlier on. We saw that fire in the refinery, in the in the export terminal for LNG that Kaylee was referencing earlier on in the program, and that, of course, keeps LNG in the United States, stops it getting to Europe, and pushes up prices here in Europe. And I put in euro yen, Matt, because I know we're going to talk about the ECB next, and some who are watching the FX markets as we work our way towards the ECB's meeting tell me that this could be interesting. There's been a lot of focus on how hawkish, of course, will the ECB be, and also a lot of focus on just how weak the yen has been of late, even if it's actually bouncing a little against the dollar and the euro today.
That used to be Tom Keene's favorite currency pair. I think now it may be Aussie
Let's
dollar.
hope it still is.
I think it might be Aussie dollar yen or CAD yen. Maybe. In any case, very interesting to watch, and it'll be interesting to hear what Christine Lagarde has to say in the meeting today if they don't do anything with rates. They're not expected to. But the debate right now is, do they go 25 or 50? The hawks seem to be gaining a little bit of momentum, and if you look at the charts, the ECB is just almost staggeringly behind what you see at the BOE and the ECB. So very interesting meeting today. Jens Eisenschmidt, Morgan Stanley chief European economist, joins us now. Jens, what do you expect from Christine Lagarde and co., and why aren't they in more of a rush to try and slow the highest inflation ever recorded in the European Union?
Hello, thank you. First of all, thank you for having me here. And indeed, just to sort of highlight, this will be a very important meeting for the ECB. It is the meeting in which they are set to announce the end of their asset purchases. We expect this end to be, in fact, a little bit anticipated to the end of June. So basically, they will be, according to our expectations, saying they will end asset purchases in Q2. And then we expect, as probably many do, and as also the president herself has lined out in a blog post just 2 weeks ago, 25 basis points in July and 25 basis points in September. And here, I think the idea is really to leave behind two of the extraordinary policy measures that are meant for a time, or were designed in a time in which inflation was undershooting consistently their target, to leave them behind. And then I think we are talking about a different setup once we have left these behind.
Okay, so they're wanting to move on and get us to a new phase then, I suppose, Jens. Your focus is on the European economy, and so I wonder, with that in mind, how long is there for hiking for the ECB? Because if they're late to it versus other central banks globally, how long will they have to hike? Because there are a lot of people thinking about when we might see recession in the Eurozone.
Right. No, I think this is a fair question, and I don't think, I mean, we expect no recession at this stage. So our baseline expectation is for 2.6%, which is pretty much what everybody else is expecting, a little bit below maybe. Certainly below what we think the ECB will be today, saying that growth will come in for 22, but that's a very weak growth profile. That's a growth profile that's actually below potential, and in some sense it's adding to slack. So from that front, at least, we don't see additional inflation coming. Now, there are downside risks to that profile. Significant ones, like, you know, the downside risks are well known. This is Ukraine, this is COVID in China, or COVID policies in China, so supply chain issues, plus maybe a less than softish landing in the US for external demand.
Okay, and so we see inflation an issue. Clearly, they want to tackle that, but growth also on their minds. Where does that leave the ECB then in terms of the communication it wants to get across today? Do you think they want to be hawkish, to be seen to be hawkish, or are they happy with where the market is priced at this point?
So my sense is, and that I think sense has crystallized following the communication out of the April meeting, which I think in spirit was a different one, and then in the 2-3 weeks after the April meeting, we have seen lots of comments from governing council member. We have seen lots of interventions also out of the executive board, all agreeing that actually the time has now come to leave these two super loose policy tools behind in a view, or with a view to say we have reached our aim, namely stabilizing inflation more or less at 2%. Maybe they will today say a little bit above 2% over the medium term, which is an important thing. And then a different discussion is what to do afterwards. So I think everybody is happy, that would be my sense, that they are able to exit this super accommodative monetary policy. The thing that unites the two, your question on recession risk or weak economic activity versus inflation, I don't think that's necessarily either or. It's something that over the medium term, what you're interested in is the stability. And the stability essentially you will get also out of, say, a lower economic activity that won't fuel inflation as much.
Okay, Kaylee, jump in.
Yeah, Jens, to that point on kind of the balance between growth and inflation, the euro obviously is not quite as close to parity with the dollar as it was about a month ago, but still at a 107 handle, it's quite weak. Would a hawkish ECB bring a stronger or weaker euro, considering if they're too aggressive, then that is a greater threat to growth in theory?
Right. I think here you have to see that market pricing currently is, from our perspective, pretty hawkish. I mean, just to sort of remind you, our perspective is there will be 3 hikes this year. Then the impeding weakness in growth that will be, in our view, concentrated around the end of the year and the beginning of next will make the ECB stop. Mind you, with 25 basis points, what we currently see as the end in December, they are still very accommodative, and they would be supporting the economy going through a weak patch. And then in September, they would resume hiking. Now, the market pricing is entirely different. Markets are very aggressive, and to the extent that the ECB manages today to be even more aggressive than that, that of course could be, could lead to some movements in the currency pair. But I would rather think, if anything, it will be not a material change to these expectations, because essentially today what we are going to see is maybe the jump to June, what I said before, so basically ending asset purchases in June, and then hinting towards the path that the president already outlined in the blog, without necessarily pre-committing to any of these steps, whether it's 25 or 50.
Okay, Jens, thank you very much for the preview. Jens Eisenschmidt, Morgan Stanley's chief European economist, joining us on set here in London. Now, coming up on the programme, overhaul at the SEC. We'll dive into Gary Gensler's vision for revamping stock market rules next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit Search Go to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Right now, you see, there is not a level playing field amongst the different parts of the markets, the wholesalers, the dark pools, the lit exchanges. It's not clear with such market segmentation and concentration, and yes, with an uneven playing field, that our current national market system is as fair and as competitive as possible for investors.
SEC Chairman Gary Gensler speaking yesterday. The SEC, of course, has previewed sweeping changes to rules underpinning the U.S. stock market, including payment for order flow. Gensler says retail investors deserve a better deal, and it appears to be the agency's most direct response yet to last year's wild trading in so-called meme stocks. Bloomberg opinion columnist Marcus Ashworth joins us now to discuss. So Marcus, he calls it a better deal. If they end up having to actually pay fees for trades rather than getting them for free, potentially with worse execution, how is that a better deal?
Well, I think no one knows what the right answer here, and what Gensler's doing here, which I applaud actually, it's a real sort of tough love, is sort yourselves out. Here's what I'm going to do if you don't get your acts together and come up with something better which works for everyone. Because it's more about suspicion. No one can really put a finger on whether payment for order flow is bad, illegal, unfair. There's a huge suspicion around it that it might be, and in certain circumstances almost certainly is. And it's just, the whole system isn't doing itself any favors, and it needs to clean its act up. But it's sort of, if you want to self-regulate in effect, then come up with much better regulations that suit you and doesn't evidently put the risk of retail trades at some form of unfair advantage, because it's so obvious putting it through market makers rather than direct on the exchanges that there is a lack of visibility what's going on. And I think that's what Gensler wants. More visibility and hopefully not worse costs or indeed execution.
But the key is no one really knows. I mean, if you read Matt Levine's columns, which I think we all really enjoy, it seems like payment for order flow could give retail investors a better deal, but it's not popular, as we saw during the hearings when Ken Griffith and Robinhood were all sort of taken to task, especially by Democrats. Are we seeing a populist move by the head of the SEC? Is that what this is?
Well, I think it is both that and also sort of the right thing to do. Unless the market makers and the big firms, Virtue, Citadel, et cetera, as you listed, they can't prove that they're not doing something which isn't disadvantaging, then they can't, they can't really have a leg to stand on here. So they have to up their game and perhaps show some visibility, which they clearly don't want to, but that doesn't mean they oughtn't to. And I think that's what Gensler's job is he's got a big stick here with a small carrot, and he's trying to help people to take the carrot and help themselves. And I applaud it. Look, as long as he doesn't get it wrong.
Yeah. Really interesting. Well, we'll see what the industry comes up with then, if that's what's playing out here then, Marcus. On another story that I know you've been focused on very closely, Credit Suisse, and of course, will there or won't there be an offer for them? State Street, there was a report yesterday that State Street might be interested. The Credit Suisse CEO declining to comment on State Street rumours, as you might expect. What was your take?
I just think, I mean, how can I say this is complete rubbish without ruling out the possibility I might be wrong? I cannot see why on earth State Street would want to buy Credit Suisse. I can see absolutely why Credit Suisse wouldn't want to be bought out by State Street or indeed the Swiss government allow it. But, they're not two completely different types of organizations. There's no real compatibility. Now, it's possible that elements of Credit Suisse, some of the American operations, asset management possibly, might fit in nicely to an overall State Street, which is a huge organization. But I just can't see it happening. I just don't think cross-border bank mergers in Europe, including Switzerland in Europe here, ever really work. And I can't see why this one makes any commercial sense for either side.
That's interesting. And taking the sector as a whole, a number of guests saying to me that perhaps some of the Basel changes we've seen recently might make them more likely, but we'll bear your thoughts in mind. Marcus, thank you so much for joining us. Bloomberg Opinions, Marcus Ashworth with us to talk about a couple of themes in finance. Coming up on this programme, could deflation be the greater risk? That's the warning from ARK Investment Management CEO Cathy Wood, part of our exclusive interview next. This is Bloomberg.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
However you get your news.
This is Bloomberg Daybreak Middle East.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons in New York and Anna Edwards in London. Now, ARK Investment Management CEO Cathie Wood says that massive inventories now held by U.S. retailers suggest that inflation will die down. In fact, she warned against deflation in an exclusive interview with Bloomberg's Ed Ludlow at the UP Summit in Bentonville, Arkansas.
If you look at our performance, our flagship's performance, from the low in COVID to the peak in February of 21, that was 360% increase. Innovation solves problems. We had a lot of problems through the coronavirus. Innovation solves problems. We were rewarded accordingly. Since then, peak to trough, when we hit our trough, thank goodness we're past it, down 75%. Why? Inflation and interest rates. So there is this, and it's really interesting to be here, Walmart territory, because I think we're learning a lot from the retailers now.
And we're talking about what we learned about inventories.
Inventories,
right.
Yes. The fear of rising interest rates and inflation out of control has gripped the market. And of course, and that's the equity market. If you look at the fixed income market, it does not agree with this.
Yeah.
The 10-year Treasury bond yield is 3%. That instrument should be one of the most responsive to inflation fears, right? So 3%, which suggests GDP growth 3 to 4% during the next 10 years. So it's not being corroborated by the fixed income markets. And I don't think that we are in a period where we can't extricate ourselves from this. In fact, the inventory stories are a very good example of why inflation has become a problem. You know, the scrambling to bring more and more inventory to satisfy demand, stay-at-home demand, went into overdrive, and I believe the narrative in the last year, inflation, gave purchasing managers this idea that, okay, what's the worst that could happen if I build inventories? The worst that could happen is that I'm able to deliver inventory profits, sell at a higher price. Well, that's not going to happen. That's not going to happen. When we see, I've never seen inventory surges like this in my career, and I've been around for a long time. So 33% at Walmart, 42% at Target, 50% at Kohl's. So very broad-based. And so I think we're going to see a lot of discounting. And what's beginning to happen now, just at the margin, and we're seeing it because our strategy is now starting to outperform the rest of the market. I've never been in a market where the market has gone to new highs and we are hitting lows. I've never been in a market. So there's been, and it hasn't been supported by the fixed income market. So we'll see what happens.
Cathie Wood there speaking exclusively with Bloomberg's Ed Ludlow, talking about inventory buildups at retailers, but not in the businesses that she owns, right? Certainly not at Tesla. There's no inventory at car makers, but I guess that wouldn't fit the narrative. Joining us now is Tom Keene, co-anchor of Bloomberg Surveillance. And typically you bring a chart of the day, Tom. I know you in the past have really cared about euro-yen. We're expecting to see or hear something interesting from the ECB today. What are you focused on?
Well, we're going to focus on the ECB. We're going to see the announcement at 7:45 Wall Street time and then on to the press conference. And I must say, this is a different ECB meeting. Am I going to be hanging on every word? No. But there will be times here where Christine Lagarde can really message the compromise she has to strike across a fractured Europe. It's just going to be fascinating to see all in all.
All right, Tom, really looking forward to your breakdown of the decision and the guests you speak with on surveillance later today. Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much. Now, in addition to the ECB, what else are we paying attention to today? I will be watching Chinese ADRs because we got news about an hour ago that China regulators are considering potentially allowing the Ant Group IPO to revive. And this was something market watchers had really been focused on as a sign that the worst of the crackdown is over. Maybe a bottom is in Chinese technology stocks. You're definitely seeing those ADRs getting a lift in pre-market trading this morning, Matt. So definitely something to watch throughout the trading day.
Yeah, I'll be watching banks. You know, we've been talking for years about the possibility of a big European bank M&A. We haven't seen any, but now we're looking at the possibility of State Street buying Credit Suisse. Neither of those banks would comment on the reports in the Swiss blog Parade Plots, but it'll be interesting to see if anything comes of it. Right now, Credit Suisse shares are trading under 7, and the offer was reportedly for 9. Anna?
Yeah, we'll keep watching Credit Suisse then. We've seen the CEO has been commenting just as we've been on air, hasn't he, around various things, but not commenting on the potential for any deal, of course, as we might expect. I'll watch the ECB then. Very much in focus is whether we get any suggestion that 50 is on the table for July or any pushback against that. Also think about fragmentation of bond markets as the PEP plan comes to an end, that bond buying program. What's happening to Italian spreads? How concerned, if at all, is the ECB about that? That's it for Early Edition. Surveillance is next.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
This higher inflation is undermining consumer confidence, and therefore
consumption.
The Fed has to keep hiking 50 basis points until there's some semblance of a demand slowdown, because that's all they've got.
I'd be amazed if the Fed is able to go 50-50-50 at the next few meetings in a straight line without any pushback from markets.
Maybe they can pause and let the high prices naturally bring down demand.
It's perfectly feasible to argue right now that rate cuts are on the table.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Over to you, the ECB, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures positive by 1/3 of 1%. An ECB decision, TK, just around the corner.
Just around the corner. I thought Kit Chuk summed it up nicely here. A nice back and forth of the different trends we're seeing, including what we see in energy. And he just simply said, John, and you know, you and I make jokes, it's a snooze fest. It's not a snooze fest. What will Lagarde do to make us gasp this morning?
Stay awake for this one, Tom. I think they are set to announce the end of QE. We're expecting that, then lay the groundwork, of course, Tom, for a rate hike, and then maybe another one after that. We saw all that in a blog from the ECB president just last month. Tom, for me, the risks around that view and the forecasts we get in the presser, those forecasts could be pretty ugly a little bit later this morning.
And very different than America. I think for those waking up in the United States, Jason Furman laid it out in the Wall Street Journal a few days ago. There's huge differences here across the Atlantic, and we can't just say the Lagarde press conference is like a Powell press conference. It's not.
Optionality, gradualism. Lisa, that's what I'm expected to hear again and again and again in this news conference.
And will that be a dovish surprise for this market that will believe that this ECB is not getting ahead of inflation? Because right now they're actually baking in more than a 25 basis point rate hike for the July meeting. So if the ECB pushes back on that, talks about gradualism, talks about going slowly, does not give any hints of a 50 basis point rate hike at some point this year, what kind of surprise will there be in markets on the long end as people look at inflation possibly getting a little less moored?
Will you stay awake in this one?
I always stay awake. I mean, I'm not the one to be asking about this. I don't call it a snooze fest. I think it's
me that
fascinating.
often struggle with these news conferences.
The history of this, folks, is very important. We're going to stop the show right now. There is a surveillance timeout share. I've spent a fair amount of time in it.
With you.
There I was. I called it a snooze fest, and they said
they were very unhappy over the ECB about that characterization.
I said, yeah, but it was.
It was.
My favorite part is you guys get in the timeout chair, and then you reiterate it and talk about it proudly and talk about how basically they got mad, and it was true, and we're going to fight that battle.
We air that news conference every single meeting. The ECB should be happy. Futures positive, 1/3 of 1% on the S&P. On the Nasdaq, we're up by about 1/3 of 1% as well. Yields look like this on a 10-year, 3.0160%. Yields basically unchanged. And look at this on euro dollar, going absolutely nowhere going into this decision, about an hour and 45 minutes away, Lisa. Euro dollar 107.14.
How much can the ECB surprise? And this goes to Kit Chuk's point, right? How can they say, oh my goodness, and actually move the dial when we already have a serious rate hiking cycle baked into the euro, and the euro is still this week, right? So at what point can the ECB really change that trajectory? So at 7:45 a.m., we do get the ECB rate decision. 8:30 a.m. Eastern time, we get the Christine Lagarde press conference. We have already so much baked in, and this is really what I'm looking at right now. The German two-year yield already up at 0.7%, a sort of shocking reversal after years and years of negative yields. How much can they really push this either higher or keep stasis, given the uncertainty around where inflation is going to come from, and frankly, how it's going to come down in a way that doesn't destroy economic growth? 8:30 a.m. we get U.S. initial jobless claims. Rick Reeder of BlackRock with Jonathan Ferro last week was saying that this was the last solid jobs report, the one that we got on Friday, in a while. He said he could see a negative print over the next 3 to 4 months. How much do we start to see this in the jobless claims, in the filings for unemployment benefits, especially at a time when we see the quits rate, people voluntarily leaving their jobs, rising to some of the highest levels in history? And then at 8 p.m., this is really interesting to me, the prime time hearings for the January 6th insurrection. Why are they doing it in prime time? They're building up expectations, John. And frankly, what can they bring out at this point that's going to meet these expectations? We don't know who's going to be testifying and what they're going after, given the plethora of other issues on the table.
Elisa, thank you. A few things to look for through this morning and through this afternoon as well. Joining us now, Sebastian Page, Chief Investment Officer and Head of Global Multi-Asset at T. Rowe Price. Let's start here, Seb. This line from you. Normally, after a sell-off of this magnitude, we'd be buying stocks. This time, we're not. Sebastian White.
You know, we started the year well positioned for this. We were underweight stocks and underweight bonds, underweight duration. We're contrarians, generally speaking. We tend to lean on valuation opportunities. Right now, we're buying bonds and we've closed our underweight position in treasuries, but we remain on the margin underweight stocks. And the key question, Jonathan, and you talk about this on surveillance quite a bit, is whether inflation will trigger a recession. And there are transmission mechanisms for this through gas prices, through monetary policy. It impacts corporate margins. But that is the key question. And is the next shoe to drop a recession and then earnings and pressures on margins? Look, S&P 4 12-month earnings are up 7% year to date. If you look 12 months forward, that's a high bar to clear. So that is the risk that we're worried about. There's a very narrow path between an inflation problem or a growth problem.
Ben Laidler takes the other side of the coin. He's been an Uber bull since 2018, and he says stay invested. And he also says inflation has peaked. Are you about inflation driving higher, inflation sustaining, or even if inflation peaks, you're cautious?
You know, first of all, I'm going to say this. We don't have a consensus at T. Rowe Price on inflation. I don't think we have.
But that's the history of your firm. Let's make this clear, folks. T. Rowe Price on the buy side invented argument. Continue.
We have. We don't have a house view, but in our asset allocation committee, we debate this inflation question all the time. I would say overall, we probably lean towards, yes, inflation is peaked, but we worry a lot about where are we going to get stuck on the way down. Right? Are we going to get stuck at 4 or 5% year over year with the more structural components of inflation? That could be a problem.
And Lisa, what's really difficult here is I can imagine Roger McNamee back at T. Rowe Price years ago. He leaped across the table and took a swing at somebody. They're arguing about tech.
Well, right now, when I read some of the comments on social media in response to different inflation calls, it's getting pretty heated. Sebastian, as you look forward into how to position, how to buy assets, how much is liquidity a key concern for you, given some of the speculation that we could see some financial market accidents, even in the rates market?
Liquidity isn't an issue until it really is. It's kind of like there's a fire in the building, everyone's trying to get out. And I say this often, but the difference in financial markets is that in order to get out of the building, you need someone to get in. And that applies to holding credit or generally less liquid assets. You need a buyer. So it is a consideration. Look, I want to be clear. We're invested, right? We're invested. We're diversified. We're underweight stocks, but we're not saying investors should not buy or hold any stocks for the long run. But really, the key question is inflation. And if I might say, Lisa, there's something more important to inflation than Fed policy, and maybe I'll get in the timeout chair here, in the surveillance timeout chair for saying that, but that is, to me, pent-up supply. And if you look at the New York Fed index of supply chain pressures, it's not 2 standard deviations, it's 3 standard deviations above its historical long-run average. And you can think of pent-up supply in semiconductors, but it's everywhere. There's pent-up supply of labor, and that's starting to soften. There's pent-up supply for just transportation in general. There's pent-up supply in housing. Houses under construction not yet finished, just very high number. There's pent-up supply in commodities, in energy, and so on and so on. So this is the key question we're debating in our asset allocation committee. Will releasing some of that pent-up supply do part of the Fed's job in bringing inflation down? I think that is the scenario where we get a softish landing. Will pent-up supply releasing do part of the Fed's?
Sebastian, just to jump in, maybe we're already seeing that on the good side with the inventory stories, say, over at Target. I just wonder if the genie's already out of the bottle on the service side, that the psychology of the consumer's already shifted. Just a final point on that, Sebastian. Do you think we're already there?
I don't think we're already there. I think the turning points are always difficult to call, but look at the overall index of supply chain pressures. That's one index. There are many indices. You can use Bloomberg to find data on pent-up supply, but it's still there in housing. It's definitely still there, Jonathan, on energy and on natural gas. So yes, some parts of this pent-up supply are going to start softening over the next few months, and that's going to help with inflation, and that's going to help with, again, doing part of the Fed's job. But we're not out of it yet.
Sebastian Page of T. Rowe Price, thank you, sir. As always, brilliant. Bramo, I think what's not been talked about enough since payrolls last week is that we've seen a few months now of pretty robust jobs growth, really strong jobs growth, yet we haven't seen unemployment come lower or wages accelerate. I just wonder what people start to make of that if we start to see more of those reports.
Some people point to the participation rate ticking up just a bit. And then there are questions about how many people really have so much power in the labor market, also the composition of jobs that actually are coming back into the market. That said, it does seem as though there isn't a wage price spiral, or at least those kinds of concerns that people had a while back, which raises questions about the supply and demand, and frankly, how much more the consumer can actually continue to buy if their wages are not keeping pace with inflation.
Let's keep it on supply, Lisa, and talk about what's happening in China. So, Tom, Shanghai is going to lock down a district in the southwest Saturday morning to conduct what they call a mass testing drive. It's the first movement restriction we've seen in the financial hub, I think, since they started easing things at the start of this month. Tom, the stop-start nature of Chinese lockdowns, that's a problem to make any forecast for the rest of 22, never mind getting out to 23.
I read that story very carefully, John. A real surprise. It is a setback, and again, it is a small district of Shanghai where they're really focused on, but tangentially to that, they're looking at other districts to, quote, re-lock down. That's worth watching, particularly with the optimism of China reopening.
And the build-up we've seen in crude commodity markets off the back of that story, Tom. WTI right now, 121, negative 0.4%. Equity futures positive, 0.33%. Coming up from New York City, an ECB decision just around the corner.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The European Central Bank is expected today to firm up its plans to exit negative interest rates. Officials are likely to end asset purchases in the coming weeks. Plus, they'll probably send another signal that the ECB will join the Fed and others in raising interest rates next month to fight inflation. On Capitol Hill, the House has passed a package of gun legislation that includes raising the minimum age to buy many semi-automatic rifles from 18 to 21. But the move is mostly symbolic. It will ultimately be set aside for whatever compromise plan emerges from negotiations in the Senate. In China, exports rebounded last month. They grew a better than expected 17% in dollar terms as COVID-related bottlenecks on production and logistics cleared up. Still, exporters are reporting a drop in orders. Consumers around the world have started moving their spending to services instead of goods. A fire at a liquefied natural gas plant in Texas will reduce exports for weeks. That will lower prices in the U.S. whilst raising them in Europe. The Freeport LNG export facility will remain closed for at least 3 weeks. Almost a fifth of all overseas shipments of gas from the U.S. went through the terminal last month. And Bloomberg's learned that China may revive Jack Ma's anti-IPO. That's one of the clearest signs yet that Beijing is dialing back a crackdown on the tech industry. It began almost 2 years ago when regulators scuttled the Ant offering, which would have been the biggest listing ever. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special Equality Series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
What's true in the United States is true in every country. Trickle-down economics does not work. By working with close friends who share our values, we can make sure that we are not left vulnerable to unexpected shocks while generating economic opportunity for the people in our region.
President Biden there at the Summit of the Americas from New York City this morning. Good morning. Equity futures look like this going into the ECB later today and onto US CPI tomorrow. Futures positive, 1/3%. Yields going nowhere at 3.02% and euro dollar totally unchanged, Tom. Look at that. Going absolutely nowhere into this decision later this morning. 107.19.
Could you call it a resilient dollar as well? Yen after that move pulls back from a 134 to 133.36. We're watching foreign exchange dynamics off of the press conference that we'll see this afternoon from Amsterdam. Jet Fitzpatrick joins now in Washington. And to those of you in America, it's an Amstel Light. Maria Tadeo's doing the real thing. She's on the Amstel River in Amsterdam in front of the Heritage Museum, and joins us as the ECB discovers heritage today. Maria, this is not Willem Duesenberg's ECB. This is Christine Lagarde's ECB. How is it different now than in its early days?
Yeah, and Tom, you're very right, because this almost feels like it's the end of an era for the ECB. It's the end of Mario Draghi and the whatever it takes. We're now heading into something new. What that looks like, I think that is going to be the challenge today for Christine Lagarde. It's very clear now that we're heading into a liftoff. July, that is well calibrated. The market is fully aware of that. I think to me, there's two things that will be very important today here. Does she stay on the 25 basis points narrative? That was consensus up until a few days ago. Or actually, are we going to see a hawkish hawkish, Christine Lagarde, that potentially opens the door to something that looks like 50 basis points. The other thing to me, and this will be a big test, potentially also a big point of departure from Mario Draghi and the old ECB, is the fragmentation around the euro area. The reason why we're here in Amsterdam is because the European Central Bank does a meeting like this once a year. They like to showcase the diversity of the euro system, 19 different economies, but will the central bank manage to take rates higher, but also tailor policy in a way that it doesn't send the bond market into major jitters, and particularly when it comes to Italy. So I think the word fragmentation will be very, very important in this press conference.
The symbolism is extraordinary as they go to the Netherlands and Belgium with all that heritage. Maria, at what level are they, quote unquote, on the same page in Amsterdam?
Well, look, we're about to see. We know that this meeting, of course, 2 days now was going to be tough, especially as we're already seeing those jitters of that liftoff in July play out. I think when you look at countries like the Netherlands today, we had inflation reported 10%, Tom. That almost quadruples the target that the European Central Bank sets out. I think there's also, when it comes to the diagnosis, a difference between the South and the North. Some say that this is persistent inflation, that the European Central Bank should change the way it looks at inflation. And of course, others would just say this is Ukraine is imported, and of course we should keep an eye on the impact on the European economy. So we're about to find out if the 19 economies are in tune or not. But this is a very difficult job. Whether Christine Lagarde can do it, I mean, that will be the start of her new era at the European Central Bank. But you're very right to say today it does feel like it's the end of something, the start of a new central bank here.
Jack, it's also the end of a low gas price era in the United States, which is part of the issue that we're dealing with inflation. A new record high on gasoline on average cost, now $4.96 a barrel. What do we know about the trip that President Biden may take to Riyadh, to Saudi Arabia, to talk about output?
One thing that we don't know is that it might be particularly important, especially to the Saudis, is whether there would be a meeting or communication with Mohammed bin Salman. Obviously, that would be a key part of any developing change in the relationship with the Biden administration and the Saudis. Looking for more production, obviously, is the broad goal, but the details are a little hard to come by, because when the story broke that this might happen, President Biden pushed back and said there was no plan, nothing concrete. So it may be a question that the White House still needs to ask themselves, is exactly what is the plan in changing or tweaking the relationship with the Saudis.
And how important is it for the United States to continue to supply oil and also gas to Europe, where Maria Tadeo has been traveling around to different spots and hearing the angst of high gas prices? We saw that fire at a shipping center for LNG that lowered the prices in the U.S. because there cannot be the same kinds of exports that perhaps we had been expecting. How important is it from a diplomatic standpoint for the U.S. to continue those exports?
From a diplomatic standpoint, it's important. It has filtered into a broader debate in Congress about what they can do short-term versus long-term to increase those exports, to shore up, maybe even change any policies with the Strategic Petroleum Reserve. Again, that's a bit more of a long-term issue. At its face, that is an important issue, and there's a lot of agreement that the U.S.'s role in exporting oil and gas can be important. The question then turns into, and it's a little bit of a bickering match on Capitol Hill, what policies would need to change and what's the long-term outlook there, and that's where it gets a lot stickier.
Bramo, what do we have to do to get on the Tadeo Euro Tour? How do we figure this out?
Well, it's not just the Tadeo European Tour. Maria, the ECB is also going on a road trip, and you get to follow along. But honestly, I think that we should just do back-to-back clips of hair blowing in your face in different gorgeous European spots. Thank you for the dream.
You'll have a lot of tape. You'll have a lot of tape, I'm sure. You'll have a lot of tape of that, that's for sure. In every different language, I'm sure.
Maria, thank you. As always, Maria Tadeo there of Jack Fitzpatrick as well in DC and in the Netherlands, respectively. I don't think this gets talked about enough. It's not just about energy. in Europe. Christine Lagarde, the ECB president, actually put out a really nice blog. I encourage everyone to read it ahead of this decision. It's not that long. It was put out in early May. And she talked about where inflation prices were going into the pandemic. Less than 20% of the core basket, the core inflation basket, Tom, were accelerating above 2%. That number now is 75%. 75% of the core basket has prices rising more than 2%. It is broad-based, TK. It's a big change for this ECB.
It's a big change for the ECB and, frankly, in America, too. And that's why tomorrow, after the ECB ballet, core inflation analysis is what the pros are watching. Steve Trent, John, at Citigroup, out on what Maria Tadeo's been living, which is revenge travel. Steve Trent saying it continues, it persists, not like it was, but we're still all getting on airplanes. And, of course, Maria came to me and said, price it out at surveillance travel. And I did, John.
How much?
Newark to Naples on the way to Capri. Newark to Capri, 2 business class. That's the only way Tadeo travels. 23,440.
Is that how much it is now?
Yes.
Not much capacity. I think that's the only direct flight, Tom.
Is that what Tom does in his free time? Just looks up different flights, different places?
Basically. To see if he can follow me on vacation later on this year from New York. This is Bloomberg.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Crypto, you have a world of young people
that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Live from New York City this morning. Good morning. Here's your price action this Thursday morning. We're positive 0.6% on the S&P and the Nasdaq 100 up 0.8%. We need to get Julian Emmanuel of Evercore on the phone right now.
Yep.
He downgraded his call from 4,800 to 4,300 base case, but he's got a bear case in there too. Here's the bear case if we get a recession: 2,900 on the S&P 500. TK, 2,900 the bear case over at Evercore.
And what's so critical on this is the granularity that his boss, Ed Hyman, works with. I really want to know what the granularity is that Mr. Hyman sees as it rolls over to the equity strategy of Mr. Emmanuel.
Julian, if you're listening, send me a message on the Bloomberg. Let's make this happen. That's the equity picture. Here's the bond market story: 2s, 10s and 30s. There isn't much of one over the last few days. Really tight trading range. Tuesday, Wednesday, Thursday, just dancing in and around 3% on a 10-year, 3.0141% on a 10-year right now. There's been a big development, though, in Europe over the last 12 months, so we can discuss that right now. Look at the spread between Germany and look at the spread between that and Italy. The spread between the two has been widening. We were inside 100 basis points last September. Now it's about 200. Tom, that's a big change around for this bond market, for the German 10-year versus the Italian 10-year. A big turnaround also for a German 10-year yield that has broken out in a big way this year.
Yeah, I take your point on that, John, and that the idea here of watching spread market right now really is critical. And frankly, John, it will be critical in the tick, tick, tick through the 8:30 press conference.
And looking at a euro, Tom, which is going absolutely nowhere going into that news conference at 107, and putting it all together, Lisa, this is the challenge for this ECB. What do they do if inflation persists and this bond market starts getting messy? How do they choose? Do they have to come together and put together some kind of package where they can tactically allocate the reinvestment of the bond buying program? You take all that stock, and when you have to reinvest it, do you get a little bit more tactical so you can keep the volatility in the bond market down, at the same time hike interest rates?
The model of the blunt tool of just keeping rates perpetually in negative territory and just keeping them incredibly low to protect the peripheral regions has failed. They have to be a little bit more tactical, and that is what I'm looking for. Any indication that they're setting up programs to selectively buy Italian bonds, Greek bonds, et cetera, to try to keep down spreads while also allowing benchmark rates to rise.
John, we got to comment on this. It's so important right now. It's a SEGUI here that's a little clumsy, but we're going to do it because we want you to hear this first from Bloomberg Surveillance. Target raises their dividend 20%, their quarterly dividend, John. This is the rebound off the tough press conference the other day. I'm sorry, John, this is corporations adapting and adjusting.
Yeah, I'll pick this up, honestly. Target coming out after having the shares plunge dramatically, suddenly coming out to try to shore up some investor support, increasing their dividend despite the fact that profits, Tom, have gone so much lower in terms of the projections.
I really can't say enough about that. And this use of cash is a quiet optimism of the people pushing against recession gloom. One of those is Katrina Dudley, portfolio manager, Franklin Mutual Series, and we're thrilled that she could join us today. This is precisely, Katrina, what you're talking about at the bottom of your research note. I'll get to the government in a moment, but what you are talking about that's so important is we will adapt and avoid the big R recession.
I think you're exactly right. When we look at a recession and a big R recession, you need to have a lot of excess in the market going into that downturn in order to have the change or the big negative downdraft that constitutes, as we call it, a big R recession. But if we look on why we think there's going to be a little R recession, have a look at things like the housing market. We think that that will continue to support the economy. We look at the supply chain, and while there's certain parts of it where we're getting a little more flexibility, there's not a lot of inventory in the system. So that's why we think it's a little recession.
We have an intuitive feel that in Europe there will be government spending. That's what happens with a war. Do you see the government spending in the United States that will allow for a little R recession?
I think as you really need to think about that in the context of the political climate. So we're going into midterm elections. And so the Democrats really need to get back some favor, particularly with the low end of the consumer. We've been talking about Target. We're seeing it at Walmart. We're talking about McDonald's. The low end consumer is really feeling the pinch of these higher gas prices and higher food prices. So you may see some type of action there. Or alternatively, we could see some progress on an infrastructure bill. Now, for the last 10 years, we've been talking about that, so I'm not exactly, putting, a lot of weight on that going forward. And then finally, there's a lot of other things that the government can do in terms of first-time home support, home buyer support, and other things in order to kind of soften the blow as we talk about it.
Katrina, I want to double down on the Julian Emanuel call of a bear case of 2,900 on the S&P and a bull case of 4,800. As John was pointing out earlier, the bear case is driven by oil prices and the fluctuations, the idea that we could see dramatically higher oil prices that crimp growth and send the U.S. economy into a recession. How much are you considering this outcome?
Look, I mean, that type of range of outcomes is so big, as we would say, you can get a Mack truck through that. So, it is really a big, big range of outcomes. The thing is, what I think that you're ignoring is the adaptability of people and the economy. And I think that that is what offsets a huge downturn. So in terms of those high gas prices, what do we think will happen is that maybe people will be driving less and they'll drive to jobs that are closer. And that's one of the benefits you have of this shift into a services economy, where those jobs tend to be closer to where someone actually lives. So I think that we can see the consumer adapt to those rising gas prices, and I don't necessarily think that that plunges us into a huge recession if you combine that with the fact that as an economy, we're just much less reliant on oil than we have ever been in the past, and that's the kind of offset this time round.
Do you think that investors are too bearish on the retail sector in particular? I point to Target, as Tom was just talking about, increasing their dividend by 20%. Shares are up more than 1% in pre-market trading. They've been really hammered so far this year because of higher gas prices impeding their pricing power and their margins, and some of the other supply chain issues that they've been facing. Would you be a buyer here?
If I take a look at something like a Target, what it's showing you is the fact that the supply chain is starting to loosen up, because obviously they're talking about discounting product because they have too much product and too much inventory in their stores. You're seeing the other side effect, as you talk about, which is the buy down and people shifting the spend out of the profitable kind of non-durable goods within a Target. So think about your towels and your sheets and your decorating items into more of the food product, which has that lower margin. So everything as we talk about comes down to the price. And also, I think, however, the stock has come down, the earnings have come down, so I think it's in much more attractive territory. And the comment that we would take out of something like that dividend increase that was announced is that management is trying to be good to their shareholders by increasing the amount of capital that they're returning. And they're also using that as a way to message to the market their confidence in their ability to get back to those promised levels of margin. So I think it's a positive setup, but it all comes down to the price you have to pay for that.
Katrina, where in the income statement do you define profit? Is profit start up at revenue with the dynamics of unit and price, or do you come down the income statement to find where you say this company has profit, this company does not?
I'm going to turn this on your head. I hate to say this. It comes down to distributable free cash flow, because as shareholders, that is all we care about. So at the moment, what you're seeing has been a huge disconnect in the first quarter between profits and cash flow. And what is driving that has been the huge buildup in inventories. And so we've seen that buildup is in inventory is both volume related as well as price related. And so we're seeing very low levels of cash flow at the moment. But as we go forward, we think that the supply chains are starting to normalize, and you will have a reversal of those trends. So you may have a little bit of weakness in the income statement and in the reported profits of companies, but you could actually see their cash flow numbers be fairly solid, driven by the unwind of that significant inventory build that we've seen.
John, that was textbook. For those of you studying for the June CFA exams, plural, tape that, tattoo it to your brain.
Katrina Dudley there. of Franklin Mutual Series. Katrina, thank you. Kathy Wood sitting down with Ed Ludlow yesterday, Tom, speaking to this. And, of course, Kathy's talking her book. But on this particular topic, I think a lot of people are gravitating towards this idea. I've never seen inventory surges like this in my career, and I've been around for a long time. She went on to say, this inventory issue highlights the cyclical reason we've been saying we think inflation will unravel. That's the view from Kathy Wood. Has been for a while, Tom, and increasingly after that Target news this week, is starting to become the consensus position on the good side of the inflation story.
Yeah, I thought Ed Ludlow really nailed that, to be honest. And John, what's so important here, and I'm going to give credit here to The Economist, and I think it was 2 issues ago, I really can't remember, just a tour de force explainer on inventories, which is from my ute. And the answer is, John, we make jokes about LIFO, FIFO. This is serious stuff where once it's cleared out, free cash flow pops, and they go from just in time to the new reality, John, which is just in case inventory.
This is an element of the tech bull thesis, this inflationary goods side of the story, Lisa, so let's talk about it. It's this idea that there's too much inventory, we get all the markdowns, there's a shift from goods to services, you start to see that disinflationary force take hold of things. Maybe it's offset by the services story, we can talk about that through this morning, but ultimately the tech bull thesis is that inflation starts to come down for cyclical reasons that Kathy's been talking about. Rates don't have to go much higher, and guess what wins? What wins in the equity market when that starts to happen, Bramo? The stocks that she holds.
Exactly.
That's the hope. That's the hope.
That's why some people talk about this as a somewhat self-serving prophecy. It's one that's interesting to note, especially on the heels of what Ed Morris of Citigroup was saying yesterday, in terms of how we're judging some of the price moves, how idiosyncratic some of them may be, and how they stem from an unprecedented period of time, how much we don't have a handle on what people are buying and when. Were people buying physical goods because they had nothing else to spend their money on? Now we're facing a very different reality, and people are not going to be spending their money at all, possibly, especially in light of
there you go. That's a gloom we need.
That is, Tom. That's it.
That's just.
Tom, I'm reliably informed there are desks on sale at Target.
No.
There are desks on sale at Target.
He wanted to buy one.
I was going to buy us one for us all to sit around.
Now the show can begin.
Bring us together. Just bring us together. Futures positive, 22 on the S&P, up 0.5%. Yields coming in a couple of basis points, still in at around 3%.
John,
an ECB decision, Tom, an hour away.
The VIX is under 24. Have a tank.
Relax. Is that a message for me or for Bramo?
Bramo.
I don't think we want Bramo on tank. One of us is enough. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Ritika Gupta. The European Central Bank is preparing for its first interest rate increase in 11 years. Today, policymakers are set to announce an end to large-scale asset purchases. The rate hike is expected next month. Officials are trying to bring down record inflation whilst averting more damage to an economy hurt by the war in Ukraine. President Biden called inflation the bane of the U.S. In an interview with ABC late-night host Jimmy Kimmel, he said that high food prices and gas prices could be offset by legislation lowering the cost of prescription drugs and childcare. Inflation has become one of the president's foremost political problems. And authorities in Shanghai are locking down part of the city again. They'll conduct a mass COVID testing drive Saturday in the first major movement restriction since the city ended a bruising 2-month shutdown at the start of June. More than 2.6 million people will be involved. Bloomberg's learned that a consortium of Apollo Global Management and Reliance Industries has made a binding offer for the international unit of Walgreens Boots Alliance. The proposal puts a value of about $6.3 billion on the business, which runs more than 2,200 Boots drugstores across the UK. A rival group, Britain's Isa Brothers and TDR Capital, has considered dropping out. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The fact of the matter is that U.S. exports have been booming. When companies had to look away from Russia for diesel, where did they go? They went to the U.S. When companies had to look for crude oil, where did they go? They came to the U.S. And our inventories came down, giving a misleading impression that the whole world was going down in the inventory side the same way the U.S. is.
Ed Morse there, the global head of commodities research at Citigroup. His view that we get down to 85 on Brent at some point over the next 12 months against Goldman's view. Jeff Curry pushing for 140, 130 over the next 12 months. Futures right now, positive 0.5%. The ECB just around the corner, 1 hour away, and euro dollar just about positive, up by almost 0.1%. And that currency pair just about a stronger euro in the mix here. Euro dollar Tom 107.24.
We love the macro babble, John, of hydrocarbons, and of course the world-class team at Bloomberg leads on this. And what I would suggest, folks, is stop what you're doing now and listen to the micro analysis of where a barrel goes. From 123, does it go to 133, or does it go back to 113? Paul Sankey joins of Sankey Research. Paul, I want to go right back to the Szymanski-Sankey Combine at Deutsche Bank. You guys did granularity like no one. Reaffirm how expensive it's going to be to produce oil in America.
How expensive it's going to be to produce oil in America? Well, the cost of capital of the companies has come down. So they do have a lot of cash available to them. Obviously, at the COVID lows, they simply didn't have any money, and that's where the major underinvestment in oil supply growth occurred. What's interesting now is if you look at rig counts in the US, and if you look at frac spreads, which is what you need to actually generate the oil from the drilled well, they're both just ticking down a little bit. And at the same time, we're not seeing any growth in gas production, natural gas production. Never mind actual gasoline production either. But in the case of the former three, that is oil, fracking, drilling, fracking, and gas supply, it's just very surprising that there's zero growth basically at, as you mentioned, 120 Brent, 120 WTI, and what was yesterday $9 natural gas. Now, natural gas has come down a lot because there's a problem with one of the major LNG plants. So one of our concerns is the government may ban exports in some form. Further to what Edmund
Paul,
was saying.
After our conversations with Christian Malik of J.P. Morgan, I want to combine the two threads here of analysis and the idea of a Sankey-Malik nexus. At what price point does investment click in, which J.P. Morgan screams we desperately need?
Well, at the moment, they just don't have the people or the pipes or even the rigs. So it's not really an economic decision. It's a lack of capacity. And that's exactly the same problem in refining. And that's why everything's so tight. And then within a Democrat administration who hasn't still to this day been helpful in terms of providing regulatory certainty, they're reluctant to commit the level of risk that they would have to. Now, one stealth thing that's happening, Tom, is there is a bit of M&A happening. For example, yesterday, Devon, which preaches a very high level of capital discipline, dropped $900 million on a bolt-on acquisition. And I'm like, I don't know how big a bolt-on acquisition can be, but that's a pretty big bolt-on, spending $1 billion in North Dakota. But there's a definite problem with reinvestment. Another good example, Tom, just to continue, is if you look at Saudi, they've said they'll massively increase their capex. But the effect of that is only to increase production by 1 million barrels a day by 2027. So, it's just not happening anywhere globally.
Paul, how much of a swing factor is China, given the fact that we're seeing renewed lockdowns in Shanghai and parts of Shanghai, one part of Shanghai, and the threat of more of them? Is this going to drive either prices going higher or lower, depending on whether those lockdowns ease or whether they tighten up?
Absolutely over the cycle. But the problem is with China, as you know, there's a lot of inventory stocking kind of playing around, which means that the short-term effects of what they do domestically are very muted. Now, if you want a great example of how marginally priced oil and gas is, look at what happened yesterday. There was an explosion and fire at Freeport LNG, a 2 BCF a day LNG export facility here in the US, and gas prices went down $1 in the last 12 hours. That's the dollar per MMBTU. So at the margin, China is hugely important. It's a 2 to 3 million barrel a day swing at the moment relative to their COVID lockdowns, which is huge. Global oil market is 100 million barrels a day. China's about 13 million barrels a day. So the swing is that big on Chinese demand, 20%, 15, 10%. And at the margin, that's enormous for prices, absolutely. But we've got the October Party Congress coming up, and I'm kind of stunned they're still mucking around with lockdowns. I just can't believe they're still doing this.
Well, have you seen evidence, given the fact that prices have gone up as much as they have, that we are seeing demand destruction in the United States, in Europe, as a counterbalance to if and when China does reopen more materially?
Well, I wrote about this last night on the wonderful subject of Casey's, and I know Mr. Tom Keene is going to enjoy this. So Casey's, as you probably know, is a huge convenience store operator, and it's very impressive management actually on their call. Weirdly, they have an April 30th quarter end, and they reported results yesterday. So what they said is they're across the Midwest, they're very, very middle America, and they're just seeing the beginnings of demand destruction, believe it or not, in the highest, well, they're seeing it in the highest priced areas, which would be $6 in certain parts of Chicago, $6 a gallon. But much of their footprint is actually in places where it's closer still to $4 a gallon towards the South Midwest. And they're still seeing demand growth. And net, they reported as of yesterday, gasoline demand, fuel sales up still in this latest quarter ending April 30th. So demand strength has been a huge feature of why prices are so high and lack of price elasticity on the demand side. Yeah.
Hey, Paul, you're one of the best. It's good to catch up. Paul Sankey there of Sankey Research on a crude market and the energy players as well. I've just been catching up with Julian Emmanuel. He heard the call, Tom. He heard the call. He's going to join us in about an hour and 30 minutes.
We got to say thank you to all of Global Wall Street for tuning in every morning on radio and television. I mean, John, we just sort of grind it out every day, but we're really thrilled that people like Emmanuel can come on so we can grill him.
Over at Evercore, Not grid him too hard, Tom. He's doing us a favour.
Seriously, I want to know.
Seriously, though, we will be gridding him about this 2,900, Tom, bear case in his equity forecast.
And I want to know how that links into what Ed Hyman's seeing in railroads, or what Paul Sankey just said about the first click-in of demand destruction.
Lisa, 4,300 is the base case. The bear case, 2,900 for Evercore.
No, it's called the Bramo case, John. Get with it.
They should rename that, shouldn't they, Tom? In a Southside Research, the Bramo case and a base case, and then the bull case.
I'm not making a call, and frankly, I think that there are a lot of potential good outcomes. I just love the idea of putting out the call and having a signal, like the bat signal, but the surveillance signal, would it be, you know, the light shining up of a cup of Tang? I'm not sure what it would be.
A quick message over to Bloomberg is always helpful too. Gillian's going to join us a little bit later this morning. Gillian Emanuel of Evercore at 8:15 Eastern Time. Looking forward to that. Futures are positive, about 0.6% on the S&P, on the Nasdaq 100 up 0.6%. Also, we're counting you down to an ECB rate decision, a news conference with President Lagarde, with your euro basically unchanged against the dollar. Euro-dollar 107.19. That currency pair positive by just 0.03%. From New York, heard on radio, seen on TV. This is Bloomberg Surveillance.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines, and that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This higher inflation is undermining consumer confidence and therefore consumption.
The Fed has to keep hiking 50 basis points until there's some semblance of a demand slowdown, because that's all they've got.
I'd be amazed if the Fed is able to go 50-50-50 at the next few meetings in a straight line without any pushback from markets.
Maybe they can pause and let the high prices naturally bring down demand.
It's perfectly feasible to argue right now that rate cuts are on the table.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
The week begins right now from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures positive, 0.5% on the S&P. The ECB, that decision coming a little bit later this morning, Tom, 45 minutes away. Then it's on to US CPI tomorrow morning.
Maria, today on Amsterdam, and of course the press conference will not be boring. It will be really interesting. Her statement at the beginning. And then, John, the nuance. John, let me go to you as a true expert here. What is the nuance you will listen for?
The debate over 25 or 50. There are going to be some hawks on this committee today, pushing hard for a move today, I think to some extent, and a bigger move in the future. This ECB president wants to keep things gradual, retain some optionality, and this is why they're moving so slowly here. Today is about laying the groundwork for a move at the next meeting, not today. It's about unwinding QE, finishing that, then making a move on interest rates, doing it a couple of times and wait and see. Yeah. Tom, you know better than most that you can be overtaken by events. I think this ECB's been overtaken in a big way by the events of inflation of the last 12 months.
And I really want to emphasize for the American audience, this is different than a Fed discussion. And John, I'm going to go right back to one of the core monthly payments people make. The utility bill structure of Greater Europe is really front and center for Christine Lagarde.
Sky high, and the UK an example of that outside of the Eurozone, where this cap has been lifted and people's energy bills have just been climbing, surging so much over the last few months. Lisa, we've all got to struggle with that, and this ECB's got to struggle with this. Inflation numbers probably get taken up today in the forecast. Growth numbers probably get taken down today in the forecast. How do you set policy for that?
Do you hike into weakness? We've been talking about this as a theme throughout the entire year, particularly with the United Kingdom, but the ECB facing the same reality. My issue is, what happens if they come out more dovish than people are expecting? What if they confirm only a 25 basis point rate hike at the July meeting and the expectation that they're not going to go for 50 basis points? Do we see a sigh of relief in markets, or do we see the opposite? Do we see longer end yields in the region climb much more dramatically because inflation is going to get away from them?
And without getting too technical, how do they manage the periphery? That's going to be interesting here. If they end QE, what do they do with the balance sheet? What's the balance sheet strategy to make sure that Italian yields don't surge as they start this rate hike cycle?
And what's the political ramifications of specifying that they're going to support the Italian bond market, the Greek bond market, and the rest of the peripheral market at a time when they want to project strength, they want to support some of their weaker members economically at the same time that they have to move away from these low rate policies.
John, a working statistic here. Brent crude intraday peak, 124.40. And John, you and I went back and forth last night. I flunked, folks. I didn't do the math on number of liters to a gallon converted to dollars. But John, it's in the $10 area.
It is.
Nudging towards $11 a gallon for petrol. That's what they call it, Lisa. Petrol in the United Kingdom.
Bramo didn't know that. Let me say this, because I've had a few messages about this recently.
I'm only trying to pronounce SEMA.
Thank you. SEMA's very impressed. You can't wait to join this conversation. A lot of people have made this point that look at gas prices in America. You hear all the moaning. Look at it relative to Europe. It's so much higher in Europe. A budget's a budget. The pain's not relative. If you're budgeting for gas to be at a certain price per gallon every time you fill up the tank, Tom, and then that changes on you, you're not sitting there saying, oh, but it's still lower than what they pay in the UK. That doesn't matter. It's not a relative story. It's what you're paying month on month, Tom. It's what you budget for, how you drive to work, and how that changes on you. That's the story.
And dovetail that into what we did yesterday or the day before, where I disagreed with Lisa. Lisa disagreed with me. I'm sorry. Revolving credit is a moonshot in America because precisely of that. People are running out of money on a weekly, monthly basis.
Lisa, final word?
look, this is the reality, and I think you say it really well. It's a budget, and it's getting crimped, and that's the bottom line, and people are going to spend less on other things.
They're getting squeezed. Futures positive, 0.5% this morning. Good morning to you on the Nasdaq 100. We are positive 0.5%. Also, yields are unchanged on a 10-year at 3.02%. Euro dollar's unchanged too. We are about 41 minutes away, Lisa, from that ECB decision.
Exactly, 7:45 a.m. Eastern time. We get the rate decision. 8:30, we get Christine Lagarde giving some color to their decision to possibly raise rates as soon as July. 8:30 a.m., we get U.S. initial jobless claims. Do we see a bit of weakness in the labor market? Rick Reeder, speaking with you, John, last week, was saying that report that we saw on Friday could be the last solid one in a while. We could see negative prints in the next couple of months. Do we see any evidence of layoffs picking up? And at 8 p.m., we have those primetime January 6 hearings in Congress. The expectation is there are going to be some bombshell guests. Otherwise, why do primetime, John?
Very true. Very, very true. Lisa, thank you. A whole host of things to look out for the rest of today. Let's get straight to the conversation with Seema Shah, the Chief Strategist at Principal Global Investors. Seema, an hour ago, we spoke to Sebastian Page of T. Rowe Price, and he said normally after a sell-off of this magnitude, we'd be buying stocks. This time we're not. What are you doing?
We are very much neutral. Look, I think you could see a bear market rally. And I'm going to say that it's a bear market rally rather than a full-on rally. And we have to look for the catalyst. When are things going to change? But once you see some of that economic data, the earnings data start to roll over, we think that you're going to see a really, really challenging period for equity markets where it retests the lows that we've seen in the past month or so and probably goes a little bit beyond.
People have been conditioned by the last couple of years, Seema. They always are. Near term, they look back. The last reference point for this, early 2020, spring of 2020. We hit the lows, we started to rally, and we had this conversation. How do you differentiate, distinguish between a bear market rally and something more durable? What have we learned from that? Because I think a lot of people looking at this right now, just sitting there itching, thinking, yeah, I want to get in. Because I was told this last time around, it was a bear market rally and this market just ripped. Why is this so different?
Oh, I think this circumstance that we're in is very, very different to anything that we've seen over the last decade. Like you said, investors, they've become very accustomed to kind of good returns, low volatility, and always being supported by the Fed. With inflation at this level, I push back a lot about the idea of a Fed put any time over the next 12 months or so. So I think in that environment, this is a time where you have to look at the fundamentals. You have to look at the fact that, as you said, energy bills are really weighing on households globally, US, Europe, wherever you look at it. And in that situation, earnings will start to slow down.
At your London School of Economics, there is one glorious morning where they study Irving Fisher of Yale. Does inflation follow rates, or does rates follow inflation?
Ooh, the big question. Look, rates should work with a 6 to 24 month lag. That is the way that we should see it. Now, there's going to be a ton of other pressures working through. We're going to have the economic slowdown already in progress because inflation is going to be pushing down, as we said, on consumers. And then we also have to think about supply chains. This is such a complicated matter compared to previous periods where you have this additional impact from post-COVID, as I said, the supply chains. And then, of course, you've got the Russia-Ukraine crisis.
Seema, if you do see the fact that Fed put is not really on the table, what's the argument for a weaker dollar?
It's a good question. So, look, beginning of this year, we were looking at the valuation factors for the US dollar, and it was flashing red. But as is always the case, valuations doesn't necessarily mean that things are going to change. You need that catalyst to see things changing. And in the last month, because we have seen market expectations for the Fed hikes probably hit a peak, and yet at the same time, you're seeing expectations for the ECB, for other central banks starting to push up. They're going to hit a crescendo at some point. But for the time being, that means that there is downward pressure on the US dollar.
But we're not seeing it right now, even as we're expecting a pretty hawkish message from the ECB today. The likelihood of a 25 basis point and even more in July. What more could they say that could be a catalyst to send the euro stronger?
So I think we need to have confirmation from Lagarde exactly where they're going. From the stuff that she's been saying, she is indicating that this is a 25 basis point move on occasional meetings, rather than the 50 basis point move that increasingly the market is pricing in. So I think we need to see some of that to see that additional downward pressure. But I also want to say that even if we were to see Lagarde moving in that 50 basis point hike, the ECB following along with that, I don't think it goes on for too long because we also have an even more negative view for the European economy. So I don't think they can keep moving at these kind of pace of rate hikes for very long.
Some of the forecasts a little bit later this morning could be dreadful. Seema Shah, thank you, of Principal Global Investors. Looking at the ECB's current forecast for growth in 22, 3.7%. For inflation, 5.1%. You think about where inflation is right now with an 8 handle, Lisa, how much that forecast might have to change. And with GDP, 3.7%, that sounds pretty optimistic at this point, given what that economy is facing.
Well, how do they parse out the oil and gas component from the rest of the components? How do they parse out how durable this inflationary move is? It's changing in the United States from going from people expecting a wage price spiral or something that is more pernicious and longer lasting to perhaps this big question mark. Is it the same in Europe? Do they see basically the transitory story lurking in the background?
Lurking, a toxic story. You need it, honestly, on radio sometimes you need the Bramo cam. You just need to see the facial expression when she makes these points, because
what facial expression
you know
am I
exactly
making?
how we're going to respond to this.
Okay.
Can I just finish on this one data
Please.
point? If you are going to compare the rate hiking cycle in Europe to the United States, be sure to think about the labour market too. Unemployment in Europe, Tom, the forecast from the ECB, 7.3% for this year, 7.2% for next year, 7% in 24. It has a 3 handle in America.
Now, even when there's structural differences there, that's still a very large number. John, I think we're underplaying here the distinction of Joachim Nagel and the Bundesbank with the proxy for the Italian central bank, which I believe would be a guy named Draghi. And I think we've depersonalized these political decisions that Madame Lagarde has to confront. They're tangible.
That's a good thing, though, isn't it, Tom?
I think it's the history of the Europe. I think that the tension of core Europe with prosperous peripheral Europe with struggling peripheral Europe is tangible. We underplay that.
This Federal Reserve has been a victim of groupthink over the last 12 months, and the diverse views on the European economy
way healthier,
often criticised, but I think I agree with you, Tom. I think to a certain extent, other elements of it, healthier, better. Futures up a half of 1% on the S&P. It's Bramo's Toxic Brew. Julian Emmanuel in the next hour of Evercore. He's got a base case of 4,300 on this S&P. He's got a bear case, a Bramo case, if you will, of 2,900. This is Bloomberg.
Brutal.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The European Central Bank is expected today to firm up its plans to exit negative interest rates. Officials are likely to end asset purchases in the coming weeks. Plus, they'll probably send another signal that the ECB will join the Fed and others in raising interest rates next month to fight inflation. On Capitol Hill, the House has passed a package of gun legislation that includes raising the minimum age to buy many semi-automatic rifles from 18 to 21. But the move is mostly symbolic. It will ultimately be set aside for whatever compromise plan emerges from negotiations in the Senate. House Democrats are taking their investigation into the January 6th riot at the Capitol to prime time. Tonight's opening televised hearing will include testimony from a police officer injured that day and a documentary filmmaker who captured the events. Republican lawmakers have planned counter-programming. Target has raised its quarterly dividend by 20%. The new payout implies a yield of about 2.8%. That is a full percentage point above Walmart's yield. The move comes after Target lowered its profit outlook for the second time in less than a month. And in China, the securities regulator says it's not doing work on reviving an Ant Group initial public offering, but it does support eligible companies listing overseas. Earlier, Bloomberg reported that regulators have established a team to reassess the fintech giant's share sale plans. Almost 2 years ago, regulators scuttled the Ant offering, which would have been the biggest listing ever. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
为开春的时候为各国运动员和随队官员提供热情周到的服务。
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic. We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special Equality Series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
We're the strongest economy, and that's allowed us at least to stay on top of and a little bit ahead of what's happening around the world. Look, inflation is the bane of our existence. Inflation is mostly in food and in gasoline at the pump.
And it's hammering his approval rating. That's the President of the United States on Jimmy Kimmel Live in the United States yesterday evening. Futures positive, 0.5% on the S&P and the Nasdaq 100 up by 0.5%. Also, yields look like this on a 10-year, 3.0178%. Don't want to push back too hard here, Tom, but it's not just energy and it's not just food.
No,
Shouters up there too, and this is pretty broad-based stuff.
It's broad-based, and what's important here, and Neil Dutta mentioned this the other day, is to maybe you look at apparel tomorrow to see the linkage there into Target, into Walmart as well. And John, I'm going to go back to David Rosenberg 101, who was literally became famous parsing inflation at Merrill Lynch years ago. It matters to divide it up into 82 different subgroups.
It keeps saying the week starts now. In about 20, 30 minutes' time, we get the ECB. Then, Tom, as you say, tomorrow, onto US CPI tomorrow morning.
Yeah, and it'll be core inflation analysis for the pros on Wall Street. Jet Fitzpatrick knows in Washington, nobody in Washington cares about core analysis of inflation. They don't care about Dallas trim. They don't care about Cleveland. What they care about, Jack, is the headline number, and the headline number is grim. Who's it grimmer for, Republicans or Democrats?
Oh, it hits politically, it hurts Democrats much more. Republicans are campaigning on inflation. It's an issue around the country, and if you're talking about who it affects in terms of the voters, I mean, you look at California gas prices. There are a number of Democrats. It's not just rallying Republican opposition to the president. It really could dampen Democratic enthusiasm because it's so widespread around the country. So it's a huge problem for Democrats. It's the focus of the midterms right now for Republicans, and it's a major factor why people expect Republicans to win at least one of the two chambers.
Jack, I got a box up in the attic, and it's full of all my old regular ties, long before bow ties. Right next to it's a box which has my political memorabilia, including Nixon JFK buttons, and it also has a Whip Inflation Now button from Gerald Ford. That went down in flames. Is there a risk here that Biden comes up with a program that goes down in flames?
The bigger risk would probably be him being seen as not having much of a program. He can make the case that it's concentrated in certain areas. He can make the case that it's a natural progression from the pandemic and the reopening and the difficult reopening, but he doesn't have a very clear answer to what exactly he can do. It's hard for him to campaign on the comparative lowering of the deficit this year compared to last year, that kind of thing. And the biggest risk is he still has a legislative agenda he wants Congress to work on. They seem to be working on things like prescription drug prices, that kind of thing. There's a conversation going on, but it's very much the kind of conversation that could stall and they could end up with nothing more than he has accomplished. So his risk is less a coherent response that failed and more the idea that there just isn't that much of a response.
Tom, do you actually have an attic?
Do I have an attic? Yeah, we've got an ancient attic. I mean, there's stuff up there.
I can imagine.
I've got all my old textbooks up there.
Yeah, and lots of Velveeta boxes, just to remember the good old days. When we look forward, John is just losing it. But I do wonder, Jack, how much we're expecting the focus in Washington to turn to July 29th, with Exxon and a number of the big oils to report their second quarter earnings. And perhaps we'll hear more about a windfall tax or some sort of problem with the profits that they're posting. Are we expecting anything on that front from Washington other than hearings?
I think it's safe to expect rhetoric and hearings. Some of the legislative response to that kind of thing has stalled. There was a gas price gouging bill that got caught up in the Senate. The Senate being a 50-50 split makes it tough to even get things out of committee and onto the floor. So it is effectively stalled. The legislative outlook and outlook for anything really substantive on Democrats hoping to hold energy companies accountable to cut down on the profits they can take. That's really tough, and it's not the highest priority on the legislative agenda in Capitol Hill. So that's more of a rhetorical issue.
Hey, Jack, thank you. Jack Fitzpatrick there in D.C. Looking ahead to tomorrow, here are the numbers you need to know. 8.2% is the median estimate so far in our survey for CPI, 8.2%. That's the headline number. You strip out energy, you strip out food, 5.9%, down from 6.2%. This is all survey stuff. What Wall Street's going to focus on, though, month-over-month figures. Core, 0.5%. Coming in just a little bit from 0.6, but 0.5%, I would argue many would too, at least are still too high.
It's still too high. And when people talk about inflation coming down, they're talking about it coming down to 4% or 5% by the end of this year, and possibly not that much lower by the end of 2023. What's the breaking point in terms of when that inflation becomes sticky? And I really don't have a clear answer to that, John.
And what's the threshold for the Fed to back away?
Yeah.
Let's be clear about this. We often talk about a consensus view. From my position, just listening to all these guests, Lisa, you give me your input as well. I'd love your perspective. It still feels like the consensus view is this Fed backs away in September or maybe shortly thereafter. That seems to be the consensus position. I still don't understand the threshold that allows the Federal Reserve to actually make that decision.
The consensus, in my opinion, is a very quiet, unspoken transitory, that there are going to be these rollover effects that are going to bring inflation down naturally, that will help the Fed back away and will give them more of a legitimate reason to not go as far and fast as a Bill Dudley is expecting. Whether they are right, whether we get that supply overdue or anything like that that could bring some of the prices down naturally remains to be seen.
So many people, Tom, just believe this story just won't persist. It can't carry on.
Well, yeah, okay, that's what they say. I mean,
That's what
you
they
look
say.
at hydrocarbons, and as I said, they're at 123. I forget where we are on Brent crude, 124 right now, rounded up. Do we go to 134, which no one understands, or do we go back down to 114? To me, that's the key emotion. John, I want to emphasize this, and this has to do with when we invented surveillance. The public is in the here and now, and that's going to be the inflation report tomorrow that President Biden and everyone else has to deal with. The street is in the expected. We are always looking out to the expected, and it's two different worlds, the global Wall Street world, John, and the fill it up at the pump and Fargo world.
Just to be clear, to clear this up, Tom, when we invented surveillance, were we all wearing ties?
No, we were not wearing ties.
Everybody wants just some evidence that you did once wear a tie.
The last time I wore a tie on the show at Bloomberg was with the set designer for Mad Men.
Yeah?
Yeah, they had a tie, special tie.
Oh, so you wore a skinny tie.
I wore a skinny tie just
Very
for
cool.
a moment.
And your thoughts on that skinny tie?
It's back in the attic.
No. They said, you're no John Hamm.
Is that what they said? Futures, positive. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
If you can, carve out a little bit of time in 45 minutes. We'll catch up with Julian Emmanuel of Evercore, and he's made a move from 4,800 down to 4,300 on the S&P. That's his base case. We closed yesterday at about 41.15-ish. His bear case is 2,900 on the S&P. We'll catch up with him a little bit later. Equity futures positive a 0.5% as the week really gets underway with an ECB decision in 15 minutes' time. On to tomorrow with CPI on deck. Let's take a look at Treasuries going into that. Pretty stable, unchanged on a 10-year yield, in and around 3% for the last couple of days. Right now unchanged at 3.02. 15%. That's the yield on a 10-year, unchanged. Euro-dollar unchanged too going into the ECB. So let's take a look at Europe. Euro-dollar 103.50, the low of the year. That was the middle of May. Right now 107.22, basically unchanged on that currency pair going into this call. But the ECB faces some contradictory goals. They don't want the euro to get too weak. At the same time, they don't want yields to get too high and spreads to get too wide. And Lisa, we often talk about Goldilocks, not too hot, not too cold, just right. I'm not sure what just right is in Europe right now because they face a problem.
They have to thread a needle in a scenario that is a basic hurricane. They're dealing with so many different variables and trying to get it right. How does this bleed into the euro? If they raise rates more, does that mean a weaker euro because that will slow growth? Or could that potentially mean a stronger euro? I have not gotten an answer, and neither of you. We've been asking it for a long time.
The Bank of England's living this right now. The Bank of England is living it. They've had to raise their inflation forecast, drop their growth forecast. Yeah. Will we see a repeat act, Tom, in about an hour's time when we hear from President Lagarde?
And from Laurence Boone yesterday, the UK view from OECD was jaw-dropping how weak that was. John, this is a really important point that the spread market to me is more important in Europe because it's so politically non-homogeneous. It's just, I can't emphasize enough, we're not talking enough about the politics that Lagarde has to face.
And it's the difference between the Federal Reserve and Europe.
Yeah.
You're looking at different markets. Chairman Powell doesn't have to juggle BTPs, the Italian debt market. And Lisa, let's just finish on that. Periphery, spreads, they've widened out. They were inside 100 basis points last September. Now they're at about 200. Are we getting to that kind of level where this ECB starts to get just a little bit more concerned?
Perhaps, and they clearly are aware of this. And I remember when Christine Lagarde said that she wasn't there to close the gap, and then she quickly reverted and said that she was there to close the gap. How much can they then target some sort of program? Because they cannot back away from addressing inflation wholesale simply because of the periphery. There has to be a more nuanced approach.
What do they do with the balance sheet? Let's find out in a news conference a little bit later. The decision about 13 minutes away. That's the cross-asset price action. Let's get some single names, some movers. We can say good morning to Romain. Good morning, Romain.
Hey, good morning, John. A relatively quiet day here in the U.S. pre-market. Tesla shares one of the more notable gainers of the day, up about 3.5%. This on the back of that data out of China showing that the Shanghai factory that Tesla has actually did pump out about 30,000 cars in the most recent month. Now, that was a huge drawdown from what this factory was used to putting out in the 60 to 70,000 range. But given the lockdowns and all the disruptions going on over there because of COVID, a lot of people seem to be applauding this. We'll see if this trend actually continues into June, July, and beyond. But nevertheless, some optimism there for Tesla. A little bit earlier, we had seen some optimism for a lot of the Chinese tech names. This is largely on the back of various reports over the last few days that China appeared to be easing a lot of the restrictions on some of those tech companies, allowing new video games. And in the reporting by Bloomberg today is that it was actually potentially going to allow Ant Group to go forward with that IPO, of course, that was scuttled very famously a couple of years ago. We should point out that the securities regulators over there in China did put out a statement in response to that report saying that they are not considering that, though they are open to some degree of relistings of some of these companies. Nevertheless, Alibaba shares, which had been higher in the pre-market, dropped about 5%, now down about 1.5% here in the U.S. The ADRs of Bilibili, they're still down pretty significantly, down about 10%, this after rallying yesterday by a significant margin. Flip it up real quick, a few other names to keep an eye on. There is some optimism here in the U.S. Caterpillar shares setting up for what could be a 7th straight day of gains. Those shares higher by about 0.9%. A lot of people do see some signs of life in the manufacturing sector here. The retail sector here is still under pressure, though, Tom. Five Below shares down 7% on the back of some really disappointing earnings. They're guiding down for the year and for the fiscal second quarter, saying comp sales will now have a negative sign in front of it instead of a positive sign. And the end of an era for the ticker symbol FB. Facebook, now Meta Platforms, officially switching its ticker this morning to META.
It's Facebook always. Romaine, thank you so much. Look for the close this afternoon as Romaine will dive deeper into Billy. Right now, and this is fun, Sharon Bell has an economics parchment, which is a little bit different because when you are in Bath, as they say in England, you get to go look at one of the great treasures of the United Kingdom, which is the Roman bath of the 1st century in Bath. Sharon Bell, there was inflation in the time of the Romans. There was inflation in the 17th and 18th century when they made Bath, and there's inflation now. What's different about this inflation for equity investors? There's something unique going on.
Yeah, I mean, that's an incredibly long-term perspective. I often get criticised for talking about comparisons with the 70s, let alone sort of back in the Roman times. But, you know, I think inflation in the 70s, for example, was pretty bad for equity investors. It was very bad for bond investors, completely destroyed their returns in real terms. But for equity investors, it was pretty bad too. And in fact, the only assets that did well then were gold and commodities, and commodity shares as well. So within equities, I still think commodity style shares, basic resources, materials companies, particularly China is reopening, and the energy stocks stand to gain most.
But critically, can we see corporations adapt? You've got a quality cash flow, quality profit, a very Peter Oppenheimer statement from Goldman Sachs. But can those corporations adapt and adjust to a sustained, say, 4 or 5% inflation?
Yeah, I mean, quality companies are the way we think about them, they've kind of got higher margins than the average company. Which naturally means that as costs go up, they don't. A very low margin companies can easily go into loss. These companies are much less likely to. Also, actually, to be fair, in the first quarter, most companies were able to pass on a lot of these costs. Indeed, that's exactly what inflation is. If we're talking about CPI inflation going up to 10%, that is because companies are passing on the costs. So I think there is some element of companies being able to pass on these costs. And there's really kind of a bit of a barbell. It's these quality stocks where everyone wants their brands, and they've got ring fence businesses and they've got very high margins, etc. And then there's also sort of commodity style companies that are price takers, but they can make pretty good profits in this environment too.
Sharon, why is the story not only about commodities, but that rising rates in the Euro region are going to be really positive for banks that have gotten hit again and again by negative rates?
I think ultimately they will be positive for banks. I mean, the last decade has been horrendous for European banks for lots of reasons, but one of them has been disinflation, deflation, negative interest rates. They really couldn't make any margins in that type of environment. Now we're going into an environment with slightly higher interest rates potentially, and that I think will be better for banks, their net interest margins, etc. Also, banks are in a better position now because they have better capital levels. But there are some vulnerabilities. I think you were talking earlier about, sovereign problems in Europe, debt levels in Europe. We're perhaps not talking enough about that. Debt levels went up through the pandemic. They haven't come down again. Higher inflation may be a little bit helpful to that narrative, but generally that's still a big worry. Sovereign spreads rising above 200 for Italy basis points. Those types of issues are still issues for the banking sector, perhaps less than they were before, but that's still a bit of a negative.
Which perhaps is why the banking sector isn't a monolith and you can't view it as such. A Credit Suisse is very different from an HSBC, for example, or some of the other banks within Europe. How much, Sharon, are you investing, though? Are you actually trying to double down on the European bank story, given that it has been the pain trade for a past decade?
Yeah, no, completely. I think lots of people have see banks really just as a trading sector now, not one that you want to buy and hold for a long time. But I do think that banks, they collapsed around the Ukraine wartime. Some of them were kind of very specifically exposed to Russia. They bounced a bit since then relative to the market. I think they probably got a little bit further to go, and I think they are still super valued. So I actually still quite like the banks in Europe. And as I mentioned, the materials and energy companies, all these kind of value areas, I still think have got a little bit further to go.
Sharon Bell of Goldman. Sharon, thank you. as always, Sharon Bow there of Goldman on the European equity market. We are 6 minutes away, Lisa, from that decision from this ECB. Then about 45 minutes after that, we'll hear from President Lagarde.
What's more important to you? What are you looking more for? The actual rate decision and the guidance, or really Christine Lagarde and how she messages
Well, let's go through the base case first of all. Most people expect today that you announce an end of QE, end next month. What you do after that, you raise interest rates 25 basis points, you signal you'll do it again, you look around, have a look. Fine, I get all that. What I want to understand is the balance sheet. How do they make sure that things don't go wrong in the Italian debt market on the periphery? And Lisa, I think you and I are on the same page there. The forecast, could the forecast be as messy, horrible, as what we saw from the UK and the Bank of England a month or so ago?
How much flexibility do they build into this statement talking about the end of the purchases to talk about what they could reignite in terms of buying, right? And that, I think, goes to your point. How much are they going to signal that flexibility in this meeting? Because how much would it actually signal that they are going to be more aggressive with rate hikes because they're trying to get ahead of it to protect the peripheral regions?
Each central bank has got a style when they do these news conferences, and typically President Lagarde leans on a couple of buzzwords through the whole thing. And a couple of buzzwords she's been using repeatedly, Tom: gradualism, optionality, flexibility, to Lisa's point.
I would strongly suggest that the attorney from Chicago, with all of her background, including at the International Monetary Fund, John, is going to lead with optionality. You can go mathy here and say degrees of freedom, but she needs that given the fractious nature. What I want to know, John, is why don't we have a countdown clock? And folks on radio and television, we welcome you to Bloomberg Surveillance, the ECB decides.
The ECB decides. Is that the name of the show, Tom?
That's the name of the show now.
For the next 5
show
minutes.
within the show.
I was about to say for the next 3 minutes.
When does that expire, Tom? After the decision comes out?
When we expire is the way that works.
If people had any choice on that, Tom, I imagine that'd be soon for us both.
Not
including Lisa, because when we get the fan mail, Bramo is always the highlight.
Oh, yeah.
How does she put up with the two of you? She leaves the kids behind to babysit you both every single morning. That's a message I got. You see that one yesterday?
Yes, I saw that one.
Thanks.
No.
We love her too. Futures positive, 0.5% on the S&P, and the Nasdaq 100 up by 0.5%. Also, yields unchanged on a 10-year, 3.02%. The ECB up next. Euro just a bit stronger. Euro dollar positive, 0.1%, 107.30.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The European Central Bank is preparing for its first interest rate increase in 11 years. Today, policymakers are set to announce an end to large-scale asset purchases. The rate hike is expected next month. Officials are trying to bring down record inflation whilst averting more damage to an economy hurt by the war in Ukraine. President Biden called inflation the bane of the U.S. In an interview with ABC late-night host Jimmy Kimmel, he said that high food and gas prices could be offset by legislation lowering the cost of prescription drugs and childcare. Inflation has become one of the president's foremost political problems. Authorities in Shanghai are locking down part of the city again. They'll conduct a mass COVID testing drive Saturday in the first major movement restriction since the city ended a bruising 2-month shutdown at the start of June. More than 2.6 million people will be involved. And Bloomberg's learned that a consortium of Apollo Global Management and Reliance Industries has made a binding offer for the international unit of Walgreens Boots Alliance. The proposal puts a value of about $6.3 billion on the business, which runs more than 2,200 Boots drugstores across the UK. A rival group, Britain's ISA Brothers and TDR Capital, has considered dropping out. And Tesla has staged a remarkable comeback in terms of production in China. The electric vehicle maker tripled its output in May from the month previous, producing more than 33,000 cars. That is despite only recently getting its Shanghai factory back up to speed after the city's lockdowns. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
As far as monetary policy is concerned, we have, still healthy growth, employment, and high inflation. So what we're saying is remove some monetary policy accommodation. And in those countries where there is obvious excess demand, then yes, monetary policy should be tighter.
That was Lawrence Boone, the chief economist of the OECD. From New York City this morning, we are 1 minute away from an ECB rate decision, not in Frankfurt this time around, in Amsterdam. We'll get the response from Maria Tadeo in just a moment. Going into it, futures are positive 0.5% on the S&P and the Nasdaq 100 up by 0.6%. Looking at Italian yields, essentially unchanged, coming in a couple of basis points, Lisa, at 3.35. That one to watch, along with the euro that's stronger going into this. Euro dollar up by 1/3%, 107.47.
Why aren't Italian bond yields higher? Does this indicate faith in the ECB to do something to really fortify and create some ceiling on yields, this idea that they're going to come out with some sort of program? Or is it just this idea that they're not going to be able to move as much as many people think?
Isn't that part of the language, though, this idea that we're going to have gradualism, that we're going to have flexibility, optionality? I'm unsure what kind of tightening cycle we get from this ECB. I've been really surprised by how quickly things have moved and how quickly people have got on board with this idea that they can actually do a fair bit.
Right now, we're looking at two-year German yields at the highest levels going back at one point since 2011 as people bring forward some of their expectations. What's been shocking is that inflation. It's been coming out above expectations again and again, and that is the reason why people have responded by pulling forward how much work they think the ECB is going to do.
Euro dollar 107. Here comes the decision from the European Central Bank. You get a drip feed of information. You get rates first. You get some guidance on QE. We'll get some forecasts in the news conference. Rates unchanged on the main refinancing rate at 0%, on the marginal lending facility at 25 basis points, unchanged on the depot rate at negative 50 basis points. Here comes some forecasts as well. Raising the inflation forecast, now predicting 2.1% in 2024. So rates unchanged, raising their baseline inflation projection up significantly. Saying this on PEP, reinvestments are flexible across time, assets, and countries. Lisa, I know that was a line that you've been looking for as well. They expect to raise interest rates again in September. That's an extra line we've just seen come across the wire right now. Lisa, I'm going to dig into the statement. So this is pretty clear. This was like we're set up for a move here on the asset purchase program, then next on rates, and also on the asset purchase program to include that flexibility. We've had a lift to the inflation forecast. We've had a drop to the growth forecast, the 2.8% from 3.7. And I think some people might say still at 2.8, Lisa. That's optimistic.
It's optimistic, especially given how much inflation has been going up. To me, this really confirms what we've been talking about all morning. They are expecting to move. They are expecting to monitor that inflation and have that be their primary concern, at the same time that they remain flexible to issues that might be arising in other areas of the European region in terms of staving off any kind of runaway yields, any runaway sell-off in bond prices. And that speaks directly to the Italian market, John.
I just want to go through these staff projections, Tom. Let's start there with the forecast. They see annual inflation at 6.8% in 2022. They see it dropping to 3.5 in 2023. The energy story is not promising. The growth story isn't promising either, Tom. They're looking for GDP growth at 2.8% in 22, 2.1% in 23, 2.1% in 2024. We'll get into the policy, but they're the forecasts, Tom. Clearly, a lift to the inflation forecast as expected, and a severe cut to the growth forecast as well.
Yeah,
they intend to hike rates by 25 basis points, Tom, in July. They see a move in September. A lot of what we're seeing at the moment confirming a lot of what was in that blog from the ECB President Christine Lagarde.
Right, yes,
the flexibility in the asset purchase program, though, Tom, an interesting element of the conversation over the last couple of weeks coming into this and confirmed by some of the guidance this morning.
In the tone here, now let me do two things, John. First of all, off OECD yesterday, these are more optimistic numbers maybe than OECD. There's a lot grimmer tone, A, and then B, you're doing this in the middle of a war that maybe it's tangential to ECB, but nevertheless, there is a major war going on within the greater European territory. And you see it, John, with a nudge to weaker euro 107 down to a barely 106 handle. I don't want to make much of it, but clearly the tone here is weaker euro.
This statement breaks it down as follows. They go through the asset purchase program, then on rates. So allow me to go to the asset purchase program. I'll read you this out line by line. In the event of renewed market fragmentation related to the pandemic, PEP, this is the Pandemic Emergency Purchase Program, reinvestments can be adjusted flexibly across time, asset classes, and jurisdictions at any time. So even though you end QE on July 1st through the Asset Purchase Program, ultimately PEP and the reinvestment of maturing bonds, Lisa, is going to be incredibly flexible. So this kind of addresses the question that people have been asking. How do they raise interest rates without damaging the Italian bond market? Here's a decision to end QE. At the same time, you've got an Italian bond market, a 10-year, up just a couple of basis points at 340. That's the concern. How do you do both at the same time? Euro-dollar falling this morning, just a little bit weaker. Euro-dollar, a break of 107. Lisa, just a couple of contradictory things to think about. How do you raise interest rates, try and support a currency, at the same time try and make sure this bond market doesn't run away from you?
And how much control can they have with purchases as we point to the JGB market that's not a market that hasn't traded as they try to control spreads, as they try to control yields? Are we going to face some sort of similar battle? And we see that struggle as markets try to adjust to this message that the ECB is trying to bake in more flexibility for them to raise rates while controlling the peripheral region. How much control can they have through these asset purchases?
So this is a line some people have never been able to read before in an ECB statement, Tom. The last time we had a hike was 2011. Since then, clearly the outlook just was not sufficient, did not meet the threshold to increase interest rates. Here's the lead paragraph on key interest rates for the ECB. The Governing Council undertook a careful review of the conditions which, according to its forward guidance, should be satisfied before it starts raising the key ECB interest rates. As a result of this assessment, the Governing Council concluded that those conditions have been satisfied. It's been 10 years, Tom, 10 years plus, since the Governing Council concluded that those conditions had been satisfied. They have now. They're going to wind down QE. They're going to look to hike next month, Tom.
Well, and the trends here are extraordinary. First, in Amsterdam, Maria Tadeo. Maria Tadeo, what is the impact of the Bundesbank and those more conservative on these set of headlines?
Well, you know, to me, Tom, actually, there's one thing that you mentioned, and you said she's put on paper now that September hike. I think the question going into this press conference, and she's going to get hammered on this, is whether that September hike is going to be 50 basis points. Now, the other thing, you know, when it comes to the German central bank, and I think is very also something that you hear from the Dutch too and a number of other central banks in the euro area, is that the ECB needs to be much more aggressive. And the projections here actually show that the inflation print is a problem. You mentioned also that line where she says her flexibility by jurisdiction, by country. Some would tell you that is a reference to Italy. But I think when you look at the BTP, and this is a challenge for Christine Lagarde, she needs to prove that this is not just about Italy, because the European Central Bank, in theory, is not here to set policy for individual countries. This needs to be a much more comprehensive question now and a much bigger debate, not just focus on Italy on paper. If it's clear that this is now perhaps concerns about the debt situation or the fiscal situation, then that becomes a problem for Italy. And to me, the remarkable irony of this all is that we're here debating BTPs, the end of an era, and it was Mario Draghi that created in the first place that whatever it takes, and he's now the Prime Minister of Italy that's going to have to deal with this.
Maria, thank you. Maria Tadeo in Amsterdam. An extra couple of lines I want to bring to the audience if you're just tuning in. This line here on September, I think, is really important on rates. Looking further ahead, the Governing Council expects to raise the key ECB interest rate again in September. The calibration of this rate increase will depend on the updated medium-term inflation outlook. If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at the September meeting. Now, I wonder if that line was included here to just alleviate some of the pressure coming from the hawks on that Governing Council, Lisa, that's been emerging over the last few months, who don't just want 25 basis point hikes. They want to go bigger than that.
The recognition of that will only ignite the trading in markets that have actually priced that in through the remainder of this year, that there will be at least 150 basis point rate hike by the ECB. Shocking to think of that, given how they have just been in negative rate territory for more than a decade. What's going to be the consequence, and how much buying do they have to do on the periphery if they go 50 basis points in one meeting?
So, Tom, rates unchanged at the ECB, but not for long. That's your headline. We're going to unwind QE, end it through the asset purchase program. They'll maintain some form of flexibility to reinvestments to address what they worry about, which is called fragmentation. You can work out what that actually means in the European debt market. They've had to cut their growth outlook, kick higher their inflation forecast, and give us some guidance on rates. And it looks like this: a 25 basis point move in July. You go again in September, it could be bigger, and then you keep hiking after that. But the words they keep leaning on are the words that President Lagarde has been talking about for a while: gradualism, optionality, flexibility. Those three words. If you wanted to play a drinking game when this news conference starts, Tom, in 37 minutes' time, I know you do, look out for those three words. I imagine you'll be drinking a lot.
To me, the single headline is the inflation adjustment here, which gets us to our esteemed guest, and that is ECB 6.8% inflation, down to 3.5% next year and 2.1% in 2024. That is a good framework to bring in the international economist at Wells Fargo, Nick Benenbrook, who is hugely qualified to speak on this. I know of no one who has consistently applied FX strategy over his career like Mr. Benenbrook. Nick, thrilled to have you with us today in the studio. Does Madame Lagarde have control of the situation?
I think she does. I mean, there's both an economic control and also a political control because of all the policymakers on the ECB, and that's where her background as a politician, I think, is so important. So that medium-term forecast at 2%, that says that, the ECB has an inflation problem, but it's not as severe, I think, as, say, the United States or the UK.
This is so important, folks. I'm going to get this out front. We're going to blow the brakes here and go right through the 8 o'clock hour with Mr. Benenbrook. He's that important. We welcome you all on Bloomberg Radio and Bloomberg Television, particularly in Europe. John?
In the event of renewed market fragmentation, Nick, I'll read out this quote to you, and you tell me what you think about it. Related to the pandemic, PEP reinvestments can be adjusted flexibly across time, asset classes, and jurisdictions at any time. Talk to me about what you think fragmentation actually means and what they're trying to do here as they hike interest rates.
Well, yes, they are seeing probably more fragmentation than they would really like. As you mentioned, the Italian bond spreads relative to those in Germany have gone from about 1% percentage point out to 2 percentage points. But I really think this is about as much as they can do, this flexible reinvestment, because it would be difficult for them, for example, to be raising interest rates, which they're going to do. Some of the other options I had talked about was restarting net purchases if there was too much fragmentation, or even coming up with a whole new program to help stabilize the markets. But then you'd be sort of tightening monetary policy on the one hand and easing monetary policy on the other, and that would be extremely challenging. So I think they will go with this flexible approach for as long as they possibly can, and certainly that's going to be a very delicate balance they're going to have to walk there.
Nick, it's delicate to walk a delicate balance on the ECB Governing Council when you've got some loud hawks. And those hawks are so loud at this ECB. They don't want 25 basis point moves. They want bigger moves than that. And clearly there's this line that's been put in this statement for September that I'd love your thoughts on. They say this on the September decision. The calibration of this rate increase will depend on the updated medium-term inflation outlook. If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at the September meeting. Nick, that screams to me an ECB that's trying to please the hawks and tell them if this carries on through the summer, we'll go 50.
Yes, I mean, I think it's certainly, trying to, as you say, allay the concerns of the hawks. I don't know if we're going to get 50 basis points in September, though. I mean, going into today's meeting, the market was pricing 36 basis points for July. And I think pretty definitively it looks like we're going to get 25 in July. And so coming back to Tom's question, does Madame Lagarde have control of the situation? I think she does. I think she's managed to get a consensus behind that 25 basis point move. Looking at our own forecast for ECB policy, we expect 25 in July. We expect 25 in September. So if I was a voter on the ECB, I guess I would not be dissenting. I would be going with gradualism at this point.
Foreign exchange traders, I don't think know exactly what to do with this. Basically a trading range 107 for the euro versus the dollar. Unclear of whether this will be supportive or detract if it ends up slowing growth even further with more rate hikes down the pike. What's your view on that? Do you think that more rate hikes, a more hawkish stance will be positive for the euro or negative?
I think if we were to get a more hawkish view than we got today, for example, I think it would be positive for the euro. But, looking at the very near term, as I mentioned, today the question was for July, do we get 25 or 50? It looks like we get 25, and that's why I think the euro's selling off just a little bit today. And so really it is going to come down to, do we see those high inflation prints? Do we see those hawkish comments? And also at the end of the day, I would say this, still the Federal Reserve moving a lot quicker. US has a much larger inflation problem. So macroeconomic fundamentals, in addition to central bank, I still think means, trend is probably for a softer euro over time.
Nick, does it matter that a lot of the inflation is driven from the energy market in Europe? I mean, certainly in the US as well, but in Europe even more so, and that really the ECB can't do much about that by raising rates?
It matters a little bit, and trying to use sort of the economist trick there on use both hands. Certainly I would say the Eurozone doesn't have as severe an inflation problem when you look at their core inflation rate of 3.8%. And, typically a central bank would say, well, the underlying inflation trend is not that bad. So, in some sense, it maybe affects the pace at which the ECB raises interest rates. But I think there's a huge focus on headline inflation in the Eurozone as well, above 8%. And the reason being is even if all of this inflation is being driven by energy, the fact is these oil prices are going to be at $120 a barrel or higher. So we're just going to have high inflation, even if the broader inflation pressures aren't that bad.
Nick, I want to go back to your heritage, and I think it's really important here. Roger Douglas had a New Zealand that was blowing up 20, 30, 40 years ago, and he, with his leadership, New Zealand codified inflation targeting. Right now, inflation is essentially out of control. The response here is not a rigidity or a formula of targeting like John Taylor of Stanford or what the Bank of New Zealand did. The issue here is the level of dovishness versus hawkishness. How dovish is our dovish central banks right now if they can't affect New Zealand-like targeting?
Yeah, I mean, I think you've got a point there. Certainly, overall, there is still a lot of dovishness, although there is an evolution going on, because when you look at a lot of the central banks this year, faced with worries about slower growth or this very high inflation, they've been coming down on the side of like, let's raise interest rates, let's try and tackle inflation. But the point you make, I think, is a very good one. These real interest rates, the policy rates are still extremely low relative to the rates of inflation. And so at the end of the day, it's certainly not an early 1980s Paul Volcker kind of a situation that we have in the United States where they're moving aggressively to just sort of squeeze inflation out of the system.
Nick Benebrook of Wells Fargo. Nick, thank you. Just want to reset for people just tuning in. Rates unchanged at the ECB, but a ton of guidance. We got some new forecasts. They had to hike their inflation forecast. They had to cut their growth forecast. This market behaved like it was actually reading the statement, which is good news, because initially the bond market was pretty contained, because the first line of the statement, asset purchase program details come before rate guidance. And on asset purchase program details on the end of QE, they baked in some flexibility, this idea that they can address fragmentation with maturing, the reinvestment of maturing assets. But then you get down to the rates line and things start to get more interesting. They're looking to hike rates next month in July, go again in September, but in September opening the door to a bigger move. And then talking about sustained but gradual increases further down the road after September as well. What's interesting about this rate guidance so far, Tom, and of course everything had changed in the news conference, you've got an ECB not just getting you set up for July, but laying the groundwork for something we haven't seen in a long, long time from this European Central Bank, a tightening cycle. It's not for me to say whether they can achieve it or not, but that's what the guidance looks like this morning. Not just an ECB getting you set for a move in July, not just an ECB opening the door for a move in September, but leaving the door open to doing more after that.
In the instant, John, the thing to me that's so important here, and I alluded to the OECD yesterday, I'd really like to do a compare and contrast of the glide path of inflation that ECB sees versus OECD, or what Gita Gopinath and IMF saw a few weeks ago. I think it's a pretty benign feel of moving from 6.8% on down. Let's do this. We're going to reset right now on radio and television. We welcome all of you this morning, worldwide, across Europe and America, to 2 days of critical economics, finance, investment, in what we do. Jonathan Farrell, Lisa Bramwitz, and myself. And John, with the ECB, we go right away to the press conference, but then on to that inflation report in America tomorrow.
We're looking ahead to that tomorrow morning, Tom. We're looking at 10-year yields right now in Italy, out by 10 basis points, pushing 350.
That's a big move.
We're through 140 on a German 10-year. And Elisa, I think that's what this speaks to, is that rate guidance. At the moment, at least, that seems to be the driving force behind some of this.
It's not necessarily the offset that could come with purchases, which raises the question of what political motivation, what political incentive there's going to be to actually engage in a much bigger bond purchasing program in the peripheral regions as they raise rates, or whether they'll be able to. And again, I go back to the Japan market. When you try to push against the grain in terms of where traders want to take prices, how successful can you possibly be? And that might be the issue also facing the peripheral region.
The ECB forecast for inflation now for 2022, Tom, 6.8%. Coming into this, it was 5.1. It was 5.1, and now it's 6.8.
Let's stop here, folks, because this is when we've got a wonderful guest to drive this forward. John, I just want to emphasize 6.8% is culturally absolutely untenable for Europe. It's different than America.
And their GDP forecast, Tom, goes from 3.7% for this year down to 2.8%. it's not looking great, is it, in 22? And in 23 at 2.1%. That's below their forecast for 23, previously at 2.8.
John, let me start the data check here with Brent crude. I got to round it up to 124 a barrel. You know, the different stories here may go up, may go down, but that stasis on hydrocarbons right now is not friendly for Christine Lagarde.
Here's the uncertain one for euro dollar. Is this rate guidance currency positive or negative? In the near term, right now, the knee-jerk response is currency positive. Just a little bit, though. Dollar up a couple of tenths of 1% to 107.33. We've seen things turn around in a news conference before, so I don't want to cling to this market narrative too quickly. Things can change in 30 minutes' time, but based on the rate guidance so far, Tom, that seems to be the main focus for the bond market, with yields higher in Germany and much higher in Italy.
You can take the drama of Euro-Hungarian forint, which is actually an inside baseball important pair for Europe with great weakness in Hungary. But, John, I'm going to go back to Euro-Swissy right now, buttressed up near a 1.05. It's not inflammatory. It's not a breakthrough to some form of Swiss franc weakness. But nevertheless, I just want to emphasize the dynamics here into this press conference are tangible.
Tom, if there's a happy central banker, it's Mr. Jordan, the president of the SNB. I'm sure he's been waiting for this ECB to make a move for a long, long time.
We will continue here right now. Patrick Armstrong with us, Chief Investment Officer at Plurimi Wealth Management. Patrick, can you invest in Europe?
You can invest in Europe. What I did this morning is I actually shorted Italian bonds, BTPs. I do own multinational European equities, companies like ASML, which has a product which is in incredibly high demand. I own Shell. You can invest in Europe, but I think you want to think global context. I think Europe's falling into a recession. It's got a tightening central bank now for the first time in a very long time. But I don't think the US falls into a recession. I think China's probably going to be enormously stimulative in the second half of this year. So if you do invest in Europe, I want to play growth in other regions, not in Europe.
Patrick, I want to talk to you about the European bond market before we go out too broadly to international equities. Do you think this is achievable, addressing eventual fragmentation if it does materialize with reinvestments of PEP at the same time to raise interest rates in the way that they're guiding us towards this morning in the statement?
Yeah, I don't think so. I think that's so small. It matters at the margin. It's designed to give the market some confidence in the periphery bonds, but I didn't realize I was betting on fragmentation. That's a term I wouldn't have used before when I shorted Italy this morning. But I think that's something done deliberately, pointing out they know there is going to be consequences to the periphery as they end their QE program on July 1st. But it's words, and reinvestment is very small compared to the bond buying program that is in place right now.
So you're shorting Italian bonds. When do you start to see value again? What is sort of the threshold at which you start to say it's a buying opportunity?
If it blows out wide versus Germany, I'm actually short boons, and I have been short boons all year. I wish I was short Italy all year as well, but I've just put Italy on. I think if we see another 50 basis points wider against Germany, I'll probably start to close Italy, because I don't think it is going to be a disaster, but I do think the market pushes for some sort of response from the ECB where they put in something maybe a little bit more meaningful to make sure that the periphery yields don't blow out wider.
In other words, a more flexible purchasing program from their PEP and how much they're going to really dive into this market. Do you think that they can be effective in actually suppressing yields in that region, moving against both the inflation as well as the higher yields in the core?
We'll see at the press conference today. It'll be very important. Draghi was the master at it, whatever it takes, using words rather than explicit policy. If Lagarde really emphasizes that we're not going to let any widening of periphery, which can have an impact on inflation, have impact on confidence, if she really stresses that we'll do whatever it takes if these kind of things start to happen. In the statement that's out there right now, it doesn't say that. It says she's aware of it. So the rhetoric and the words may have just as much importance as the policy in the coming weeks.
Patrick, there's been so many doubts about whether the Federal Reserve can deliver on the rate hiking cycle that a lot of people are pricing. Can you run me through how likely it is that this ECB can deliver on gradual, sustained interest rate hikes?
I was surprised by that, because I didn't even think they'd want to commit themselves to that yet. I think the optionality that she's really been keen to create, she's almost given up some of that by saying this is the beginning of a gradual hiking cycle. I thought it was going to be maybe even 50 in July and then see what happens. But yeah, she set the groundwork for 25 in July, maybe even 50 in September, which I think is very unlikely. That's meant to appease the hawks, I suppose. But given where growth is, given the impacts of higher oil prices and energy prices on the European consumers and European manufacturing, I think it's going to be very difficult to get a hiking cycle started in Europe. If it does start, it's great news. Something very good has happened in the economy.
I assume you also think then their GDP forecast of 2.8% for this year is pretty optimistic, maybe overly so?
I do. I think Europe's falling into recession. I do believe Germany's committed to moving away from Russian oil and probably natural gas towards the end of the year, and that's very stagflationary. That's a huge hit to manufacturing, huge hits to jobs, and higher prices as well.
We're back to that old equity playbook, aren't we? Buy Europe, but buy companies listed in Europe that have international exposure. Is that the play now, Patrick?
That's the play for me, and that's been the play for me for quite a long time. Europe's facing a lot of issues with growth and prices, and for the first time not having negative interest rates, which may even be a positive for the banks, but I still prefer to own the bank bonds rather than the bank equities with this backdrop.
Patrick Armstrong, thank you, sir. As always, Plurimi Wealth and Patrick Armstrong going into an ECB news conference, Lisa, 21 minutes away.
James Stanley over at the Daily Fix put this out, and I thought this was interesting. The ECB taking the most dovish route when trying to sound hawkish. We'll hike in a month, and then after we'll see, right? I mean, how much is this message? And we are hearing people look at this message and say it's trying to sound hawkish, but actually has a dovish tilt to it. How do they parse that line? And I guess
What's
we'll find out.
What's the time on that note? Is
that
it got a timestamp?
Yeah, 8:03 a.m.
Do you think he read it? I think maybe he read it 15 minutes in. Sure, perhaps he read it. I've got some doubts as to whether people read the full.
No, he was quoting the full statement, and I think that, and honestly,
no, it's not aimed at him in general, just broadly.
And I think that he's not wrong. Some people are going to agree with that. I mean, Nick Benenbrook seemed to indicate the same thing, and that's why you're seeing such a lack of conviction around the euro trading, because it's unclear what they're saying. They're trying to basically appease every constituent here. So where does Christine Lagarde come out? Perhaps the rhetoric will be most important.
You try and please everyone. Everyone often ends up unhappy. And Tom, there's always a lot of people unhappy when it comes to European central bank policy. I'm with Patrick. Surprised they opened the door to gradual sustained stuff further down the line. That's a rate hiking cycle that we're talking about, not a couple of moves and a wait and see. That's a little bit more than that.
I'm going to go to what we saw at the Fed press conferences, and John, you allude to this important press conference in 20 minutes. It could surprise. She could cut this the other way after these statements.
At 8:30 Eastern Time. Looking forward to it. A news conference just around the corner. Looking forward to this. Have been all morning. Julian Emmanuel of Evercore. He has got a 4,300 price target on the S&P, down from 4,800. He's got a bear case in there. His bear case is 2,900 on the S&P 500. Julian Emmanuel of Evercore joins us next on Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The European Central Bank has just made it official. It will end asset purchases July the 1st and also begin raising interest rates for the first time in 11 years. Plus, the ECB boosted its inflation forecast for this year from 5.1% to 6.8%, and it lowered its growth projections for this year and next. On Capitol Hill, the House has passed a package of gun legislation that includes raising the minimum age to buy many semi-automatic rifles from 18 to 21. But the move is mostly symbolic. It will ultimately be set aside for whatever compromise plan emerges from negotiations over in the Senate. And House Democrats are taking their investigation into the January 6th riot at the Capitol to prime time. Tonight's opening televised hearing will include testimony from a police officer injured that day and a documentary filmmaker who captured the events. Republican lawmakers have planned counter-programming. And Jack Ma's Ant Group now says it currently has no plan to revive the IPO that was scuttled almost 2 years ago. Earlier, Bloomberg reported that regulators had established a team to reassess the fintech's giant share sale plans. The original Ant IPO would have been the biggest listing ever. And Target has raised its quarterly dividend by 20%. The new payout implies a yield of about 2.8%. That is a full percentage point above Walmart's yield. The move comes after Target lowered its profit outlook for the second time in less than a month. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
We're prepared for a substantial economic slowdown towards the end of this year and into next year. That's why central bankers raise interest rates, right? It is to dampen the level of economic activity, and we think they're going to be successful in containing inflation, but we think there's going to be an impact on economic growth. We don't think that it's going to be a severe recession.
No hurricanes over at Standard Chartered. That was Bill Winters there, the CEO of Standard Chartered Group. From New York City this morning, good morning. Equity futures down about 1/10%, up rather by 1/10%. Unchanged on the NASDAQ 100. A big lift in the Italian bond market. Yields higher on 10 years by 15 basis points on a 10-year, on a 2-year by 10. We'll run you through the ECB stuff in about 12 minutes' time. Tom, we've got to start with Julian Emmanuel over at Evercore. The base case was 4,800. It's now 43. The bear case is 2,900. That's a lot of downside on that bear case from Evercore, Tom.
John and Lisa want to get to that. I just want to do some internal housekeeping here on Evercore ISI. Julian Emmanuel, how does Ed Hyman's acclaimed granularity and study of the American corporate economy infect this new view that you have?
Well, what it does, Tom, is it reinforces the idea that our base case continues to be that there isn't going to be a recession. And we've had waves of concern, obviously economic hurricanes maybe offshore, so on and so forth. But Ed's granular data says we are not at the point where there is likely to be a recession, yield curve or no yield curve. And frankly, what it does, though, is when you look at the macro environment around you, it increases the probability of a recession off in 2023.
Julian, why the change? Why the change yesterday evening?
Because really, when you look at the move off of the low on May 20th, and you think about, how these kinds of bottoms form, and to be clear, our view is that you are in the midst of forming a non-recessionary bear market bottom. That's the base view. But what we haven't seen is that fundamental catalyst, and we all know that the biggest fundamental catalyst is falling energy prices, and, we look for it every day, and it is not happening. But then the other thing is volume. It tends to be when you get bottoms of that nature that you see surges in volume, real concerted buying interest. That's lacking.
Julian, the downside case, the bear case, 2,900, is that the recessionary bear case, and where does the number come from?
So basically, if you look at recession bear markets of the last 100 years, the average is down around 41%. That gets you to 2,900. We're not going there unless we get a recession.
You talk about oil being the distinguishing feature between that recession, that downside scenario, and not. What is the pain point in oil that you're looking for?
Well, so, Lisa, I think it's pretty fair to say that when you think about the consumer psychology, and look, you heard the president address it last night on late night TV, is that the psychological pain point has already arrived, whether it's $5 a gallon or whatever you want to define that as. But frankly, when you look at historical data, the longer prices stay elevated at this level, the closer you get to the actual pain point.
I couldn't believe, Lisa, what the president said last night on late night TV.
He was very real in trying to address the American people. Julian, you say that, it's about how sustained this is. What about the bull case? What has to happen in order to get to 4,800 at a time when people want to hear the bearish case and want to understand how much downside they have?
We need to see visibility into the idea that this so-called softish landing is really going to crystallize. And our fear here is that, again, there's only so much the Fed can do to get, to put a lid, and not only put a lid, but take energy prices down. And really, they can't do much at all. And that, we've seen more hawkish rhetoric out of global central banks in the last week. We're likely to see that next Wednesday. And the fear is that, that it doesn't move inflation materially lower. If you get that break in inflation and you get consumer spending to stay hold in there, that's where we get the upside.
And that's the September pause as well, Julian. Do you need the September pause to get that 4,800 bull case?
Not necessarily, and frankly, the whole concept of both volatility around the macro and economic volatility, whether driven by inventories or a number of different issues, it is such a long time between now and September. The picture is likely to look almost entirely different. So we don't know exactly what monetary policy is going to require, but we do know that inflation is going to need to turn down meaningfully without a turn down in growth.
Julian, you've got three numbers here, 4,300, 4,800, 2,900. I'll have a wager with you, $10, that the only one you get asked about today is the 2,900. Julian, thank you, buddy. As always, Julian Emanuel there of Evercore, jumping on the phone for us as he downgrades the outlook. Lisa, 2,900, the bear case, the bull case, 48, something in between, the base case, 4,300.
John, it's not a bear case, it's a Bramo case.
To your point, people want to hear the downside risk because people feel like things are heading in a negative direction. They want to understand how much protection they're going to need and what could potentially transpire to get there. If oil prices stay where they are now for a prolonged period, we could get there. That is what we were just hearing from Julian Emanuel. It's shocking to me because we hear from almost every oil analyst, with the exception of Ed Morse, that oil prices are going to stay at this level. So that's where you start to get what is the downside and where does the consumer become most vulnerable?
I'll tell you what's not staying still right now is the Italian bond market. Lisa, the drumbeat begins, it gets louder. 6 minutes away, an ECB news conference with President Lagarde. Yields up 15 basis points on an Italian 10-year, on a 5-year up 17, up 12 on a 2-year note. There was a line in there about addressing fragmentation. We're going to need some more detail on that in the news conference, I think, to really temper any concerns about what could happen here. And then you've got this guidance, not just for July, not just for September, but for the size of the move in September, opening the door to something bigger perhaps, and also just a sustained move further down the road. That's an ECB talking about a rate hiking cycle, not just a couple of hikes.
Italian bond traders are hearing that rate hiking cycle. They are not hearing the flexibility from the ECB to possibly buy other bonds in other countries. That is not enough conviction to really give a ceiling to these yields.
Can that ECB president, Tom, lean into the uncertainty, the risks around that view, around that sustained tightening cycle further down the road?
You know, I'm looking at a fancy mathematical chart here of the Italian 10 here, John, and what you need to know is from the beginning of the year, you've enjoyed a price move on that piece from 100 down to 80. You've lost 20% of value arguing about the ECB. I would suggest she's got to lead with that. I should also note, based on a lot of what ifs and setups, it's a very elegant chart to be higher yield and lower Italian bond price.
Also, just a note for the ECB watchers out there. Interesting, curious that the forecasts were in the statement, because typically we have to wait for the news conference.
Yeah,
for that.
Explain that, Frankfurt.
Not sure, Tom.
one.
I imagine that they put that in there just to justify the rest of it, the guidance around rates and monetary policy more broadly. It's going to be an interesting one, potentially. The ECB news conference coming up with President Lagarde, full coverage right here on Bloomberg TV and on Bloomberg Radio. She might want to avoid that, Tom.
She's not going to.
Unchanged on the S&P. On the Nasdaq 100, we are just about negative. We were enjoying a small morning of gains and now just rolling over a little bit, down 0.1%. From New York, this is Bloomberg.
En nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a couple of seconds' time, we'll have a news conference with the ECB President Christine Lagarde. Before we get there, we're just waiting for some economic data in the United States. Jobless claims just seconds away. Futures unchanged on the S&P 500. Unchanged also on the Nasdaq. Briefly, we're now down about 1/10% there. Yields on treasuries tracking yields higher in Germany, in Italy. Yields on treasuries higher by 4 basis points to 3.0641% on a 10-year. Claims data due any moment. The estimate 206,000, the previous number 200K. That number not out yet. We'll wait for that before we cross over to the ECB president. Yeah. But clearly, Tom, the move in treasuries tracking what we're seeing in Germany, what we're seeing in Italy.
Yeah, 307 on the 10-year yield, make it a 306, and you get out a couple more beeps and you get through the autumnal 2018 higher yield. And, you know, again, I'm going to go, John, to the idea of a regime change. Thank you, Professor Bullard. And the idea of the regime change being something Christine Lagarde has to address. John, there are those jobless numbers.
Yeah, the wrong kind of upside surprise. Historically still very low, but 229K against an estimate of 206 and a previous number of 200K-ish as well, Lisa. So an upside surprise and the wrong kind of upside surprise for jobless claims.
It takes me back to what Rick Reeder said on your show, how he was talking about how this might be the last solid jobs report that we've seen, the one that we got on Friday. How much are companies, whether it's Amazon or even Microsoft, going to start pairing workforces that they built up for a very different economy during the pandemic? Are we starting to see that, or is this just simply a normalizing market going back to something akin to what we saw pre-pandemic?
John, very quickly here, 229 claims are getting back to a January-ish level here of this year, coming down from the pandemic vector that we saw.
A bit of movement in Amsterdam, some photos being taken. We can cross over there and catch up with the ECB President Christine Lagarde as she gives us her view on the path ahead for an ECB looking to hike interest rates. The photo's still being taken, Tom.
Yeah.
Typically, I'm usually on time. Christine Lagarde is too.
No, I thought it was some nice.
Get a few more photos in, a bit of elevator music.
No, I thought it was ABBA.
It's not Frankfurt, is it? In Amsterdam,
no,
they're just
Amsterdam.
a little bit more
doing it a little differently.
Casual.
A warm welcome.
And a warm welcome. There you go. Should we listen in now?
Today and also yesterday, the Netherlands Bank had the honor of hosting the ECB's Governing Council here in Amsterdam. It was the first time in 20 years that the Governing Council came to the Netherlands again. Today is also the first time that the ECB hosts this press conference again in physical format, and I hope it will add to the joy. Thank you. Over to you, Wolfgang.
Thank you very much, Governor Knot. We are also joined here on stage by President Lagarde and by Vice President de Guindos. This is a hybrid meeting, and for those who join us remotely, I would like to ask you, as always, to turn your camera and your microphones if you ask questions. I will now give the floor to President Lagarde. President Lagarde, please.
Thank you very much, Wolfgang, and thank you so much, Klaus. It's a real pleasure being here in Amsterdam, but we'll come to that later. Let me first wish you all in the room a good afternoon as well. The Vice President and myself welcome you to our press conference. I would like to thank President Knot for his kind hospitality and express our special gratitude to his staff and for the excellent organization of today's meeting of the Governing Council. High inflation is a major challenge for all of us. The Governing Council will make sure that inflation returns to our 2% target over the medium term. In May, inflation again rose significantly, mainly because of surging energy and food prices, including due to the impact of the war. But inflation pressures have broadened and intensified, with prices for many goods and services increasingly strongly. Eurosystem staff have revised their baseline inflation projections up significantly. These projections indicate that inflation will remain undesirably elevated for some time. However, moderating energy costs, the easing of supply disruptions related to the pandemic, and the normalization of monetary policy are expected to lead to a decline in inflation. The new staff projections foresee annual inflation at 6.8% in 22, before it is projected to decline to 3.5% in 23 and 2.1% in 24, higher than in the March projections. This means that headline inflation at the end of the projection horizon is projected to be slightly above our target. Inflation, excluding energy and food, is projected to average 3.3% in 22, 2.8% in 23, and 2.3% in 24, also above the March projections. Russia's unjustified aggression towards Ukraine continues to weigh on the economy in Europe and beyond. It is disrupting trade, is leading to shortages of materials, and is contributing to high energy and commodity prices. These factors will continue to weigh on confidence and dampen growth, especially in the near term. However, the conditions are in place for the economy to continue to grow on account of the ongoing reopening of the economy, a strong labor market, fiscal support, and savings built up during the pandemic. Once current headwinds abate, economic activity is expected to pick up again. This outlook is broadly reflected in the Eurosystem staff projections, which foresee annual real GDP growth at 2.8% in 22, 2.1% in 23, and 2.1% in 24. Compared with the March projections, the outlook has been revised down significantly for 22 and 23, while for 24 it has been revised up. On the basis of our updated assessment, we decided to take further steps in normalizing our monetary policy. Throughout this process, the Governing Council will maintain optionality, data dependence, gradualism, and flexibility in the conduct of monetary policy. First, we decided to end net asset purchases under our asset purchase program as of July 1st, 2022. The Governing Council intends to continue reinvesting in full the principal payments from maturing securities purchased under the APP for an extended period of time past the date when it starts raising the key ECB interest rates, and in any case, for as long as necessary, to maintain ample liquidity conditions and an appropriate monetary policy stance. Second, we undertook a careful review of the conditions which, according to our forward guidance, should be satisfied before we start raising the key ECB interest rates. As a result of this assessment, the Governing Council concluded that those conditions have been satisfied. Accordingly, and in line with our policy sequencing, we intend to raise the key ECB interest rates by 25 basis points at our July monetary policy meeting. Looking further ahead, we expect to raise the key ECB interest rates again in September. The calibration of this rate increase will depend on the updated medium-term inflation outlook. If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at our September meeting. Third, beyond September, based on our current assessment, we anticipate that a gradual but sustained path of further increases in interest rates will be appropriate. In line with our commitment to our 2% medium-term target, the pace at which we adjust our monetary policy will depend on the incoming data and how we assess inflation to develop in the medium term. Within the Governing Council's mandate, under stressed conditions, flexibility will remain an element of monetary policy whenever threats to monetary policy transmission jeopardize the attainment of price stability. The decisions taken today are set out in full in a press release available on our website. I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. Looking at the economic activity, in the near term, we expect activity to be dampened by high energy costs, the deterioration in the terms of trade, greater uncertainty, and the adverse impact of high inflation on disposable income. The war in Ukraine and renewed pandemic restrictions in China have made supply bottlenecks worse again. As a result, firms face higher costs and disruptions in their supply chains, and their outlook for future output has deteriorated. However, there are also factors supporting economic activity, and these are expected to strengthen over the months to come. The reopening of those sectors most affected by the pandemic and a strong labour market with more people in jobs will continue to support incomes and consumption. In addition, savings accumulated during the pandemic are a buffer. Fiscal policy is helping to cushion the impact of the war. Targeted and temporary budgetary measures protect those people bearing the brunt of higher energy prices while limiting the risk of adding to inflationary pressures. The swift implementation of the investment and structural reform plans under the Next Generation EU programme, the Fit for 55 package and the Repower EU plan would also help the euro area economy to grow faster in a sustainable manner and become more resilient to global shocks. Looking at inflation now. Inflation rose further to 8.1% in May. Although governments have intervened and have helped slow energy inflation, energy prices stand 39.2% above their levels 1 year ago. Market-based indicators suggest that global energy prices will stay high in the near term, but will then moderate to some extent. Food prices rose 7.5% in May, in part reflecting the importance of Ukraine and Russia among the main global producers of agricultural goods. Prices have also gone up strongly because of renewed supply bottlenecks and because of recovering domestic demand, especially in the services sector, as our economy reopens. Price rises are becoming more widespread across sectors. Accordingly, measures of underlying inflation have been rising further. The labour market continues to improve, with unemployment remaining at its historical low of 6.8% in April. Job vacancies across many sectors show that there is robust demand for labour. Wage growth, including in forward-looking indicators, has started to pick up. Over time, the strengthening of the economy and some catch-up effects should support faster growth in wages. While most measures of longer-term inflation expectations derived from financial markets and from expert surveys stand at around 2%, initial signs of above-target revisions in those measures warrant close monitoring. Let's turn to the risk assessment. Risks relating to the pandemic have declined, but the war continues to be a significant downside risk to growth. In particular, a major risk could be a further disruption in the energy supply to the euro area, as reflected in the downside scenario included in the staff projections. Furthermore, if the war were to escalate, economic sentiment could worsen, supply-side constraints could increase, and energy and food costs could remain persistently higher than expected. The risks surrounding inflation are primarily on the upside. The risks to the medium-term inflation outlook include a durable worsening of the production capacity of our economy, persistently high energy and food prices, inflation expectations rising above our target, and higher than anticipated wage rises. However, if demand were to weaken over the medium term, it would lower pressures on prices. Let's have a look now at the financial and the monetary conditions. Market interest rates have increased in response to the changing outlook for inflation and monetary policy. With benchmark interest rates rising, bank funding costs have increased, and this has fed into higher bank lending rates, in particular for households. Nevertheless, lending to firms picked up in March, and this was because of the continued need to finance investment and Nevertheless, lending to firms picked up in March, and this was because of the continued need to finance investment and working capital against the backdrop of increasing production costs, persisting supply bottlenecks, and lower reliance on market funding. Lending to households also increased, reflecting continued robust demand for mortgages. In line with our monetary policy strategy, the Governing Council has undertaken its biannual in-depth assessment of the interrelation between monetary policy and financial stability. The environment for financial stability has worsened since our last review in December 21, especially over the short term. In particular, lower growth and increasing cost pressures, as well as rising risk-free rates and sovereign bond yields, could lead to a further deterioration in the financing conditions faced by borrowers. At the same time, tighter financing conditions could reduce some existing financial stability vulnerabilities over the medium term. Banks, which started the year with solid capital positions and improving asset quality, are now facing greater credit risk. We will watch these factors closely. In any case, macroprudential policy remains the first line of defense in preserving financial stability and addressing medium-term vulnerabilities. So, summing up, Russia's unjustified aggression towards Ukraine is severely affecting the euro area economy, and the outlook is still surrounded by high uncertainty. But the conditions are in place for the economy to continue to grow and to recover further over the medium term. Inflation is undesirably high and is expected to remain above our target for some time. We will make sure that inflation returns to our 2% target over the medium term. Accordingly, we decided to take further steps in normalizing our monetary policies. The calibration of our policies will remain data-dependent and reflect our evolving assessment of the outlook. We stand ready to adjust all of our instruments within our mandate, incorporating flexibility if warranted, to ensure that inflation stabilizes at our 2% target over the medium term. We are now ready to take your questions. Thank you.
Thank you, President Lagarde. And the first question goes to Caroline Look of Bloomberg News. Caroline, please.
Good afternoon, President Lagarde. I have two questions. Firstly, one argument that you've made rather frequently over the last few months is that the euro area economy is in a very different place than other advanced economies. And even so, 3 months after the Fed started raising interest rates, you are now looking to start doing the same. So is this still about a difference, or are we talking more about a delay at this point? And second of all, could you tell us a little bit about whether this week's discussion focused at all on fragmentation risks and whether there were any new proposals made to address them? Thanks.
Thank you very much. The Governing Council, on the occasion of this meeting organized outside of Frankfurt in beautiful Amsterdam, thanks to the National Central Bank of the Netherlands, focused primarily on the challenge of high inflation facing the euro area and on taking further steps in our normalization path that we started, I remind you, back in December. So it's not a question of catching up. It's a question of using all the tools that we have in order to deliver on our mandate of price stability and in order to bring inflation down to target over the medium term. And our analysis was obviously that inflation was, as we said, undesirably high, and that we had to take the steps that I have identified in the monetary policy statement. And I would like to add that it's not just a step, it's a journey. We started back in December. We gradually, over the course of time, put ourselves in a position to move away from unconventional monetary policy, which will actually be taking place as of the 1st of July, in order to use more conventional tools, which are the interest rates. And on the issue of the interest rates, we also identified a path which is not only limited to a particular move, but a series of moves over the course of the next few months, depending on the medium-term outlook of inflation. On the second issue, we have to have the right monetary policy stance. That is critically important, and that is what we are doing with that identification of the journey that I just mentioned. But we also have to make sure that our monetary policy is transmitted throughout the entire euro area. And to that end, obviously, we need to make sure that there is no fragmentation that would prevent the adequate monetary policy transmission throughout the entire region. We have existing instruments. I think that we have described them in the past. It is obviously the reinvestment capacity that we have under the PEP, which is, I remind you, a complete reinvestment package that totals 1.7 trillion euros that will be reinvested with total flexibility if warranted across time, across jurisdictions, across products. And if it is necessary, as we have amply demonstrated in the past, we will deploy either existing adjusted instruments or new instruments that will be made available. But we are committed to proper transmission of our monetary policy, and as a result, fragmentation will indeed be avoided to the extent that it would impair that transmission.
Thank you, President. The next question goes to Mark Boinderman of NRC Handelsblatt over here.
Thank you, President Lagarde. My first question is whether today's decision was unanimous, Could you give us a flavor of the discussion? And secondly, the ECB is now communicating that in September it could raise rates by more than a quarter of a percentage point. Did you consider already giving that message for the July meeting? Thank you.
Well, thank you very much for your question. And as I said, we had very productive discussions in Amsterdam, and these discussions concluded with a unanimously approved decision. And as I said, we are on a journey, but this is clearly an important step in that journey, given that we are actually deciding to end net asset purchases under the APP as of the 1st of July, which effectively means that we stop before, for all sorts of market operation conditions. But we are also setting a path in which July and then September are the next first steps along the way of hiking interest rates. And while we intend to raise interest rates by 25 basis points in July on the basis of the assessment that we conducted today, we also indicate that, and I will read very carefully for you because it was obviously a sentence that we drafted carefully in order to capture our commitment. We also indicated that I'll read you the whole paragraph actually because it's a really important one. So we undertook a careful review of the conditions, which according to our forward guidance, you all remember the forward guidance with the three conditions, should be satisfied before we start raising the key ECB interest rates. Well, we concluded that these three conditions were satisfied. And accordingly, in line with our policy sequencing, for those of you who wonder why we didn't do it today, well, we have a sequencing in place that dictates, and we want to be predictable on that front, that we first of all stop net asset purchases and then we look at interest rate hikes. So in accordance with our policy sequencing, we intend to raise the key ECB interest rates by 25 basis points at our July monetary policy meeting. And that's the September that you were asking me about. Looking further ahead, we expect to raise the key ECB interest rates again in September. The calibration of this rate increase will depend on the updated medium-term inflation outlook. If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at our September meeting. That is pretty precise as a commitment, but it is also a factor of how the situation evolves. So if the medium-term outlook persists as we see it now, or even deteriorates, which of course we don't wish, but it could happen, then obviously the increment will be higher than 25. And then we go further because we take a third step along that journey to indicate what we will do beyond September, which is also the anticipation that further rates hikes will be necessary on the basis of the data that we collect. Thank you.
Thank you, President Lagarde. And the next question goes to Bart Meyers of Reuters. Bart, please. Here. You get a microphone. Yeah.
Thank you, Bart Meijer for Reuters. So just to make that perfectly clear, follow up on your last answer, does that mean that if the inflation outlook is not cut back down to 2%, that we will see a 50 basis point increase in September? And secondly, on the fragmentation. No, sorry, I lost that question. What I wanted to ask.
Take your time, you will find it.
Yes, no, that's all right. You said that you wanted to increase the rates by September. Does that mean all three rates? Thank you.
Yeah, that's a good question. I don't want to give a reading exercise because some of you occasionally comment on the fact that I read too much, but this one I really want to read it a bit because it matters and every word matters, including plural versus singular, to your point. So what we say is, looking further ahead, we So today we say that. We expect to raise the key ECB interest rates, the 3 of them, again in September. Most likely. The calibration of this rate increase will depend on the updated medium-term inflation outlook. And here's the important one. If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at our September meeting. So I think that you took the example of if you are at 2.1% in 2024 or beyond, then the increment adjustment will be higher. The answer is yes.
Thank you, President Lagarde. And the next question goes to Annette Weisbach of CNBC. Annette, please, here in the middle.
President Lagarde, thank you very much for taking my question. I have one on what are you expecting in terms of time lag? If you raise rates in July, when will you see an effect on inflation and inflation expectations? And will that ultimately also mean that you have to lift rates to your neutral rate? And that would be my second question, because I think there's a lot of guessing around what you think the neutral rate actually is. Is it 1.5? Is it 2% for the euro area? Perhaps you could give us a bit more of an insight. Thank you.
So do we expect that our July interest rate hikes will have an immediate effect on inflation? The answer to that is no. And I would like to develop that a little bit. First of all, because of the anticipation of our monetary policy, because of the inflation and growth outlook, financing costs have already moderately but significantly increased, whether you look at corporate bonds, whether you look at sovereign bonds, whether you look at bank, of course. Those financing costs have increased. And with the signal that we're giving here, particularly concerning the short-term rates, this signal will continue to have an impact on financing costs. Now, typically, monetary policy decisions have a longer-term impact in relation to inflation itself. So we have to stay the course, be determined, committed to delivering the 2%. But we cannot expect that to happen on the 22nd of August for a decision that, 22nd of July for a decision that we would have made in July. On the other hand, because you mentioned inflation expectations, we observe that inflation expectations are well anchored. And we certainly want to indicate to those who form expectations, whether they're markets, whether they are experts, whether they're consumers, that we are determined to delivering on our target of 2% in the medium term. And therefore, expectations should absolutely remain anchored because we will deliver. Oh, the neutral rate. This is a topic that we have deliberately decided not to have on the occasion of this Governing Council meeting. And I'm sure that we will ad nauseum argue as to whether it is 0.96 or 1.97 or beyond or below or whatever. Suffice to say that the neutral rate over the course of time, for multiple reasons having to do with productivity, with demographics and all the rest of it, has gone down. But where it stands exactly, we have decided not to discuss it on this Governing Council meeting. And believe me, we had plenty to discuss. So we saved a little bit for later. And, you know, to be fair as well, it's not something that you can observe and determine with precision today. Is as you get closer, we will understand better where exactly it stands. And we will debate it. I have no illusion on that. Thank you.
Thank you. And the next question goes to Dan Balacher of Volkskrant. Dan, please.
Good afternoon. Thank you for taking my question. Is the end of the asset purchasing program a good time for you maybe to adjust the forward guiding policy? Because when it was introduced in 2013, it was meant to manage market expectations. But now it seems like the ECB would have stopped the purchases earlier if not for the promises made, even though there was an extraordinary inflation-inducing event like the war in Ukraine? Is the tail, financial markets, not wagging the dog, the ECB, instead of the other way around? My second question is related to this one. The ECB believes inflation will fall down back to target by 2024. But for most of the past decade, the ECB also consistently thought that the inflation rate, which was then too low, of course, would converge to its target, and that also didn't happen. So how firm are your beliefs that you are going to succeed now, as historical experiences do not imply great credibility?
First of all, on the issue of forward guidance, I'm assuming that you're referring to the forward guidance relating to asset purchases. Yeah. So if you look at that forward guidance, we have actually changed it. If you recall, the forward guidance that we had referred to favorable financing conditions and to accommodative, there was a qualifier as well, but it referred to the accommodative aspect of our monetary policy. We have changed that, and if you look at the third paragraph on the second page, we do refer to the fact that we will do so for as long as necessary to maintain ample, not favorable, ample liquidity conditions and an appropriate monetary policy stance. So we take account of the change that has indeed taken place. And you're right, we are in a different universe. A lot of the tools, the forward guidance, the considerations over the last 11 years had to do with exactly the opposite movement, trying to bring inflation up because it was too low and often at risk of deflation. Now we are in the opposite situation, where inflation is too high and we need to bring it back to our target of 2% over the medium term. Now, how confident are we about our projections? First of all, I'd like to say that our staff does the best work they can do and apply their whole consciousness and professionalism to producing those projections. Second, those projections are not just the ECB. The projections that you have in front of you are the projections of the entire Euro system. So it's the ECB and 19 national central banks, including the great Bank of the Netherlands, which has actively and always actively participates in this exercise. So it's a cohesive work that is done, that is tedious, that is iterative, and that really checks everything. Third, it is clear that the massive energy prices hike and the war in Ukraine and the fast pace of the recovery have taken all forecasters by surprise. You know, I thought you would ask me a question like that. So what did I do? I looked at other, I hope I can find it now. Anyway, it doesn't really matter if I don't find it. The point being that all international institutions, all forecasters of repute have actually made the same mistake of underestimating or not anticipating some of the developments, such as the war, such as the energy crisis. Fourth point, I think we, the Euro system, and the ECB in particular, we are the only central bank which has gone back to the work that was done, which has looked under every stone to understand where the errors came from. And I use the word errors with some trepidation because it's misforecasting caused by very unpredictable events. 3/4 of the forecasting errors is actually attributable to energy prices, and the rest is largely attributable to bottlenecks that have lasted longer than had been anticipated. So, again, they do everything they can as well as they can. They make the same kind of forecast as other international institutions. Events that have developed are not captured in either models or sometimes just the sheer imagination of us all when we talk about the war at the doorstep of Europe. And fourth, we do the introspective exercise of trying to find out where it went wrong, and we will continue doing so in the future because we have to improve, no question.
Thank you. And the next question goes to Mark Schreurs of Börsenzeitung. Mark, please.
Yes, thanks for taking my questions. The first one is on reinvestments. In the past, you've stressed several times the importance of the stock of assets compared to the flow. Now you have reaffirmed to reinvest, especially the PEP payments, principal payments, at least until the end of 2024. That means a huge monetary stimulus for years. Is that appropriate if you, at the same time, are talking about normalizing monetary policy? And the second one, just for clarification, why do you today already exclude a 50 basis point hike in July?
On the reinvestment policy that we decided for PEP and for the APP, both of them will now be operative as of the 1st of July for APP and has already begun for PEP. It is a matter that we will be discussing within the Governing Council, which we have decided not to debate today. We had, as I said, plenty to do already in the last couple of days, but we will be looking at it. And I have to tell you something. There are some of us on the Governing Council who will be interested not only to deploy flexibility, if warranted, on classes of assets, by jurisdictions, over temporality, but some of us are also interested in looking at how we can support the financing of the measures needed against climate change. I said already before that a green LTRO was interesting to consider. I think the reinvestment decisions that we will make in the coming months and years might also be inspired by this concern that we have. Okay? So that's point number one. Your point number two is, why not 15 July? Well, we are coming out of 11 years of no interest rate move. We are on our path to exit negative interest rates soon. It is good practice, and it is actually often done by most central banks around the world, to start with an incremental increase that is sizable, not excessive, and that indicates a path. As I said, the decision that we have made today are not just one intention of one single month of July. It's a whole journey that will take us back to the 2% target in the medium term. We also want to observe how markets are going to operate. And as I have mentioned, we couple our July determination with our September indication.
Thank you. Next question, Martin Arnold. I think you raised your hand, of the Financial Times.
I did. Thank you for taking my two questions. Hello, Madame Lagarde. Could I ask, first of all, is this announcement today a signal that you are dropping gradual normalization in preference for a whatever it takes approach to tackling undesirably elevated inflation? And secondly, could I ask on tackling fragmentation that you mentioned earlier, the new instruments that could be designed and launched, would those only be designed and launched once the existing instruments, i.e. PEP reinvestments, have been fully utilized? Thank you.
I want to take you back to the monetary policy statement, because I think that the key principles that we will be inspired by in order to be predictable by you, but also to set the rules according to which we will proceed, are captured on the top of page 2 and say the following: throughout this process, the Governing Council will maintain optionality, data dependency, gradualism, and flexibility in the conduct of monetary policy. So, all four will matter. And there will be circumstances when one might be more important than another. And there might be other circumstances where the pecking order will change. So I think by doing that, we are trying to have as much optionality as we can, be able to use flexibility if and when warranted and necessary, be as data dependent as we have demonstrated and will continue to demonstrate, and also deploy the gradualism that will be appropriate given the circumstances. And I think in times of great uncertainty, gradualism is probably appropriate, more so than if the path is clear, well identified, and we all understand where we are heading. On the second issue, I just want to yet again come back to this issue of fragmentation, because I know that this is dear to some. I just want to reiterate that within our mandate, we are committed to preventing fragmentation risks in the euro area. Fragmented financial markets would obstruct the monetary policy transmission and undermine the possibility for the ECB to achieve its price stability mandate. And that's the reason we monitor constantly. And that is the reason we have available at hand all the dimensions of flexibility that can be applied to our reinvestment policies under the APP, under the PEP, because flexibility conditions are clearly associated with PEP to the extent that it relates to consequences of the pandemic. But we, as I said, we know how to design and we know how to deploy new instruments if and when necessary. We've demonstrated that in the past. We will do so again.
Thank you. And the next question goes to Eric Albert of Le Monde. Eric, please.
Thank you very much for taking the question. Given the scale of the inflation, it's no surprise that the ECB is acting. But still, could you explain, it's an inflation that's imported, that's mostly a tax on consumption, really. What can interest rate do against this kind of inflation? And also, could you come back a little bit on why do you not expect too much of a risk of a recession? You did explain a little bit, but could you expand on that, please?
Well, thank you for your question. It is a case that a large portion of the inflation that we have analyzed is attributable either directly or indirectly to terms of trade, what you call imported inflation, whether it is energy, exogenous bottlenecks, that is clearly so-called imported inflation. But it's not it, because we are clearly seeing an unprecedented 75% of the items considered to measure inflation being above 2%. And that applies to non-energy industrial goods, it applies to services, and it is partly a factor of the energy pass-through, but not only. Number two, we are also very attentive to wages, wage negotiations, and to the risk of second-round effect and potential spiraling. We are not seeing the risk of spiraling at all, but we are seeing wage increases that have picked up, particularly since March, and that, as we indicated in the monetary policy statement, would not be entirely surprising, whether it is by way of catch-up effects or by way of general wage increase. We're also aware that Germany, for instance, will implement the minimum wage as of October 1st. So it is largely, and certainly much more so than in the US, for instance, to come back to your questions about the difference between the EU and the US, it is more so imported inflation than it would be attributed to overheating demand, as is probably more so the case in the US. But it's spreading more broadly than strictly speaking, in energy-related sectors. And then, you had another question. You know, it's a bit of a story of, on the one hand, on the other hand, the current situation of the economy. There is probably more of the negative hand than the positive hand, but we have both. And on the negative front, we clearly have the continued impact of the war, in particular, the reactivation of lockdown measures in China, which went away, then are maybe slightly coming back, the bottlenecks impact that it induces and the dampening effect it has on growth, not to mention the reduced disposable income that some of the households are suffering. But on the other hand, you have entire sectors of the economy that are recovering. And when you look at the tourism industry, the accommodation industry, hospitality, those sectors are really recovering at a fast pace. And we looked at, on a per-country basis, at the prices of hotels, of restaurants. It is clearly on its way up, with a strong demand in those sectors in particular. And we cannot exclude also, we hope, that remains to be seen, that some of the factors that have a dampening effect on growth will gradually fade a bit.
Thank you. And the next question goes to Eshe Nielsen of the New York Times. Eshe, please.
Thank you. Good afternoon. You talked of raising all three key interest rates. Is the intention to keep the spread between those consistent as they have been so far, or will that change further into the future? And then my second question is on, can you talk a little bit more about the conditions that would trigger the flexibility within PEP, and do they have to be specific to the pandemic being the causes, or could you say that actually consequences of the war in Ukraine or some other shock that we haven't envisioned yet could also encourage that flexibility usage? Thank you.
Thank you very much for your question. In relation to the July rate hikes that we discussed, we certainly considered that the three rates would be impacted by the hike, not just the DFR. For future references, as of September, we might also apply the principle of hikes to the three, but we have not discussed that yet. And I think the intention will probably be to have a close look at that and to determine whether or not we want to just keep those spreads or return to a better symmetry between those three. That's clearly to be debated at either our next meeting or the September meeting. On the conditions that would trigger the anti-fragmentation, let's be clear. The critical point is monetary policy transmission, and we are very attentive to make sure that it transmits throughout the entire euro area. So there is no specific level of yields increase or lending rates or bond spreads that can unconditionally trigger this or that. The principle is that we will not tolerate fragmentation that would impair monetary policy transmission. And we will determine on the basis of circumstances, of countries, how and when that risk is likely to materialize, and we will prevent it.
Thank you very much. I would like to turn now to WebEx and take a question from a colleague in Frankfurt.
Oh, we had forgotten WebEx because you're all here, which is so much nicer.
So Andres Stumpf of Expansion, your question please, and please turn on your camera and your mic. Andres, for the time being, we can't hear anything.
Can you hear me now?
Yes, wonderful.
Okay, I wasn't able to unmute myself. I have another question, Madame Lagarde, about fragmentation. We are today experiencing a new sell-off in sovereign bonds, and this might point that the PEP reinvestments and maybe the ECB new commitment is not enough to prevent fragmentation. Has the ECB any news on how the new or the adjusted tool could even look like? Thank you.
Thank you very much for your question. I can only repeat what I have said, which is that we will not tolerate fragmentation that would impair the proper transmission of monetary policy throughout the entire euro area. We do have existing flexibility that is embedded in the reinvestment of our PEP in particular, and we have demonstrated in the past, we will demonstrate if necessary in the future, that we can design, we can deploy the appropriate instrument to prevent that risk from materializing. Thank you.
Thank you. And the next question will go to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Good afternoon, and thank you for taking my questions. President Lagarde, I have two questions. One is on the importance of data dependency. And looking beyond September for rate hikes, the Governing Council will adjust the monetary policy and it will depend on incoming data. Can we expect then lift-offs to come on a quarterly basis, coupled with the macroeconomic projections? And my second question is on financial stability, because you mentioned it. You mentioned that banks will be facing credit risks increased due to tighter financing conditions. How concerned are you about financial stability in a war situation? Thank you.
I have to tell you that I'm concerned about the war, full stop, but your question goes further than that, of course, and the financial stability side of the question I will defer to my esteemed colleague, friend and Vice President de Guindos. The first one, yes, we are going to pay a lot of attention to data, and we are considering data dependency as one of the key 4 principles according to which we will operate. And obviously, you know, the quarterly projections that we produce are, you know, very rich, inform our decisions best. But we cannot be unattentive to developments and to data that we continuously collect, both at the ECB and within the national central banks as well. So we are not going to put ourselves in a straitjacket of only taking decisions when we have projections. So with that, I'd like to hand you over.
Thank you very much for the question. You know that in our strategy review we included a reference that twice per year we would include financial stability considerations in our monetary policy making. And you know, we did it in December and we have done it now in June. And here, you know, the message is quite clear. The vulnerabilities of the financial system in Europe have been defined in our financial stability review, refer to problems in terms of valuation of financial assets, in terms of margins of the banks, and in terms as well of you know, high valuations in some spots of residential real estate. So the conclusion that we have reached, that is included in the monetary policy statement, is that in the short term, the normalization of monetary policy conditions can give rise to additional stress in the short term, but in the medium term, you know, the tightening of financial conditions could be positive in order to try to address some of the vulnerabilities. Think about residential real estate. So, you know, this is the main conclusion. And, we try to make an assessment that covers not only the short term, but as well the medium term.
Thank you very much, Vice President. That brings our press conference today to a conclusion. Thank you very much for coming here.
I would just like to add something, because we are here standing in Amsterdam, and my colleague Klaus Nott is with us. And for those of you interested, we had just a fantastic meeting that was organized under the auspices of the De Nederlandisch Bank, under the leadership of Klaus. And it's been just a really good, fruitful and productive experience. Geography matters, and hospitality can help a great deal. So thank you to the Netherlands, and thank you to the National Central Bank of the Netherlands.
And our next scheduled press conference is on 21st of July in Frankfurt.
Hospitality in Amsterdam is not helping out this bond market. From New York City this morning, good morning, good morning. Let's talk about this price action. We're set up as follows for the euro on euro dollar, following a decision from the ECB to keep rates unchanged, but tears up for a move in July and maybe a bigger one in September. Euro dollar just a break of 107 at 106.89. Here's the move in the bond market. This is where things get interesting. In Germany, a 2-year yield higher by about 10 basis points. On a 10-year, just a little bit lower, higher by 6 basis points to 141. That curve flattening, this curve isn't. In Italy, what a breakout on an Italian yield curve, up by 16 basis points on a 2-year, up by almost 20 on a 10-year to 355. Let's call it 356, pushing 360. So in July, we're set up for 25 basis points. What about September? The ECB president leaving the door open to a 50 basis point move.
The answer is yes. The calibration of this rate increase will depend on the updated medium-term inflation outlook. And here's the important one. If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at our September meeting.
Let's head over to Amsterdam and catch up with Bloomberg's Maria Tadeo. Maria, run me through your takeaway of the last hour.
Well, look, Jonathan, I think in many ways she just confirmed what we got from the statement, that this is the end of an era for the European Central Bank. Of course, we're heading into a 25 basis point hike in July, and there will be now another one in September. That was on paper, and she repeated that verbally. They're, of course, opening potentially the door for a 50 basis point. She did not push back against that, but I think for me, the real takeaway, and if you're listening to the number of questions, there was this idea of fragmentation. She got 4 questions on fragmentation. She repeated, we can't afford that. We're going to deal with that. We've done it in the past. We've done it in the future. But however, there was a lack of detail that I think when you look at the market reaction, especially BTPs, the spread, also the way it's moving on the German one, it was underwhelming. And the fact that she kept repeating the same answer without actual details of it, I think that was very, very underwhelming. And you're coming out of a conference where a lot of investors right now, especially if you trade the BTP, it's not obvious which way the central bank is going to go, but also how ready they are to provide this buffer, and in particular, what shape and form.
Which is why we're seeing some big moves in this bond market. Maria, great work as always. Maria Tadeo in Amsterdam with the European Central Bank on tour this time around. You heard the opening bell ring there. About 40 seconds in, we're down 0.4% on the S&P. On the Nasdaq, we're down by 0.5%. No real drama here. But over in Europe, this move in Italy, in Germany, it gets your attention. It got the attention also of Mohamed Al-Arian, who tweeted the following: the more I listen to ECB President Lagarde's remarks, the more I feel that this Governing Council meeting will be remembered as marking the official recognition of a consequential secular change in both the economic outlook and the policy regime. We get lucky this morning. Mohamed joins us right now. Mohamed, let's start there. Your takeaway from the last couple of hours.
You know, it started by being a somewhat more hawkish outcome. And then the more I listened to President Lagarde, the more I realized that she was signaling this consequential change in the policy regime. This is a big deal, what went on in Europe. And I think the market reaction is indicative that the market is starting to understand that we've exited one regime and we've entered another regime. You know, if you listen to her carefully, she almost said that 50 basis points would have been the right move today if it weren't for the history of not having moved for a long time. That is quite a statement, and it opens the door not just a little, wide open for 50 in September.
Some people will struggle with this, Mohamed, this idea that they can be gradual when inflation has an 8 handle and rates are still negative 50 basis points, and they'll only be going 25 basis points in July. So what we face, Mohamed, is Europe going through a whole summer of high inflation with interest rates still negative. Now, Mohamed, I get it. It's a big change for someone that's followed the ECB for a long time. I get all that. But when you look at where policy is relative to where the data is right now, that's a long summer, isn't it?
It is a long summer, but John, you also rightly showed and tweeted about Italian spreads, and that is what's holding them back. They really are worried about fragmentation. So they're going to have to strike that very delicate balance. As I said, I think that they would have rather go 50 than 25 in July, and they may still do it. You know, I wouldn't rule it out completely, but yes, they are late. Yes, they've got to get going, and she stressed it's a journey. She kept on talking about the journey that they're starting to embark on. So she's trying to give a very clear message that if you net present value what they intend to do, it's equivalent to moving quite a bit early on.
Should we talk about this journey together? For July, 25 basis points. For September, in the statement, this is what it said. The calibration of this rate increase will depend on the updated medium-term inflation outlook. If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at the September meeting. Then they went further, Mohamed. I was surprised by this. I thought they'd tee us up for July, give us something for September, but then to say we'd see gradual and sustained hikes after that. we're now thinking about not just interest rate hikes for the first time since 2011, not just exiting negative rates for the first time since 2014. Mohammed, we're thinking about a rate hike cycle at the ECB. You and I have spent months talking about what is achievable for the Federal Reserve. Given the breakdown that we're seeing in the Italian bond market, which is recovering just a little bit on my screen at the moment, how achievable is a rate hiking cycle at the ECB, and what does it actually look like from your standpoint?
So I think it is achievable. I think it's achievable if only their own forecast is 6.8% inflation for this year. Their own forecast is 3% for next year. So they've got to move. I do think they have the tools to counter fragmentation pressure. What the market is nervous about is they didn't hear details, but they have set up mechanisms to counter fragmentation. The worry, John, is unlike the Fed, the ECB has only one objective, and that's inflation. And the real economy is going to suffer. Look, I'm willing to bet you, John, that when we get the next set of revisions, growth will come down even more than what they've brought it down. And remember, we are in mid-year. I'm amazed to see how big the revisions are for the current year, given that they're happening in June. Look what the OECD did and the World Bank did earlier this week. There's a major downward revision of growth going on around the world.
I want to speak to those revisions right now, Mohammed. As you speak, we've got them on the screen. 2.8% is the GDP forecast for this year. It's down from 3.7. The inflation forecast now 6.8. The previous was 5.1. I had a guest earlier when I asked them, Mohammed, is it achievable to get 2.8% growth in Europe this year? And they said no, recession. You've said the same thing before. These central bankers don't forecast recessions, Mohammed. They certainly don't do that if they're forecasting higher interest rates either. What do you think those revisions will look like on the growth side, coupled with the pressure on the inflation side?
So I suspect we will get a lot lower than the current 2.8% this year, with a few countries of the Eurozone in recession. Why don't they project it now? There's enormous institutional inertia. I worked in a multilateral for a long time, and I can tell you it's very hard to make major revisions unless you're in the midst of a crisis. So we should expect the next round of revisions, and that's true not just for the ECB and the Fed, but also for the OECD, also for the World Bank, to include further downwards revisions in growth and further upward revisions in inflation.
What do you think takes priority? The inflation side of the story or the growth side of the story? When they meet again in September and the revisions evolve in the way you expect them to?
Inflation for the ECB. That is their objective. That's what they're going to be judged on. They are way behind, and they've got to move. So inflation, and the tone of President Lagarde was completely different from anything I've heard from her before. This is quite a significant change in tone.
She was asked 1 million times about fragmentation, Mohammed. I wrote down some of the stuff she said. Within our mandate, we are committed to preventing fragmentation risk in the euro area. And the why, it would undermine the ability of the ECB to achieve its price stability mandate. Now, from my vantage point, others too, Mohammed, some people might sit here and say, are they contradictory goals to try and avoid fragmentation risk and also to tighten financial conditions sufficiently to bring inflation down? The ECB is saying they're not. What do you think?
I think they're not. And the phrase that you should have written down, John, and I'm sure you did, is monetary transmission. She linked the two by monetary transmission, that if you get fragmentation, you will not get the proper transmission of monetary policy. And that is correct. As I said earlier, John, I think they have the tools to counter fragmentation. So the fear of fragmentation is not going to get in the way of this journey of higher rates.
We're going to spend some time talking about the Fed in the next segment, Mohammed, but I wanted to tee it up with you, just as the ECB as a reference point. How different is it with this ECB joining the Federal Reserve in this tightening cycle in a way that it just did not play in the last 10 years? This feels so different to me. The ECB sat it out last time around. It's not this time around. The BOJ sat it out last time around. They're trying to do it again. That's an interesting element in all of this as well. But Mohammed, just your thoughts on that at the moment.
Oh, it is very different. I mean, in fact, you could argue that the ECB has leapfrogged the Fed. President Lagarde spoke about how they looked under every stone to figure out why the inflation forecasts were wrong. The Fed hasn't done that yet. The Fed hasn't explained to the marketplace why its forecasts were so wrong. She then talked about a journey going beyond September. The Fed hasn't been as explicit. Their guidance is really till September. So in a funny sort of way, not only has the ECB joined the Fed, they've leapfrogged the Fed. And you saw that initial reaction in the FX market as the marketplace recognized that this was a significantly more hawkish ECB than the statement suggested. I mean, the press conference will be looked back, I think, as a seminal event.
Just watching this Italian 10-year story fade just a little bit more. We were positive more than 20 basis points on a session, now up just 15. Mohammed, I want to keep building on this with you. The ECB is playing in a rate hiking cycle in the way that it didn't with the Federal Reserve. You think this is becoming the more important story, slightly perhaps. The BOJ's not. This has consequences for foreign exchange. We're seeing this push up against dollar yen. Dollar yen through 134 overnight, seemingly at one point pushing 135. It could have consequences for the bond market in a way that we didn't see in the last cycle either. Mohammed, I've been surprised by how quickly some people have got comfortable with the idea that we might have seen a peak on a 10-year yield in early May at 320. Comparing it to what we experienced maybe in late 2018, this time around, German yields aren't sub-zero, they're positive. As you sit and look at bonds at the moment, Mohammed, how big a change is that, and how does it influence your thinking on where this bond market is going?
So I think we're having a general tightening of financial conditions around the world, and I think that's important. Yes, Japan is the outlier, but look at the functioning of the Japanese government bond market. It is not functioning well. It's clear that it is reaching the natural limits to unconventional policy. So even Japan is going to have to somehow exit from the regime that they're in. So this is a consequential change in the bond market. It's clear for what happens to the front end of curves. Once you get to 10-year or beyond, you have to worry about the growth implications. And that's why you've had this incredible volatility that we've seen in the 10-year in the US because of the different growth outlooks that have played out. John, I would keep a really, really close eye on the functioning of these bond markets because, as you know, there's three sorts of risks that the market are having to navigate. One is interest rate risk. They've navigated that rather well, not perfectly, but rather well. The second one is credit risk. They're embarking on this now. And the third one, which is the ugliest of all, and we don't want to have to navigate it, is liquidity risk.
Well, Mohammed, I'm not sure there's even a market in the JGB market in Japan at the moment, as we both witnessed this week. Another trading day. Haven't seen that this year, I don't think, so far. Another trading day of no trades whatsoever on a 10-year JGB. Mohammed, we're lucky. We're going to get another segment in with you, and we're going to talk about inflation, which is due tomorrow. Looking at this equity market at the moment on the S&P, we're down 0.5% with some movers. Just quickly, here's Abby.
John, a bit of wild action here on that ECB decision because, of course, ahead of it, the U.S. 10-year yield had been lower. At that point, tech higher. Then it shot up 4 basis points, bringing tech lower. And even though the 10-year yield is now flat, we still have big tech reverse lower. Apple down 0.8%. KeyBank also seeing signs of softening of demand in U.S. NVIDIA, they signed a partnership with Hynix. That stock is lower, however. One outlier, Tesla, up 1.2% on some positive trends in China. And then speaking of China, Alibaba cooling off after a 28% 3-day move. Today down 4.4%, maybe because of the yield story and also the idea that there could be limited lockdowns in Shanghai this weekend. Alibaba right now down 4.4%, similar to U.S. tech right now, tech.
Abby, thank you. Coming up, inflation, top of mind.
Look, inflation is the bane of our existence. Inflation is mostly in food and in gasoline at the pump.
Except it's not, because core inflation is also running at 6%. Tomorrow, we're looking for another big print. We'll have that conversation next.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron, because as we know, many parts of the world use different types of vaccines, and that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
We're the strongest economy, and that's allowed us at least to stay on top of and a little bit ahead of what's happening around the world. Look, inflation is the bane of our existence. Inflation is mostly in food and in gasoline at the pump.
The latest read on inflation in America, 24 hours away. The administration and investors bracing for another elevated print. With more, here's Candy Lyons.
To be 8.2% on the headline for the month of May, John. And of course, even if that is a slight moderation from the prior month, when you look at the month-on-month figures, it's expected to be a higher number, about 0.7%. So prices are still climbing and wages are not keeping pace. And that's really the problem for the Biden administration, because the American consumer is feeling the pain, especially as for the last 2 months straight, the primary consumer expenses, fuel, power, and grocery store food have all been rising at double-digit annual rates for the first time since 1981. Food prices up nearly 12% in May. That's going to be one big contributor to the headline number. Another is the spike in gasoline prices. Pump prices up 8.2% last month, still climbing, now near $5 a gallon. They have more than doubled over the course of the Biden administration so far. But of course, neither gas nor food goes into that core metric. When you back those out, the print is expected to be softer, 0.5% month on month, 5.9% year on year, as you see demand moving out of goods, consumer discretionary goods, and into services. But our economists here at Bloomberg Economics, John, say that speaks to the mistake the Fed made. What started as supply-side goods-driven inflation has now widened out to services, which is stickier, and that means 50 basis points is going to be the move for maybe longer than this market expects, John.
Kelly Lyons, thank you. Still looking for a headline number with an 8 handle potentially. Month over month core is what this market will look at. Wall Street will be focused on, and even there, 0.5% is the estimate so far. That's elevated. We're lucky. I've said that 3 times now. 3 times a chime. Mohammed, thank you, sir, for being with us still. Let's go there. What are you looking for from CPI in the United States tomorrow?
So I have no reason to have a different forecast from the consensus of 0.5 and 0.7 month on month. But what worries me, John, and you're not going to like this because it's looking forward, the June month on month print will be worse than the May month on month print. I think those who boldly said inflation has peaked and it's coming down may have to change their minds. I wouldn't surprise me if we see a headline print that's much higher than the 8.5.
Next month, Mohammed, why?
Not as early as next month, because first, the drivers of inflation are broadening, and that's due to the Fed policy mistake. Secondly, at the headline level, energy prices are going up month on month quite dramatically. And thirdly, we're seeing pressure on shelter and food. So if you look at all the components, it's way too early, unfortunately, to say that inflation has peaked. I hope it has, but it would not surprise me if we go above 8.5% on a yearly basis.
Hey, Mohammed, this is really important. I remember when you gave me the call early last year, and you said, I don't think this is transitory. This is important. I'm pushing back. And you went out there in force, and that force got more powerful as the year progressed. I get the feeling this year, Mohammed, that we still haven't totally relinquished this idea that a lot of this is temporary. I hear from a lot of guests who think that we've seen the peak, a mechanical peak year over year, and for good reason, and they think the Fed backs away in September. Are you stressing this is going to persist through the whole of this year, that we're not going to get that drop-off that so many people are hoping for, looking for?
John, if we get a drop-off, we'll get it for the wrong reason. We'll get it because of demand destruction, and that would be tragic. The last thing we need is for inflation to completely undermine the demand side, because then we have not only a price issue, but we have an income issue. And once again, it will be the most vulnerable segments of the population that get hit the hardest. So in a way, be careful what you wish for. So if you believe the labor market stays strong, wages remain buoyant and start catching up to inflation, then it's very hard to see inflation coming down. If, however, you think that we're going to have a recession, sure, inflation is going to come down, but that's not the sort of transitory inflation that anybody wants.
Can you take any confidence from the labour market prints we've had recently, Mohammed, that we've seen robust jobs growth, yet we haven't seen unemployment come lower, we haven't seen wages accelerate? Can you take any confidence? Is there any sign whatsoever that we are slowly getting the supply-side response that can alleviate some of this pressure?
Yeah, I certainly do. To be clear, recession is not my baseline. You've heard me say over and over again, it's stagflation is my baseline and recession is my risk scenario. John, the only thing I wish for on the labor market side is higher labor force participation and higher wages, believe it or not. That's the only thing that's missing. Otherwise, this labor market is very strong.
So when we wake up in September, we've had 3 more inflation prints going through the summer, and they sit down at the end of September at the Federal Reserve. Jackson Hole's behind us, all of that, Mohammed. What do you think the Fed has to confront, and how do you expect them to confront it?
I suspect first they'll be happy that most of the blame will have gone to the administration, unfairly so. You know, when I look at the mistakes made or the drivers of inflation, the administration comes 5th. However, it is the administration that's going to be blamed. So I think there'll be some relief in the Fed that people won't quite understand how much of this is a Fed policy mistake. But second, they're going to have to be much clearer about that path. And you've heard me say this, much clearer about what mistake are they willing to underwrite. Because right now, they are so late, John, that there is no first best policy response. That was last year when you and I were discussing it. Now, it's about minimizing the mistake. And they're going to have to make a choice and stick to it. The worst thing is the flip-flopping Fed. A Fed that hikes rates and then pauses in September, then starts hiking again, and then pauses again. That would just mean that stagflation would persist much longer than it needs to.
Mohammed, you were right, they were wrong. And we're lucky for a 4th time to catch up with you, sir. Thank you very much for being with us. Mohammed Al-Arian from Queen's College, Cambridge there, breaking down the latest move from the ECB, looking ahead to CPI tomorrow and looking ahead through this summer, the challenge that the Federal Reserve faces, a challenge in the minds of Mohammed and others of their own creation in some ways. Coming up, the market moving events you need to be watching. Your trading diary is up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
"25 minutes into the session, equities doing okay. Unchanged, treading water, if you will, going into CPI tomorrow at the ECB. Unchanged on the S&P 500, positive just a little bit on the Nasdaq by 0.1%. Following the ECB, rather, some of this price action settling down. CPI tomorrow is your trading diary. President Biden delivering remarks at the summit of the Americas at 2 p.m. Eastern. Then tomorrow morning, it's the main event. US CPI coming on Friday, followed by the University of Michigan Consumer Sentiment Survey. Looking ahead to next week with US PPI on Tuesday, a Fed rate decision and Shetland Pound News Conference next Wednesday. Then it's the Bank of England's turn with its own rate decision on Thursday. And finally, it's the Bank of Japan's turn next Friday. So a ton of really important central bank decisions coming next week. Before we get there, US CPI. And this country facing another headline print with an 8 handle. This market focused on the core month-over-month read, and even that is looking elevated. From New York, this is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
898, I won! Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realised something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumours that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking, and of course Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19 they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venergold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Wienergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Wienergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, 1 kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At 1 kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000!
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating, where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission, that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
The Fidelities and the Schwabs and the E-Trades of the world, they look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech in right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this.
I made the options video where I was like, options are just like shopping.
Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price?
And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're gonna watch and gonna stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, The hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign the ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interests of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
Usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home, but in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing,
Google in the morning,
and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The US connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.